Of trade in the U.S. markets on the first day after the Trump inauguration. The Dow has risen over 500 points. Bear in mind, everything that I'm going to set up for you is in context to some of the things or many of the things that President Trump has been saying. So you've had the Dow up nearly 537 points, the NASDAQ up in the green as well, Dow futures right now trending in the green. So what is Trump saying? The latest, and I thought important to note, he may impose 10% tariffs on China on 1st Feb. He's come out and said that. He's also announced at least $500 billion, and this is important, $500 billion investment in AI. Oracle shares popped up after this. So did SoftBank, because it's a JV of sorts, an alliance that he's building on artificial intelligence. We'll have to wait and see if Indian stocks or Indian tech stocks react at all. Netflix also zoomed, I think, one standout story, nearly 14%, because stellar results beat on all fronts for Netflix, record number of new subscribers coming in as well. Bond yields have slid on the first day of trade post the Trump inauguration, which is not half bad. Maybe inflation fears are receding, but also because all of these tariffs is raising concerns on what that does to economic growth, which is why you saw crude also slipping on those Trump announcements. The Brent, in fact, was below the $80 mark. What about the other asset classes? Gold hit a 2-month high. Shows volatility and a bit of concern out there. Crypto zoomed, no surprises there. Solana was up, I think, about 4% odd. Asian markets have been trading mixed. All eyes on what Bank of Japan and the commentary coming there. So Nikkei about 1.5% up. Hang Seng down deep in the red. Shanghai also down. So mixed case there. India looks like it's going to open up in the green, and that would be a huge relief after yesterday. I mean, Alex, if you pull up the intraday of the Nifty, it was ridiculous at some point. So sharp falls and then gains.
Yeah, so I was suggesting a headline for the Sensex. Incidentally, yesterday was Sensex expiry, so some bit of that volatility is being attributed perhaps to that. I don't know how much, but you say, I was suggesting close to 1,000 points on the Nifty, on the Sensex. The Sensex down close to 1,000 points twice in a day. And that's exactly what panned out in trade yesterday. It briefly slipped into the green territory, but then it went back. Let's, before we get started, talk about the flows, because the fund flows will give you a picture. 13 straight days of selling by foreign institutional investors, and another 5,920 crore rupees sold on a net basis in trade yesterday. And that's proving to be a little bit of a downside for the Indian equity markets that continues. Equities fell, obviously. There were sharp gyrations. We spoke about that. They closed at the lowest since the June crash. Volatility spiking in trade yesterday. And the VIX as measured by, or the volatility as measured by the VIX is up at 17 at this juncture. The Nifty 50 broke below 23,000 for the first time in a while. In fact, it closed above that mark, and we'll have to watch that number very closely in trade today. This month, the Nifty 50 is lower by as much as 2.6%, and the broader markets have seen a sharper sell-off. In trade yesterday, in fact, you had the mid-cap index down about 2% and the small-cap index down over 2%. Understandably, the market breadth tilted very firmly in favor of the declines. 4 stocks losing for every stock that gained in trade today. All sectors lost ground, with the realty and energy seeing the worst battering. And a few of those stocks, even Sunteck Realty, which ended with very narrow gains at the end of the session, lost as much as 9.4% from the high point yesterday, that entire pack being beaten down very sharply. In fact, let's only pull up the big losers in trade today, because this will tell you a story. Newgen Software was the biggest loser, but Dixon Tech was a big talking point yesterday, and so was Zomato. A big beat down on the back of its Q3 earnings. Keynes Tech and MCX also reacting to the earnings and down as much as 9%, Tamanna.
So, okay, just to add a bit more, detail to what you said, and exactly that, Alex, I think just watching that chart would be giving anyone vertigo yesterday, because the Nifty 50 obviously breached the 23,000 mark intraday for the first time since June 2024. So that's a pain point. Volatility remains elevated. India VIX was back at 17. That's the highest in the last 2 months. The Nifty has now, and this I found interesting, Nifty has moved more than 150 points up or down 7 times in trade yesterday. Of this, 300-point move was seen 4 times. That's the extent of volatility. So the near-term market sentiment is clearly negative, and that will continue. This is weighed down by weak earnings report. I mean, we'll come to some of the key earnings, but you look at the list so far, nothing is really standing out. It's looking quite dismal on the earnings front, and that remains the number one reason. External geopolitical tensions are also there. I mean, President Trump is talking about hitting back at BRICS nations if they stop de-dollarization. Not sure what that means. Tariffs on China, tariffs on Canada, tariffs on Mexico. The fact that this Birthright Act is going to be scrapped, it will be challenged in court, is going to be a huge hit to the H-1B visa holding talent that is moving out of here. Remember, a lot of people go there, they stay for years before they get a green card, they have families, their children are naturalized because they're born in the US. That doesn't happen anymore. So global interest rate expectations are also wonky, which is why the overall mood is a bit bearish. In fact, the put-call ratio indicates a bearish mood, and the rising India VIX also shows some caution. So what could traders do? Traders may look for opportunities to short or hedge their positions as long as market remains below key resistance levels. The one positive is that the FII long continues to remain low at 17%, and this could lead to a relief rally. Your immediate support levels are 23,000, next one is at 22,800, and then 22,600. Resistance at 23,200 and 23,300. So, I mean, your implied is indicating that you might be okay, but we'll have to wait and see. Results will become the big factor. I mean, an HDFC Bank will come in mid-afternoon, mid-trade around between 1 and 2 o'clock is what we're expecting this afternoon. If that is a good set of numbers, and we'll get you a preview very quickly on that from our banking analyst, you could see some relief there. HUL will report, and that becomes important. BPCL, Coforge, Persistent, these are some of the key numbers to look at. And like I said, HDFC Bank's report becomes very, very crucial. If HDFC Bank pulls through, then you might see a change in sentiment. So that is maybe the one factor. Let's pull up delivery data for you as well, because some huge hits yesterday, and look at the kind of volumes we saw with delivery. Zomato, the big one yesterday, 39.65% delivery, but I would mark out an ICICI Bank as well for you with 59.5%. So delivery volumes have been quite robust. Dixon Tech is the other one which had a huge hit yesterday, 31.2%, and look at HDFC Bank ahead of its numbers at 44.5%. RIL, interestingly, nearly 45% of delivery going in yesterday, and here's the rest of that chart for you. Bharti Airtel stood out at 57% as well, and Coal India, 78% delivery percentage there. So quite a few numbers to watch out there, but I suppose Alex, the big ones will be the results today, and maybe we'll start off with your list.
Absolutely. And in fact, I'm very keen to find out what HDFC Bank puts out, because that's going to set the tone. I'm going to get the bad results out of the way first, and there's one. So out of the 3 stocks that I've selected, Dalmia Bharat is a bit of a disappointment. The volumes proving to be the sore spot here. The revenue declined as much as 12%, but the big hit is going to be on the margins front, where you had a contraction to the extent of 16.1% versus 21.6%. The net profit as a result declining as much as 75%. There is a note that has come through. Jefferies has maintained a buy with target price of 2,070. It said that the miss was on account of weak volumes and higher costs for the company, and realizations were slightly better than expected, and unit EBITDA has also improved. But watch out for this one at the start, the earnings not too strong. KEI Industries, also a set of not too good results. The revenue came in at 2,467 crore rupees. That was in line, but the margins and the net profit were below. Margins have come in at 9.6%. The net profit coming in higher by about 9.4% at 165 crore rupees. UBS has maintained a buy with a cut of its target price to 5,750 crore rupees from 6,050 crore, 5,750 rupees versus 6,050 rupees earlier. It has in fact said exactly what I just said, in that margins have missed, led by volatile commodities and muted government capex. The last stock that I will talk about is PNB Housing Finance, and this is a thumbs up, a good set of numbers from from this housing finance company. The net profit is up as much as 36% at 471 crore rupees. There was some recovery that the lender managed to do from its retail book to the extent of a little over 50 crore rupees. The net interest income growth is as much as 17% and 4% sequentially. The gross NPA has declined 54 basis points to 1.19%, and that's certainly positive. The net interest margin has managed to stay at about 3.7%, and it's actually an improvement sequentially from 3.68%, and the return on assets is also positive at 2.5%. So MS, which is Morgan Stanley, has maintained an overweight with a target price of 1,520.
Okay, so PNB Housing is one glimmer of hope
Yes.
that you're seeing. I wish I could say the same about my list. Unfortunately not.
They're all thumbs down.
No, they're pretty much all thumbs down this morning. That's right. ICICI Pru, thumbs down. You know, because numbers were in line with estimates, fair enough, but margins this quarter have declined because they're simply selling more ULIPs. And that has impacted their margins. ULIPs and group funds share has gone up in their new business. So that's why the value of new business, or VNB margins, a metric which you've seen for insurance companies, has gone down sequentially, quarter on quarter. They're moving to demand as well. And I wonder, the whole case for insurance companies has been that while equities is looking so volatile, maybe some of the family savings which had gone into equity will come back into insurance products or insurance/investment products. Not a great thing for investors, but yes, for those companies, definitely. So let's just look at some of those metrics. Net premium income up 23% at 12,261 crores versus 9,929 crores. Net profit up 43% at 325 crores versus 227 crores. So like I said, the numbers on the face of it look good, but I just want to pull up that graph which tells us about APE and value of new business, because that gives you a greater picture. Solvency ratio was fine, 211% versus 188%. There was a 13-month persistency at 85.8% versus 86.4%. But when you look at the actual VNB number, that seems to have gotten a little slow. So you actually saw that drop a fair bit to 23.2% in this quarter, drop of nearly 2% sequentially. What is Goldman Sachs saying? They've maintained a neutral with a target price of 650 rupees. They're saying the Q3 is in line. APE growth so annualized premium growth basically was driven by ULIPs. Strong growth has come at the cost of margins. Margins decline on mix shifting to lower margin ULIPs and other group funds kind of business. Meanwhile, Macquarie has maintained a neutral with a target price of 725. VNB growth, that's value of new business growth, continues to disappoint in their view. Higher ULIP, declining savings and higher costs have affected margins. They see a downside risk to FY25 value of new business estimates as well. So that's the picture as far as ICICI Pru is concerned. Tata Tech, and we're going to be speaking with the management, I think, in a short while from now. Tata Tech is a thumbs down as well, unfortunately. Revenues are a miss. Margins are largely in line with estimates. And near-term challenges continue due to delayed decision-making in the US. Maybe that changes now, and that is one thing to watch out for. Revenues are up 1.6% this quarter for Tata Tech at 1,317 crores. The EBIT was down 1% at 204 crores, marginally. Margins are also down marginally at 15.5% versus 15.8%. Net profit was up 7.1% at 169 crores. If you look at the segments, the service segment was also completely flat. Revenues up 0.8%. They have, though, secured 4 large deals in this quarter. Let me pull up for you what Citi is saying on them. They've maintained a sell with a target price of 765. And in Citi's view, the revenue miss is an issue. The near-term challenges due to delay in decision-making in US is what they talk about. And they say these near-term concerns will likely weigh on growth. But I must come to IndiaMart as well. Thumbs down. And this is interesting because the numbers on the face of it look good. Revenues are up 16% at 354 crores. EBITDA up 61.4% at 138 crores. Margins at 39, huge jump in margins, 39% versus 28.1%. Net profit up 47%. So the numbers optically look good. Why am I saying it's a thumbs down? Because this Nomura note is interesting. They have downgraded the stock to reduce with a target of 1900 rupees, and not because of just valuations or something like that. And it's a steep target price compared to where the stock is right now. They've said there's an unexpected decline in paying subscriber base, a low gross addition with sticky high customer churn will weigh on collections growth. They say weak gross customer addition with elevated churn is concerning. They've in fact gone ahead and cut the FY25 to 27 profit estimates by, get this, 4 to 13%. So a massive range there, which is why just, the optically positive numbers won't do.
I don't know when the last time, I mean, it might have happened recently for all you know, but 1,900 is the target price down from 3,150. What a massive cut in target price. Of course, that reflects what you just said on the PAT estimates. But clearly something to watch out for in trade today. Unfortunately, more thumbs down than thumbs up, and that seems to be reflective of what we've seen in the earnings season so far. A lot of companies reporting a contraction in margins and more difficult environment for them to operate in. Let's, in fact, mark a few more stocks that you should keep on your radar on account of earnings. And we've got Mika joining in to round off the list before we talk about the earnings that you should watch out for in trade today. Mika, morning.
Another set of not so very good numbers on my radar. You have Rossari Biotech. Despite revenue seeing 10% uptick, we've seen EBITDA see only a 2% increase. Margins have contracted to 12.6% versus 13% last year, missing estimates of 18%. Net profit is down 7.6%. Now, what dragged the margins despite the revenue uptick is a 25% increase in material costs, an 82% higher stock in trade purchases, 37% rise in employee benefit expenses, and a 22% uptick in other expenses. We also have Tanla Platforms. Revenue is fairly flat with a negative bias. EBIT is down 8.6%. It's missed estimates at 139 crores. The margins have contracted to 13.9% versus an estimate of 17.4%. And net profit has also seen a 9% fall. Muted revenue growth was seen in digital platforms as well as enterprise communication segments. Margins were impacted by 22% higher employee costs and 37% uptick in other expenses, and also by a 4.4 crore forex fluctuation loss versus a gain seen in the previous quarter. And then we have Cyan DLM. It's a neutral on this one. Revenue is up 38% in line with estimates at 444 crores, but EBITDA is down 4% and margins have also fallen 270 basis points. However, net profit is up 40%. Margins and profits have been, impacted by a one-time M&A expense of the acquisition of Altech, and organic order book, excluding the acquisitions, have fallen Q on Q. Revenue split is now diversified because of its latest acquisition.
Okay, all right. Thanks, Mika, for that. And of course, Tamanna has already pointed out what earnings you should watch out for today. Question marks as to whether or not HDFC Bank and HUL will report during market hours, but certainly BPCL is something that will come post market hours. Let's talk about HDFC Bank at the start though, because it's going to set the tone somewhat. It's the largest private sector bank so far to report numbers, and it's set to clock a modest 8% year-on-year growth in net profit. Let me hold off on telling you anything more about the numbers though, because we've got Harsh joining in to tell you about what you should focus on. Harsh, morning. What would disappoint you? Let me ask that.
Well, so you would really want to see margins go up. If that were not to happen, that might in some form disappoint the street, but limitedly. The question will largely be with regard to asset quality and whether HDFC is able to hold on to the kind of asset quality that it has always done. And if any kind of disappointment on that count comes, you might well see a negative reaction on the stock. But in terms of what to expect from the numbers as a whole, one, you'll expect net interest income to be flat on a sequential basis around 30,400 odd crore. In fact, all the numbers to be flat sequentially except that provisions number, which will go up off a low base. Operating profit expected around the 25,000 crore mark. You will see provisions go up from 2,700 crore approximately last quarter to around 3,000 crore this quarter. So you'll see a bit of a spike there. and profit after tax expected around the 17,000 crore mark. You'll expect HDFC to hold on to that ROA of 1.9% plus, and essentially you'll wait for the commentary, one with regard to where margins will go, second with regard to where growth will go, and that will also be determined by a loan to deposit ratio and how quickly they are confident that that will come down. Of course, loan growth is largely muted. How much of the book will continue to be sold off will also be on what investors will watch out for.
Okay, Harsh, stay on with us. We're joined now by Mona Khetan, Director Research at BFSI, Daulat Capital. Mona, thank you for speaking with us this morning, and great to have you on.
Hi, good morning.
Good morning. All right, let's start talking about HDFC Bank. I mean, the narrative, the big question the last few quarters has been, are the merger pains behind us? Do you expect to see some of that this quarter?
Oh, well, yeah. So when it comes to benefits on the cost of funds, I think that's yet to play out. It will take a few more quarters, but the challenges around deposits that we're seeing for the entire industry, because it will hurt, it's probably hurting HDFC Bank a little more than others because the requirement here is more post the merger. So, yeah.
You know, in terms of margins, what are your expectations that you're penciling in, Mona?
So we are penciling in slightly higher margins versus last quarter, maybe stable to slightly higher, maybe a few bits here and there, because there will be some benefits playing out from the sharp decline in wholesale book that we saw. So if you look at the business update that the bank shared, sequentially, the wholesale book declined by about 16%. So we believe that may have some positive bearing on the margin. Otherwise, we were largely building in stable names. Yeah.
Okay. Mona, what is your own expectation on the glide path for loan to deposit ratio? Because that has been the other key monitorable. The bank seems confident that it's going to bring it down over the course of the next couple of quarters. But what, according to you, would not be a good number to see in the third quarter?
So the LDR numbers are already out. It has come down a bit. However, what is a bit concerning to me is the decline in LDR is more driven by runoff in the book versus a healthy rise in deposit growth because of whatever challenges we are seeing across industry. So, that's been a little challenging. So therefore, when I built in a deposit growth of 17% for this fiscal or so, that may not play out the way because in 9 months, the growth has been much lower. I don't recollect the exact number, but yeah, it's been, so they may not be able to reach that mark of 17%, 16-17% kind of deposit growth that we were building in. And therefore, a higher runoff in book will lead to the decline in LDR, something we are seeing over the last few quarters, which is a bit concerning because then your business growth remains broadly more muted than what we were building in a few quarters ago.
Right, Mona, this is Harsh also joining in. I want to try and understand from you what you are penciling in. So what are the estimates that you at Daulat Capital are penciling in, both in terms of margins as well as growth? When do these come back? If we can just zoom out a little bit, try and look at it over the next year or two. When do you expect margins to bounce back and growth to bounce back?
So margins may bounce back prior to growth. We believe, so they may not start reporting higher growth before getting, pre-merger LDR, which was close to about between 85 to 90%. So maybe an 87% or thereabouts is something they will seek, which will take at least this fiscal and the next in our view. So growth will come back only in FY27 probably in a bigger way. However, the other question was around margins. When it comes to margins, I think the pickup may be faster because sometime next year and slowly even some part of this year, we are seeing some benefits of a runoff in the HDFC Limited, the ex HDFC Limited borrowings. And therefore, there will be some benefits on margin sometime in FY27 as well, in the sense that while margins may fall for the rest of industry, they may hold on, post we see the repo rate cuts and everything, they may hold on for HDFC Bank.
Mona, I'm just trying to understand that in relative terms, I suppose the street's excitement about an HDFC Bank and an ICICI Bank also to that extent is that when the big cloud of asset quality is there in the space, then these are the stellar ones. In that context, what would be the bare minimum that the street would expect to see, banking analysts like yourself would expect to see, to say that, HDFC Bank is able to pull the mood positively?
Yeah, so I think we are building in about 50 to 55 bits of credit cost. And, that's on the lower end of industry. And that's, given what we have seen HDFC Bank's history. So, yeah, those kind of credit costs will be sort of expected. If they are able to get in, somewhere a credit cost that's lower than 50 bits, I think that will be a huge positive.
Okay, Mona, thanks so much for joining in, for giving us that perspective ahead of the numbers. Look forward to speaking to you soon.
Thank you.
Right, it's time for a very quick break. We've got lots lined up on the other side. In fact, we've got trading strategies that you should pay attention to, and also a corporate view from Warren Harris of Tata Technologies on the latest numbers. So do stay tuned.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
This January, the world will come together at the World Economic Forum at Davos to bridge differences, because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
I present the budget for a historic
Well, Budget 2025 is around the corner and Macquarie has come out with its budget estimates or expectations on each sector. The first sector is the banking space. They do not expect favorable treatment for deposits and possible capital infusion for PSU banks and insurance companies might take place. Moving on to the next sector, NBFCs is the counter. Credit guarantees similar to SMEs for MFI sector can be expected. In the insurance company space, that is the next sector to watch out for, no change in tax rates or any product or any corporate profit tax rate change can be expected in this budget of 2025. The next sector to watch out for will be cement and metals, where they're expecting announcement on import duties to restrict imports on certain metals and certain materials. Moving on to the auto space, outlay for PM E-Drive and PLI can be expected. Policy initiative to drive localization of key EV-related parts can also be expected. The next sector in focus would be the consumption space. Mid to high single-digit increase in cigarette taxes can be expected. The budget, interim budget which was announced last time did not have any tax rate change in cigarettes, which is why we did see an uptick in stocks like ITC and VST. But this time you could see mid to high single-digit increase in cigarette taxes. Reduction in taxes for low middle class consumers could take place, which could boost consumption in the rural as well as the urban spaces. Moving on to the next space, jewelry is the space where no reversal of custom duty cut on gold will take place. In last budget, there was a custom duty cut announced on gold, silver as well as platinum. There will be no reversal on this as per Macquarie. Moving on to the next space, pharma and healthcare, potential support for higher R&D via tax reduction can take place, and PLI for anti-diabetic and weight loss medication could also be one of the factors that the budget might consider. And modest increase in allocation for Ayushman Bharat is something that Macquarie is expecting from the pharma and the healthcare space. Infra is the next space. Capex allocation for key ministries like railways, roadways, etc. Can be expected in this budget, and announcements around additional dedicated freight corridors can also be expected in this budget 2025. Defense is another area where initiatives to boost defense exports can be expected, and announcements around that will be expected, and initiatives fastening domestic defense equipment procurement could also be one of the things to watch out for in this particular budget. Lastly, in terms of power, green energy thrust to continue. Steps to promote initiatives across the value chain, that is to promote green energy, might also be seen during this budget. Oil and gas is the last counter where Macquarie expects that OMC's compensation for LPG under recoveries might be seen. So these are Macquarie's expectation on different sectors as to how budget may come out with different changes in different sectors and how it may impact these sectors.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims?
All right, that was the profit watch list you were watching on your screens just before we came back. But the other big action, of course, is all the way in Davos at the World Economic Forum. We've been bringing you extensive coverage on what's been happening there, where world leaders are meeting. Let's listen in to Neeraj's Davos Diaries report for today.
Well, thanks you guys. It's really sunny out here in Davos today. But after a super day of conversations around AI and the Trump presidency and more, it's another packed day. One, we are doing an exclusive panel conversation with the Andhra Pradesh government and a panel of some esteemed speakers on AI and its impact on industry. So you don't want to miss that. Amongst known names, the Executive Vice Chair at Citi, Vis Raghavan, will talk about money flows into emerging markets and India. as will Dorit Door, the CTO of Checkpoint, which are reasonably large in India and want to grow. And we'll be talking to them yet again this year about what are the forming of their India plans as they had spoken to us the last time. It's a $20 billion cybersecurity giant listed in the US. We speak to BK Goenka of Welspun on the expansion plans and wrap up the day with a Dil Se conversation with Maharashtra Chief Minister Devendra Fadnavis. Amongst other things, we'll be asking, or I personally will be asking Mr. Fadnavis about what is it that Maharashtra is doing in order to attract more investments into the state. Of course, remember, from Global Conversations perspective, Vishnu Shom will be bringing his conversations with the Israeli finance minister as well as Chandrababu Naidu too. So, and we'll start the day, of course, with Anish Shah of M&M as they straddle across various industries and try and understand from him how is the response been at the WEF to the Mahindra Group and the Indian proposition at large. Back to you.
I think we need to unshackle many sectors where there is just too much regulation for private sector to effectively play a role.
Example?
Anything. I mean, it could be rail, it could be roads, it could be housing, mass housing, anything. You know, it's not an easy way to, it's not easy to do these businesses in India. And if you look at the scale of the Indian companies in these sectors versus the scale of the Chinese companies, I mean, we're not even a fraction of it.
Got it.
I don't want to praise China because, you know, we all know that a lot of those Chinese companies are collapsing. But point is that they were able to scale up.
True.
Maybe they went 2x, 3x, 5x beyond what they should have. But the speed at which they did it created employment. Maybe we don't need to do it at the same speed. Maybe we need to do it in our own measured way. But it clearly has to happen.
Okay. Now,
because only the cities are developing. If you look at the tier 3, tier 4, there's not much happening.
okay. And there is room
We
there.
need to improve the quality of life of the people in Bharat, not just the people in India.
Every market has its idiosyncrasies. Every market has its own set of regulations that you need to navigate. I mean, we are blessed as a Novo group in that two of our operating companies, Novo Nordisk and Novo Nessus, have been in these markets forever. They've been in China for 30 years. They've been in Bangalore and India for decades, and we leverage off of that capability. But I have to say, we have found investing in India reasonably straightforward. We have not faced any obstacles that have surprised us or have told us or have convinced us to slow down in any way. Totally the opposite. I think there's very much of a pro-growth, pro-investment agenda. We're very much aligned with that, and we're very excited by the India opportunity. India right now is, we've allocated, I would say, if we look at our total investments in Asia, India is about 40% of that. So a really big commitment to the country, and we're very excited by the potential.
All right, so that's a very small glimpse of all of the conversations that Neeraj has been having and will have in Davos. I'd encourage you to stay tuned through the day, and we'll bring you more glimpses. Of course, you can also find a lot of content on our YouTube channel, so do check that out as well. In the meanwhile, let's turn back to stocks that you should watch out for in trade today, and one of them certainly is going to be HUL. We brought you the preview for HDFC Bank, but this really is going to set the tone for the FMCG space. We've been speaking about how consumption is a bit of a question mark. What are the numbers going to look like? You've gotten a glimpse, of course, based on the initial numbers, the business updates that were sent out by the company. But Mahima is bringing in what is expected on the earnings front. Mahima?
Right, so Q3 again is going to be a muted quarter for HUL. In terms of the Bloomberg estimates, we're expecting an uptick of around 3% in the revenues. EBITDA is going to remain flat. Margins will take a hit to 23% from 24%, and this is on the back of the raw material inflation that is going on. And net profit may rise by around 5% odd. Now, in terms of what to expect, single-digit growth overall, demand to remain muted, especially in urban urban areas, margin contraction due to raw material inflation, volume growth to remain range bound, and this is because company would have taken price hikes, and improvement in rural consumption is something to kind of expect. Now, what to watch out for? Their commentary on the new subsidiary. They've now decided to make a new subsidiary with for their ice cream business, which is Quality Walls. The commentary coming in on that. The commentary coming in on minimalist acquisition is also something to watch out for. Demand recovery in urban areas and the quantum of price hikes that the company has taken will kind of determine as to how the margins pan out. In terms of brokerages, Axis Security believes that revenue is expected to grow on 3%, 1% volume growth versus 3% volume growth in Q2, 2% price hikes are expected, and EBITDA margin is likely to decline owing to higher input costs. Nuvama says demand trends to remain similar to Q2. Exceptional items are likely to form as a sale of Pureit. Systematic says that faster growth of small packs will impact the product mix, and hence this will also impact the margins. Winter portfolio to underperform, and price hikes won't fully offset the sharp inflation in palm oil. Lastly, HDFC Securities believes that urban slowdown and increased competition across categories would hurt the performance of HUL, and hyperinflation in raw material index to weigh on gross margins, and higher royalty rate and termination of GSK consumer distribution contract will also kind of hurt margins. So margins will definitely take a hit when it comes to Q3 numbers for HUL.
I'm just wondering, Mahima, as a defensive play, how Street is looking at an HUL or any of these majors. And are you going to be looking out very closely for what kind of commentary is coming from HUL on demand, especially rural demand?
Not just rural demand. In fact, rural demand, we're definitely expecting a recovery there in terms of small packs, but that will kind of hurt the margins. But something that we really look forward to is the kind of urban recovery that is taking place. Since the past 2 quarters, we've seen that there is a slowdown in the urban recovery, and that is where the margins come from and the top line and volumes come from, which is why we are expecting that if a positive commentary on the urban recovery comes into picture, we'll see that the other staple companies will also have a good set of numbers, but which is unlikely. So that is something to watch out for.
Yeah. So no, I mean, if there's pain across the board on consumption, then HUL is the bellwether to give us that picture, no doubt about it. Thank you for that, Mahima. I know you'll be tracking that very, very closely. But just an interesting aside, Alex, we spoke recently to Sandeep Tandon, and of course on the budget and everything expected, but also what's happening in the markets. And one of his top bets for 2025 was FMCG and pharma.
Interesting.
He's saying now spot what has been beaten down the most and go after it. I mean, he didn't mention any company specifically, but FMCG and pharma, he's saying, yes, it's time for that defensive play.
I would be very keen on finding out what is announced in the budget, because a lot of people are pinning their hopes on what the finance minister will say to bolster consumption. This is a narrative that has been created over the last several months now, because...
But what can she do? I always think about this. They're not going to put more money in your hands. They're not going to cut taxes. How are you going to do it?
Okay. Well, we haven't seen a cut in taxes for a while, but that doesn't mean that she won't contemplate it. I'll tell you why. Non-individual tax collection on the direct side is up 22.5%, and that's not even for the full year. And it's more than what you've collected from corporates for the first time in I think a while.
Non-individual.
So non-corporate individuals. Individuals.
Yeah.
So individual tax collection on the direct side is up 22.5%.
So you're
it's
saying
more than corporates.
No, so you're saying because this category pays more tax, they deserve some relief.
Not just that, you have a larger number of individuals that, because of the tinkering that was done last time around, are not paying taxes. They're filing their returns, but they're not paying taxes. The number of people paying taxes is reduced, but they're paying more tax.
Always. That's
and these
the
are the people that spend and consume.
Yeah, but what is fair and what they deserve doesn't mean that's what they
You could also grease the wheels of the economy. Let them spend more.
Yeah, I mean, I don't know. We can always hope. But more stocks that should be on your radar today, and we're talking about a couple of notes actually on IndiaMart Intermesh. Hiral is joining us for more on that. And Hiral, I thought this was very interesting because the numbers on the face of it look good. But both Nomura and Nuvama are very cautious on this company.
Absolutely. What's happened is on the back of the numbers, though you've seen a growth on a year-on-year basis, sequential basis, the numbers have been absolutely flat. Now, what Nuvama is pointing out is they have maintained a reduced, but they've reduced the target price to a 1,970 from a 2,500. And this is mainly on the back of a decline in paid subscribers. Now, the margins have been elevated, but this is on the back of a lower investment. Why the paid subscribers have reduced? Now, this has happened for the first time since COVID, and that is why it's important now. There has been an elevation in terms of where the churn goes in the silver category, which is one of the premium categories, despite the kind of efforts that the company has been making to increase and bump up the subscriber base in this category in the last 6 quarters. What they've indicated is that they're yet to see any meaningful sign of improving subscriber retention. Now, till the time the subscribers do not retain, they're not able to retain them, you will see this kind of a downtick with regards to where IndiaMart Nivesh goes. That is what Nuvama is indicating. Secondly, you have a Nomura. They've downgraded it also to a reduce from a neutral, and their target price has been cut to 1,900 from a 3,150. So that's a big cut coming in on this one. Secondly, what they were saying is that they actually did not actually expect a decline in terms of the paying subscriber base, which has happened now. Secondly, the low gross additions, that has been with sticky high customers, and that churn is actually weighing in now. Secondly, the weak gross customer addition with sticky elevated customer churn is concerning, and they've cut their FY25 to 27 PAT estimates by almost 4 to 13%. So the crucial problem over here, Tamanna and Alex, is the churn that's happening. They are not able to retain subscribers in the premium categories, and they've been actually investing to get this number higher, which is not really paying results. And I think that's the reason why brokerages have now given up and reduced the target price and downgraded the stock.
Okay, so which is why IndiaMart under pressure. Thank you for that, Hiral. All right, Sudeep Shah with us this morning. He is Deputy Vice President, Head Tech and Derivatives Research, SBI Cap Securities. Mayuresh Joshi is joining us, Head of Research at Market Smith India. A very good morning to both of you, and great to have you here as always. Sudeep, so this is like peti kaske bandh lijiye when you look at what the Nifty has done yesterday. You have to be completely ready. I'm sure you have your own theory on what we saw yesterday. It was quite insane, to be honest, and we'll pull up the intraday chart for anyone who's missed what we're talking about, the kind of gyrations that we saw. But what is your outlook for today on the indices?
Good morning, Tamanna. I truly resonate with the Hindi proverb that you have just used, peti kaske bandh lijiye. And actually, you hear
on flights. That's what you hear on flights, because when the air hostess comes and tells you to prepare for turbulence.
The turbulence was even more like unbearable. Even if you are in a flight condition here, even the smartest of traders yesterday would have made losses. I can just tell you one thing. Before a minute that you can think that where could be the next move, the indices have moved 100, 200 points. So execution as well as cutting your trades, whether in profits, whether in losses, that was the biggest issue yesterday. And I feel we are in for this kind of volatility for the next 7 to 10 sessions now ahead of the budget. So this could just be a trailer. We could see this kind of movements in the next 5 to 7 days. And that is the reason while we share our index views, Nifty views on our views on the stocks, but it is important for us to even educate the viewers that these are the days when you need to trade with low quantity, have stop losses in place, and only trade when there is a high conviction, just not for the sake of trading. So just be a bit cautious. And now coming to Nifty, yesterday's one candle just from the highs of 23,350 now to 23,000 almost, that engulfed the previous 6 candles moves. Now even on 13 Jan the indices were headed lower, closer to 23,050. The lows were made. Then we attempted a slight pullback up to 23,400, but this entire pullback of last 6-7 days got negated yesterday. So that reinforces the strength of the downtrend. And I feel the next few days it's better to reduce the leverage in trading, just be a bit cautious going into the budget. Let this 4, 5, 6 sessions go by and reevaluate your trades post the budget. Because the kind of momentum that the markets have displayed yesterday, there is a likelihood that the downtrend could get extended. And the next support that we are seeing on Nifty, the first support is at 22,800, followed by 22,550, 22,600, and that could be a likely scenario. On the upside, 23,300, 23,350 zone now would be the first level that we need to watch out for. We need at least 2 to 3 closes above this level for us to presume that yes, the downtrend is getting over and we could enter into a phase of consolidation with some kind of a positive bias.
Okay, and all right, so that is good, cautious, I would say, advice there. What about stocks, Sudeep?
One stock that is there on my radar, that is Shyam Metallics. Now, this stock had seen a good move from May 2024, right from 600 levels to 950, 960 levels in September 2024. Thereafter, it slid into a period of consolidation, retested important support zones from a Fibonacci perspective, closer to 750, 760. And in the last few days, we have seen a decent up move in this stock, which is against the market. Now, that is the reason we feel that the relative strength is higher over here. And it has even closed above its important swing resistance, which was around 800, 805 levels. So we feel with a downward sloping trendline breakout, which is visible, the stock could head up to 850, 860 levels. And the stop loss on the downside could be placed around 800 levels. But still, I would still repeat once again that just don't go into all these names with say high leverage. Normal trading quantities should be sufficient.
Mayuresh, hi, good morning. A lot of stocks, particularly large caps, we saw yesterday being sold with high delivery. And I'm just curious about what you think about where we are right now, right? You saw so much volatility in trade yesterday, and the tendency even for long-term investors, Sudeep already pointed out the tendency of the short-term trader or the losses that they would have incurred yesterday. But the tendency of the long-term investor is to try and catch that bottom. Where would you find some of these bottoms? Is there anything that you saw in trade that reflected that? Because all of the earnings we've seen overnight, you've seen more or less all of them have margin contraction and weak earnings.
Morning, Alex. And just to complete what Tamanna said, right? कुर्सी की पेटी बांध लीजिए, मौसम बिगड़ने वाला है. So I'll complete that complete sentence for you. I think the market volatility is here to stay, and there are various numerous reasons for the same, right? I think we've been talking ad nauseam about that. Earnings are expected to be soft. They are turning out to be soft. So I'll not be surprised if you get downgrades at the end of this earnings season. And Q4 also largely might be a periodicity of consolidation as far as a large part of the markets are concerned. And therefore, I think the base factor as far as earnings are concerned is the weak link for the markets itself. Now, couple that up with what is expected on the geopolitical front. You've seen in Trump's inauguration address and the executive orders that he's been signing off. There are inherent signs that he is going to look at the US economy internally very, very strongly. And therefore, what kind of an effect does this have in terms of global economies, emerging economies in particular, and the currencies thereof, which might also propel some element in terms of inflationary aspects reflected through the bond yield. So I think it's an entire quagmire of events that is expected to take place. Our take, Alex, to answer your question, we are very, very cautious. We have been very, very cautious over the past few weeks. Valuations expensive. They are still very, very expensive if earnings start coming off. And in that context, if your annualized EPS estimates start going down, you cannot have a re-rating in terms of price earnings multiples for a lot of sectors and a lot of stocks within those sectors itself. And markets with India, again, I think if leadership stocks start breaking down, that is an ominous sign as well, because that gives you an indication to a large extent that the market probably is not probably at the right juncture in terms of going out there and buying aggressively in these markets. Do you start nibbling into these markets again, very, very selective in terms of our sectors. What is probably getting thrown up on Pandry, our institutional software, are sectors like hospitals, to a certain extent, certain agrochemical stocks, and certain pharma stocks. I think outside this sphere, I think very few stocks are showing strength at this juncture.
Okay, so while we're talking about, okay, we have to, I'll hold off on that question because I've completely forgot. I was caught up in what you were saying and I wanted to ask you another question, but I realized that we have to go to another piece. I'll come back to you on that one. We have an interesting note that has come through on Citi. They've maintained a buy on IOC, BPCL and HPCL, and they've said that earnings improvement is likely to take place both in Q3 and Q4. This, remember, is ahead of the BPCL numbers that are coming through later today. Mika joining in with what they're saying. Mika?
Yeah, so what Citi is saying that the OMCs are right now showing an opportunity to buy on dips. They do have a positive outlook for the stocks. They maintain a buy on all the three counters. IOCL target price at 190, BPCL target price at 390, and HPCL target price at 450, which provides a 22 to 45% upside depending on the previous close. They do expect strong numbers in terms of Q3 for IOCL, BPCL, and HPCL in Q3 as well as Q4. While there are some positive or while there are some headwinds for the space for Q4, the Citi is saying that the inventory gains and the LPG compensation expected is set to offset all the negative factors in Q4, and now they're seeing a buying opportunity in the three counters due to the recent 5 to 10% correction. Also, the companies have underperformed versus their upstream peer, which is ONGC. So yeah, it's a buying opportunity on dips is what Citi is saying.
Okay. Thanks, Mika, for getting us those details. We have to slip into a very quick break. We'll be back on the other side and we more or less be able to set you up just as the market starts. So do stay tuned for that.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about three key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold into the mutual fund industry over the past couple of years will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate on what
Welcome back. We're just waiting for the first pre-open race to hit, but Chandan Taparia with us this morning, Head Technical and Derivatives Research at Motilal Oswal. Chandan, very good morning to you. You know, we were just talking about the volatility in yesterday's trade and what the outlook is for today. But since we're so close to open, let me just get your view very quickly on indices.
Good morning. Thanks for having me. Yes, we have seen a roller coaster ride, but ultimately the bounces are being sold. The structure of the index is negative. It has wiped out the conservative move of last 6 trading sessions. Looking at InduSInd Bank, structure is in conservative mode from last couple of weeks or couple of days. As of now, we are in no trade zone. 935 is the major support, 1000 is major hurdle, and it got stuck in a range. So let it give a decisive breakout below 935 or above 985, then only we'll get the trade trigger in the counter.
Okay. Chandan, I know this is going to be a difficult question, but any picks that you would have heading into trade today?
Yeah, advanced decline ratio of the market is slightly negative, and we have seen that meaningful bounce were being sold, but we have mix of buy and sell to deal the market swings. So on buy side, we have Tata Consumer. After a long time, the stock is finding some buying interest, holding well above 970 zone, forming a positive price pattern on the daily and the weekly chart. So looking for an upside, one can buy on a small dip with support of 950, and Tata Consumer can head towards 1010 kind of level. One sell idea, there is sell on Voltas. Stock has been making lower top, lower bottom. Just a couple of days back, it gave a major breakdown, and still the follow-up selling is intact in the counter. So with hurdle of 1535, one can sell Voltas for the downside target towards 1444.
Okay. Thank you for that, Chandan. I'm just going to ask you to hold for a bit, even as we see the first rates hitting in, because we're speaking with Mr. Warren Harris this morning, MD and CEO of Tata Technologies. Mr. Harris, great to chat with you again. And thank you for your time this morning. Just looking at your quarter numbers for the December quarter, there is a small decline in net profit, but there is a sequential rise that I can see. Your margins have also been a little muted. How would you describe this quarter?
Well, we think we had a resilient quarter. The third quarter is always soft because of festivals and holidays. And we also rolled out our salary increments at the beginning of October. So to squeeze out 1.7% constant currency growth and to resist the 150 basis point impact of the salary hikes, we think we have performed relatively well in the face of challenging economic circumstances. So I'm relatively pleased with how we ended the calendar year, and I think it really sets us up for a strong finish towards the end of the fiscal year, and continued momentum as we move into the new fiscal year in April.
Okay, no, so let me just come back to the point of the 150 basis points hit because of salary increases. Of course, you don't see that impacting you next quarter. So where do you see margins, for example, stabilizing?
Well, we've positioned consistently that our North Star is 20%, and this year, I think because of the policy uncertainty in and around the automotive industry, growth has been a challenge for the entire industry. But we think now that the administration change is confirmed in the United States, and we are getting wind of the fact that the regulator in Europe is going to provide clarity in the short term. And so we think our customers are going to return to investment in new product, and we think that will provide tailwinds as we prepare for the new fiscal year.
Warren, can you take us through the deals that you've just signed? There are 4 large deals that were signed in the third quarter, and also give us a sense of what the pipeline looks like. What is the possibility of signing more deals in the fourth quarter? You mentioned that third is usually a little quiet and soft.
Yeah, we were very pleased with deal signings. You know, we closed 4 large deals. You know, one was with a European premium automotive OEM. They're launching a new electric vehicle, and we've won the responsibility for doing the test and validation of that particular product before it's launched. we secured the responsibility for the setting up of an offshore development center here in India for, again, another European company. And then we won an embedded and a software deal for a automotive technology company who provide solutions for various types of propulsion system and emissions system. And here in India, we won a large education deal with the government of Tripur. And so I think the signings demonstrate that despite the economic headwinds, we continue to execute against our agenda and continue to build out the order book that gives us confidence in terms of the future. One other significant event for us in Q3 was that we began operations of the BMW Tata Technologies joint venture. We started with 100 people. We're scaling that organization very rapidly, and at the EBIT and other income level, we were able to consolidate the contribution from that JV. And certainly, we expect at a PBT and a PAT level going forward, the contribution from that joint venture will be material.
Warren, you mentioned earlier in this interview that the uncertainty policy uncertainty in the US specifically has seen an impact on this quarter, and with the clarity in regime change, etc., and policy, things should be better. I want to ask you, how do you see that quantifiably impacting you? Because the broad outlook of the new regime seems to be not too interested in electric vehicles. They want to end that mandate. Just give us a sense of what it really means for you, contribution of business from this geography, etc.
Yeah, I think because of the polarized policy positions of the Republicans and the Democrats, I think the lack of clarity up until November has really prompted most automotive and I think most manufacturing companies to resist major commitments in new product. I think now that there's clarity as far as the White House is concerned, whether you like the clarity or not, I think there is a basis on which the OEMs and the supply chain will now invest. What it will probably mean is that there will be a commitment to a much more balanced portfolio of propulsion systems. But for Tata Technologies, that really plays into our strengths, because not only do we have capabilities, very strong capabilities in EV, but we can also provide support for plug-in hybrid systems, and also continue to work with our customers to help them optimize and improve legacy internal combustion engines. So for us, as far as propulsion is concerned, we're relatively agnostic. But what we're excited about is that there is now a basis on which our customers can make decisions.
We'd love to have a longer chat with you, Warren, but we're very close to market open, so I will have to end it here. But thank you so much for joining us, and hope to speak with you soon. Tata Tech there. I want to see what Tata Tech is doing pre-open as well, because pre-open rates have now hit. And the stock 1% down, no surprises there. But the rest of the market not looking too bad, I would say, at least in the pre-open session after the kind of volatility we've seen in the last few days. Chandan, I want to come to you very quickly, and let's talk about one specific stock. I want to talk about Dixon, because after the kind of pummeling that Dixon got yesterday, do you think that there is, sort of a relief rally?
The structure of Dixon is now changing. I clearly follow one simple price behavior in Dixon, that is technically the 50-day exponential moving averages. From last 240 days, it was holding well to that. And first time it gave the breakdown on 9th of Jan, then witnessed recovery and again getting surrender below 50-day exponential moving average. So now I believe it would be very tough. I can take a couple of names which were following same kind of behavior, including Bajaj Auto or stock like Divis Lab. They were holding well above 50 DEMA, and once that level got broken, stock drifted lower. So I'll be now cautious in Dixon. However, major trend is positive, but we cannot ignore the short-term change in the price setup. As of now, till it holds below 15,800 zone, bounce could be sold, and major target for the downside comes at 14,000 to 13,700 on the positional point of view. All
right, big brokerage call, and on a stock that is already moving, PNB Housing. PNB Housing showing some sharp and smart moves in the pre-open session, and Harsh is joining us on why Morgan Stanley is so bullish on the stock.
69% upside. I mean, I had to read that twice. 1520 being the target price that Morgan Stanley has given on this one. In terms of the numbers first, they believe all numbers were on track. Strong loan growth. Affordable housing finance book just sub 4,000 crore. Again, very strong growth there off a low base, of course. The emerging loan business also doing very, very well for itself. 13,200 crore is the size of that book now. Borrowing costs have moderated and moderated quite sharply when you look at it even on a YOY basis. The moderation is decent. And the higher bad loan recoveries are roughly at 53 odd crore. The credit cost is within the guided range of around 0.2%, which is 20 basis points. In terms of commentary, also very constructive is how Morgan Stanley sees it. Encouraging commentary. They've maintained their 1 lakh crore rupee loan book guidance by FY27. The affordable housing finance book likely to reach 5,000 crore by FY25 itself. That growth clip is very strong, reiterates that. They also talk about growth delivered despite challenges. You had certain states where there were challenges. We heard that from other housing financiers as well, and this one therefore stands out. Higher recoveries has driven the beat with regard to the numbers as well, and asset quality is improving in an environment where otherwise there are asset quality challenges. Valuations look reasonable. 1.2
I need to get a quick view. I need 4 minutes to open. I need to get a quick view, and I want to come to Mayuresh on PNB Housing. Let me add, Mayuresh, if you quickly can, some of the insurance players. ICICI Prudential, let's start from there, and PNB Housing.
Also, the insurance players probably are reporting better set of numbers because as there is a reasonable amount of maturity coming through their product mix, the kind of commission and upfront expenses that were front-loaded for the past 4 quarters since the budgetary changes were announced, there is some element of sanity coming through in the VNB margins. And therefore, I think as this trickles down in terms of expectations of growth in the embedded value itself, there might be some element of earning stability expected for insurance players. For PNB Housing, apart from what Harsh said, I think the NIMs have remained extremely stable. So for the first half, they are close to 3.67 odd percent. In fact, for the quarter gone by, they've shown an improvement quarter on quarter in NIMs, where I think a lot of BFSI companies are actually showing some element of compression on NIMs. As far as their construct is concerned, the corporate borrowings or corporate lendings are almost nil. And therefore, I think the entire retail-centric balance sheet that PNB probably carries at this juncture, with asset quality pressures coming out, GNP has shown a declining trend quarter on quarter, 1.21% against 1.27%. Net NPA is stable. And therefore, I think the emerging segment, which is expected to grow significantly, and where the management feels that they have significant credit underwriting controls on this part of the book, makes us believe that the book value that PNB probably has at 675 rupees. Valuation is not expensive.
Mayuresh, sorry, just 2 minutes to go, which is why I want a quick technical view on PNB Housing. Chandan, I'm going to come to you. And if you have a view on Zomato.
Yeah, to start with PNB Housing, stock witnessed some recovery even after the market pressure. In fact, on weekly chart, it is bottoming out and getting an early sign of some up move by surpassing its falling supply trend line. So I believe some positive could be there. Yesterday, drifted lower, but managed to hold the key support zone. So based on the previous day closing, with support of 885, we may see an upside move towards 950, 970 in PNB. Talking about Zomato, I believe some more weakness could be there. Major breakdown is visible below 235, 230 zone. So as of now, it can dip down towards 195 with hurdle of 215. So till it holds below 215, look for some more profit booking in the counter.
Okay. Sudeep, coming back to you, you've given us your picks as well, but I'm just wondering whether you've seen anything since 907 and just before the start of trade that indicates something that will move and any opportunities that you're seeing?
I feel we should let the markets open, let it settle for the first 10-15 minutes. And that's it, because right now, even if there's any kind of an opportunity, we need to see whether that gets sold into in the first 5 to 10 minutes with the kind of momentum that have been there in the mid cap and the large caps in the last 2 days. So I'll prefer to wait and watch for the first 5 to 10 minutes and then take a call accordingly.
Chandan, same with you?
So I would totally agree with the same. The only problem is that bounces are being sold. Until market doesn't surpass 23,200 or 23,333, we need to deal with the same. So fasten your seat belt and be habitual for such kind of swing, because India VIX is at 17 marks. In the next couple of days, the focus will be on the budget. So we have to be light. We have to be very specific and selective in this market scenario. On downside, making support goes at 22,800.
Yeah, seat belt firmly on. Chandan, that's, I think, the dialogue of the morning. Seat belt firmly on, fastened and ready, because 20 seconds to go for session to open. Now, the question really is, are you going to see some amount of bounce back in the most beaten down counters from yesterday? And Dixon is one that I would definitely add in it, even a Suntec. Suntec in pre-open looking decent after falling dramatically from its highs yesterday. But nevertheless, first rates coming in, and exactly what the implied had indicated in terms of an opening at the 23,000 mark, holding on over there. So that's a bit of a relief. Question is, will it restrain or retain at these levels? And this is the problem coming in, that retention power of the market has been dipping in that sense. IT stocks looking good this morning, about 230 points up. Is there some, hope of the big AI spends in the US helping IT companies? Maybe that's what's happening. VIX still at 17 and, not sharply up, but VIX is another point that we should look at. I'm going to quickly pull up the sectoral heat map before I get to the Nifty heat map, if I can, because let's just give you a broader picture right now on what's working. Look at the defensive play in action. Nifty Pharma nearly 1% up, but more red. Even Stevens on red and green, but nothing moving too massively. Pharma, healthcare, IT in focus. FMCG maybe ahead of the HUL numbers. What's falling? Nifty Realty has been having a tough time, and that continues. I'll pull up the Nifty heat map for you for a second, and then let's just see what is happening there before we have Alex come over. On the winning side, Sun Pharma. We told you it's a day about pharma. Infosys not doing badly at all. Some recovery there. Britannia ahead of the HUL numbers also. Britannia's okay. Some pop of green in IT, and maybe, like I said, it's that AI boost hope which is coming in. HUL also not half bad ahead of its numbers, but all range bound. On the losing side, BPCL ahead of numbers today, and that could be one reason. ONGC feeling the heat, and metals also not doing too well. Hindalco, Tata Steel a little dismal this morning. So not too much action here, range bound, but I think not too much action is okay for today, looking at how the markets have been.
Certainly.
I think stock specific is the name of the game.
Yeah, in fact, let's pull up the broader markets also and look where they are right now, just to set the context before we head into that. A little more weakness in the broader market, so 0.5% decline for the mid-cap index, and about 0.75% for the small cap index. So the breadth continues to be a little weak at the start. Let's see how that pans out through the trade, because you've seen quite a sharp gyration through the day yesterday. Don't count on this being where we stay through the rest of the session. But let's talk about a few of the individual stocks that we should focus on at the start. And it's all about earnings today, because so many stocks reacting very sharply to earnings. Let's pick the bigger one first. ICICI Pru losing as much as 6% in trade at the start. And why? Well, because the feeling is that the mix that has come in the quarter gone by tending towards ULIPs, and that has had a bearing on margins, and not too much is being seen in terms of the value of new business growth, and so that's weighing on the stock at the start. Dalmia Bharat, another set of weak numbers. It is not under too much pressure at the start. Let's see how that pans out. KEI Industries losing ground, and it was a thumbs down from our end as well. It's down about 1% or so. Cyient DLM, it had a miss on the margin front and on the profit front, and as a result of which it's taking quite a battering in trade today. Tanla Platforms, another one that's facing a little bit of pressure on the back of earnings. It's recovered from the low point of the day already, but down about 2% or so. Tata Tech, we spoke with the management not too long back. It is in fact, let's pull that up. Tata Tech under a little bit of pressure at the start, 2.6% or so. And IndiaMart Intermesh, this is something that we thought, at least on the face of it, the numbers look good, but then look a little bit further into the details and that note that came through that spoke about client addition and the loss, in fact, of clients, where you're seeing a decline of as much as 8.8% at the start. PNB Housing, the one that stood out to me, it was gaining at the start, but it is in fact down from the high point of the day, but gaining about 1.75% or thereabouts and holding out. So it's going to take a lot, Tamanna, for the good news also to be cheered as much as it was even 3 months back.
Yeah, and in fact, outsized reaction to bad numbers. I wouldn't say outsized in the case of an IndiaMart, and we called it for you. If you watched our show right on top and in our setup as well, we told you that IndiaMart is going to be in trouble. But I just want to point out what's happening with the realty pack, because Nifty Realty not only down in the red, but so is Oberoi Realty, about 5% down. Prestige, Macrotech, that whole host of companies really hurting. So is Suntech. Chandan, obviously your top call or anything that you've spotted in the first few minutes of opening, and the call on realty and specifically Oberoi. You're on mute, Chandan.
So like two trade identified, that was Tata Consumer on the buy side and Voltas on the sell side. But let's talk about the real estate counter. Oberoi Realty looks weak. It started to form lower top, lower bottom. The structure has gone totally on the downside. In fact, the Nifty Realty Index has given a breakdown of the multiple months. So I believe some more profit booking could be seen here. As of now, till it holds below 1820, this counter can dip down to a 1710, 1720 marks.
Okay. Based on the reaction in Oberoi as well today, it's down 5%. Mayuresh, didn't get a chance to ask you about this, but this is a stock that got beaten down yesterday as well. And I was reading a note that spoke about the weight of expectations that is playing out. The other thing, of course, is that some of these stocks had run up till mid-December, I think, and then they've come off a little bit. But is it only the earnings, and is it the pre-sales number that came a little bit weaker than was anticipated, or is it a valuation mismatch?
Factors, Alex, very frankly. And therefore, I think the run-up has been very, very sharp for most counters within the realty space. I think Oberoi and DLF have been outperformers within this space itself. And therefore, if you probably look at how the numbers have played out and how valuations are stacked up, they're also in late stage base category as we see it in markets with India as well. And therefore, I think any sort of earnings disappointment, one will expect such kind of sharp reactions to probably come through. Not just for the reality pack, I think for the market as a whole. And therefore, I think the real estate pack itself in terms of pre-sales velocity, I think it is now stabilizing to a large extent. One cannot really expect a compounding growth that keeps on continuing for the next few quarters and on an annualized basis as well. Obviously, the companies are executing well. They're getting into an asset-light model, most elements within the space itself. But again, I think the expectation burden a little bit too much as far as the reality pack is concerned. And if it misses even a tad bit, I think you're going to see sharp reactions on the downside.
Chandan, thank you so much for joining us. I know you have to run. So thank you for your inputs there. But I want to come to Sudeep on, the kind of moves that we are seeing this morning. Sudeep, just on the index, and I want to come to you on the index because both you and Chandan said, let the markets open and then we'll see. Nifty at least holding up about 60 points up, above the 23,000 mark. Is that giving you some relief?
Tamanna, I guess if you look at the Nifty, it will be a wrong signal now. Nifty might be up 50, 60 points, couple of stocks holding them, but the carnage which was happening there in the mid-cap space is still happening today. Also, you're seeing a lot of mid-caps slipping 2, 3, 4% in the first 7 to 8 minutes of the trade. So I feel it's important that we look at the broader markets. Nifty is just being held up by a couple of stocks, but yes, the larger trend, the larger mood of the market seems to be headed on the downside.
Okay, just talking a bit about some movers on the positive side. I'm seeing United Spirits moving because they've had a resolution with the government and in Andhra Pradesh, and which is why maybe that movement continues into today. Some interesting moves in IT. I don't know if they'll sustain. And Infosys about 1.5%. Sudeep, your views on IT? Is there a short-term play here? Is IT one of the plays in town?
Tamanna, if you see Nifty anti index, it is sustaining at its lowest level in the last 1.5 to 2 months now, almost closer to 41,900. There was that gap down opening post Infosys numbers that we've seen on last week, and now what we're seeing is that that zone is now not able to get surpassed. So 42,500 will now act as a resistance. Till the time 42,500 does not cross, I don't see any major recovery into IT space. But yes, it won't be the cuts may not be sharper as it's being witnessed in other sectors. But this sector at the best could enter into a period of consolidation wherein the Nifty IT index may trade between 41,300, 41,400 on the downside and 42,500, 42,600 on the upside.
You know, Mayuresh, I just want to talk a bit about ICICI Pru, and yes, we called it as a thumbs down. It was on top of my stock watch list, but it's cracked about 9%. So has Nugent Soft, so has Persistent. I mean, Sudeep is absolutely right. In that entire mid-cap space, the meltdown has been pretty painful. Let me talk a bit to you about insurance, because I recall you earlier saying that you are quite positive on insurance overall.
No, I think I was just trying to make a point that they are trying to fix their product mix with the budgetary changes that have happened, Tamanna, over the last 4 to 6 quarters. And as this transition is taking place, you've seen incremental improvement that have probably happened, both in terms of recoupment of VNB margin, as seen in the case of HDFC Life to a certain extent, SBI Life as well. And therefore, I think the product mix is going to be extremely critical going forward. Again, ICICI Pru, as Alex pointed out, a large part of their skew is towards ULIPs. And that is where I think the pain point might actually continue going forward as well. And therefore, I think how they evolve their product mix is going to be very, very critical for all these insurance players. At the same time, keeping tab in terms of their overall costs, both marketing and the upfront commissions that they probably pay. ICICI Pru, HDFC Life, a large part of their upfront costs are close to 20-21%. SBI Life is close to higher single or mid-single digits. And that is where the differentiating factor might actually turn out in terms of consistency posted in VNB margins. If there is no recovery in VNB margins or consistent performance thereof, the embedded value for a lot of these players are going to remain stagnated, and therefore a re-rating in terms of expectations of improvement in embedded values might be a little bit, it might actually happen with a lag effect. And therefore, I think we'll have to be very, very selective within this space. But again, I think HDFC Life, hardly any move that they've done over the last 5-6 years. ICICI Pru, again, a slam dunk in terms of how the product mix played on numbers. SBI Life, better placed, but again, I think the entire construct in terms of price damage that the market is showing is probably getting reflected on SBI Life as well. So I think SBI Life is top of the stack as far as insurance players.
Okay, very quick last question from my side, Mayuresh, and this is going to have to be a quick answer. Kalyan Jewellers is down another 3.5% today, and the brief respite that it had, I think a couple of sessions back, proved to be just that. We've not been able to see anything untoward with this company. We've asked around, are you covering this, and what explains the kind of drawdowns that we've seen?
So, Alex, I think multitude of news, rumor mills, whatever you call it on social media, etc. Right from IT raids to the pledge of the promoters to whether the promoters are buying helicopters. Is there some issue in terms of their overall branch operations, both domestically and on the international scale as well? And all these issues are then pointing out to significant corporate governance lapses that might come. Now, whether it's true or not, I think only time will tell. But I think reaction is for a multitude of reasons that's probably happening.
All right, thank you so much, Mayuresh and Sudeep, for joining in today as we wrap the first leg of India Market Open. But a lot coming up. Stay tuned, because right now we're going to put the spotlight on a sector we were just talking to Mayuresh about, which is insurance. Raghavesh from JM Financial is joining us on this to discuss it, and it becomes crucial because look at what's happening with ICICI Pru this morning, and that fear continues. Harsh joining us first to highlight key trends that we're seeing in this pack.
Well, first off, Tamanna, returns have not been great here. Since budget of 2023, since the introduction of taxation provisions with regard to life insurance products, certain ones, you've seen life insurers under pressure, and they've constantly been under pressure. The kind of stock movement has been very, very range bound. And that's also led to some shift with regard to product mix, some changes in terms of regulation, including the surrender value regulations, where there was large amounts of overhang. Would be curious to know whether some of those overhangs have actually gone away, or do they continue to sustain, and whether now over the next 2 to 3 years the growth runway is cleaner, both with regard to profitability, which is your value of new business as you quantify it in insurance and life insurance terms, as well as with regard to top line. Can you continue to do that? There's also some bit of overhang with regard to possible restrictions with regard to the banking channel distribution. Whether that will come or not, it has been a big concern. So some of these, and who will adapt the best, and whether valuations actually look decent now, given the kind of flat line that some of these stocks have moved at, is something I'd be curious to know.
Okay, some key questions to actually put forward to Raghvesh, who's joining us. Raghvesh is Insurance and AMC Research Analyst at JM Financial. Raghvesh, great to have you on the show, and very good morning. Thank you for your time here on NDTV Profit. All
Good
right,
morning, and thanks for having me.
Sure. Let me start with an overview before we get to the specifics, and of course we'll speak about ICICI Pru, which is getting a hammering today. It seems like a choice between the devil and the deep sea. And I say this because insurance companies, after regulatory changes, etc., and because of demand, want to sell a product that gives them lower margins. And that pain will continue for some time, isn't it?
If we move back to, say, a couple of years, FY 22, the budget imposed taxation on ULIPs. At that time, the concern was the ULIP, which is a good 30-40% of the business for them, that tapers off and the growth for the sector comes off. Now, what happens today is we are saying that ULIP mix is rising, so the margins are coming off. See, the industry has adapted over the last 3-4 years, as they have adapted over the last decade. There are some changes which are happening in terms of the VNB margins coming off with a higher ULIP mix. However, I would not look at that as a negative. See, ULIP is a shorter term product as compared to, say, a participatory product or a non-par. So the margins which we are talking about comes from, say, a 10-year period compared to a 20-year period or a 25-year period for a traditional product. After 10 years, the customer is back to you. You can sell him another product. So actually, the sustained value for the business is generating over a period of time does not reduce. So while we may see margin pressure here and there, over the period of time, as long as they're able to sell the products, as long as there's a demand for the products that these guys are selling, we see a sustained growth. I mean, these guys have consistently shown a 14-15% growth, 2-3% above the nominal GDP, have largely maintained the share of customer wallet in terms of the share of financial assets that are going into insurance funds. And we look, and at this point, we see consistent 15-16% growth for the private sector going ahead.
So Raghvesh, are you saying that from here on as well, when you're looking at an insurance sector, avoid looking at the margins, because the margin trend will be skewed and they will continue to focus on achieving sales?
See, the absolute value which a business is generating is in terms of the value of new business. In life insurance, we use this compared to a PAT metric because a lot of the value occurs over the period of time. Say a typical product for them is, say, a 25-year product, a traditional product. While we keep saying that the margins have come off, if you look at the growth numbers in terms of VNB, it's pretty decent at around 14% for HDFC Life, high single digits for some of the other peers that have come in. So as long as the VNB is growing, there is another part of the book, which is the value of the in-force business, which is all the policies that have already been sold, and they bring an investment income to the embedded value. We see a sustained 15 to 16% growth in terms of embedded value for the wider ecosystem. For the leading players, we are seeing anywhere from 17 to 18% growth in embedded value, and that translates into stock market performance going forward.
Just on, let me come to you on ICICI Pru, Raghvesh, because I think that is top of mind today in terms of the extent of crack. The pain point when you see the key metrics is that sequentially their margins have come down, and that was expected because you're changing the product mix. Do you see it as such a big negative? Just want to know your assessment of the numbers.
So thinking about some of the results which have come in the insurance sector, across the board, we have seen ULIP share rise through the year. In fact, starting from FY24, the ULIP share has risen. For some of the players like say an HDFC Life, the share of ULIPs in the savings business has come off coming into 3Q. And that will play out for all the players with a lag of a quarter here and there. It also depends on the channel mix, which channels are selling which products more aggressively, or where the demand is there for these products. We can also take a view on the equity markets that with the SIP inflows coming in, maybe that is a reflection of how much a natural demand is there for the ULIPs. But again, as I mentioned earlier, ULIPs keep the customer engaged. There is a change in the NAV of the product so that customer is constantly in touch with the insurer. You sell a ULIP today for say 10 years to a 40-year-old customer. You sell another ULIP after 10 years. At 60, comes back to you for an annuity product. And you're able to keep the customer engaged, not just to the insurer, but even to the wider ecosystem if you are part of a bank group or an insurer-led group.
So Raghvesh, when you talk about ULIP heavy, specifically for ICICI, right, that's been the case. Now, if the growth challenges persist, and if the natural demand for this product comes off, will it be ICICI which will be beaten heavily as compared to a HDFC Life and a SBI Life? Because that's the nature of the products that ICICI has been selling.
See, the products have evolved over time. Like HDFC Life, a couple of years back when they were selling, they were very specific about the share of ULIPs in their mix, because they were not able to generate the margins and hence their VNB growth used to suffer. Now, when they are able to, with a natural demand for more protection in terms of higher sum assured on the products, in addition to just the saving component, and a demand for, say, a health rider along with the ULIP product itself, the margins for that business has improved. And now we can see that in, say, an HDFC Life that their VNB margins at a blended level have improved. And I think that is what should play out for all the other insurers as well going forward.
So Raghvesh, what is the street taking negatively that the stock of ICICI Prudential is down to the tune of almost 10%? What are the markets reading negatively? Because valuations are not expensive as compared to peers as well. And with that, if you see in terms of the quarter, the numbers look pretty decent. So what are you reading?
See, when we look at the entire life insurance space, the overhang that we had a bit of concern around whether there will be a cap on banca, which you were discussing earlier, that was the key before coming into the results. Coming into the results, the commentary from the peer insurers has been that there's nothing specific on this and they expect banca business to grow in double digits going into FY26 and beyond. With that, the stock, that a lot of re-rating for the sector has already happened. Now, perhaps there is a concern that in the budget, we may have something negative for life insurance. Maybe people decide to wait for a quarter, but the fundamental value kind of stays intact for the life insurance sector. And when we are talking of 15-16% kind of a floor on the EV growth, the valuations have to catch up at some point.
So Raghvesh, when you mentioned that there is an anticipation there could be some negative announcement that could come in the budget, what is it that we should be watching out for?
See, there is no anticipation of a negative announcement in the budget as far as I have been hearing. What we expect from the budget is perhaps something along the GST cut, which has been in the news for some time. The products under life insurance and health insurance are liable to pay GST at rates of anywhere from 2.25% to 18%. If that comes off, it will be a positive for the sector.
Budget. That's a decision the GST Council will make. So
yes, but there is a discussion along those lines that it may come with the budget. Among other things, the income tax slabs, there is an expectation that there's something comes along a direct tax code, something about the new income tax regime getting better. However, over time, we have seen that around more than 70% plus people are already there on the new tax regime who do not get a benefit from saving through insurance products. And as a result, we have also seen that over time, the share of people buying insurance products in 4Q has reduced over time. So a number which used to be, say, 38% of the sales would come in 4Q has reduced to somewhere around a 32 to 34% number recently over a 6-7 year period. So I would not be very worried even if a direct tax code or the new tax regime is made more attractive to the individual taxpayer.
In a comparative situation, Raghvesh, and let's look at some of the peers there. We talked a bit about ICICI Pru. Let's look at SBI Life. I don't know if you look at a Go-Digit Insurance, because that has also been buzzing, and others in that space. How would you rank them? What would be the comparative overview that you can give us and your top pick there?
So in the insurance sector, broadly, we are very positive on the life insurance and the health insurance space. Both are essentially consumer-facing business, long runway for growth, have shown consistent growth over the years. We prefer the larger names because, as we were discussing, there have been concerns around how the caps around expenses of management, what they can pay out to the distributors, how that plays out. So my top picks would be the larger players within the insurance space, the private sector, someone like an HDFC Life, a Star Health, and SBI Life in that order.
One question I have, Raghvesh, is with regards to valuations in terms of the life insurance companies. Absolutely low right now versus if you look at the last 4 to 5 year average. The quarter has been decent. Clearly, the stocks have been beaten down. Taking this combination into consideration, do you think this is the best time for an investor to start allocating to insurance as a sector? And if so, I come back to Tamanna's question in terms of your pecking order, if you have to look at the topic.
Yes, I think it is a good time. A lot of the concerns which were there, I think much of the last year was spent discussing about how the surrender norms will play out. The companies which have reported, HDFC Life, which was expected to have a hit of up to 100% on their VNB margins, have come out saying that the maximum hit that they can see today is a 30 bp impact on VNB margins, which is very small. Somebody like an SBI Life, again, as we were discussing, higher ULIP share, hardly any impact of the surrender norms. So that has played out. I think that is what a lot of the street was waiting for. We spent much of the last year calculating how these numbers would play out. Now I think on the base of last year, the companies have delivered on growth. Like private sector for the 9 months has delivered somewhere around 19% growth. Even on a 2-year CAGR, it's around 16%. That should translate into VNB margins going forward as the product demand stabilizes, the product mix and the product bouquet for the players have actually evolved very well over the last couple of years. And from here, as we were discussing, around 16-17% growth in embedded value for the top players. And with consistency around the APE growth, VNB growth matching the APE growth number, and the embedded value growth slightly ahead of that, we see the consistency being rewarded by the markets. Again, to reiterate, top pick would be HDFC Life, followed by a Star Health, and then an SBI Life.
C Life, Star Health, and then SBI Life. All right, so that's what making. All right, thank you, Raghavesh, for joining us. I mean, clearly ICICI Pru is not in that list. 8.5% down right now. Markets overall, at least I would say, top line recovery from lows. So that's a positive on the Nifty. Even the mid cap, in terms of its lows, at least some recovery from there. Yes, there is a big crack in some stocks specifically, and marking out IndiaMart for this. 7% down now on the kind of results that we have seen. Even at Tanla platforms, poor numbers, Persistent Systems has cracked quite terribly, 6% down. And otherwise, IT is not doing too badly, but Persistent seeing a bit of pain. Newgen Soft, again, set of numbers that hasn't excited the street. Oberoi Realty, a whole host of brokerage notes there, which are not too excited about Oberoi Realty. But we talked about IndiaMart Intermesh in a world of pain, and Varsha's joining for more on this.
Thank you, Tamanna. Now, IndiaMart is under pressure mainly because of the brokerages giving a downgrade rating. Let us just look at the numbers. If you see, there was an uptick in revenue of 16%, while EBITDA was up 62%. Margins were at 39% versus 28%, and net profit was up almost 48%. But the highlighting point here is why the stock is under pressure, because if you see Nuvama has retained reduced lowest target price at 1,970. Now, company has reported a surprising decline in the paid subscribers, is what Nuvama is saying, and the margins have been elevated due to lower investment that the company has done. Nuvama expects yet to see any meaningful sign of improving subscriber retention, while Nomura has also downgraded to reduce from neutral earlier, and they've cut target price to 1,900 from rupees 3,150. They say that there has been unexpected decline in paying subscriber base, and low gross addition with sticky high customer churn will weigh on the collection growth that the company will see. And the weak gross customer addition with sticky elevated customer churn is the concerning according to Nomura, and they've cut FY25 to 27 PAT estimates by 4 to 13%. So overall, if you see, both the brokerages have downgraded the rating and have shared their concerns. This is why we are seeing the stock is under pressure.
Right. Thanks, Varsha, for getting us the details. So clearly, it's the subscriber base that is the key concern for IndiaMart, and that's what is putting pressure. Though there has been a slight recovery right now, we're seeing cuts of almost nearly 7% coming in there. But moving on, KEI Industries, that's a stock to focus on. They've reported numbers. Overall, if you see in terms of the revenues in line, there is a slight miss that's come in terms of where margins are concerned, as well as in terms of profitability. But first, let's head across to Anushi, my colleague, who will share as to what should be the key focus areas for a KEI Industries, and then we will be joined by the management as well. Anushi, over to you.
Hey Hiral, so KEI Industries is focused on the back of the Q3 numbers. Now they've recorded a 19.8% of an uptick in their revenue, which is majorly in line as to what the street was pegging. However, margins and net profit were a miss. Margins stood at 9.6% versus 10.4%. Margin miss led by majorly volatile commodities and muted government exports. So what is the management saying on margin front is something we should be tracking out for. What is another supporting factor though is the export outlook. Now in the first half we saw that the exports had recorded about a 15% of a decline, but now we are looking at a 5% of an uptick in terms of where the exports are concerned. So outlook on exports also, if we see further recovery happening in the upcoming quarters, is something we need to see. Now if you look at the segment revenue mix, institutional cables and wires recorded about 18.2% of a jump, while the dealer sales, that is in the cables and wires, saw about a 31% growth. So healthy growth there. The EPC projects, now the management wants to shift its focus from the EPC projects, so we are looking at a downtick of 59%, and stainless steel wires, so about a 17% of a growth. Order book stands at about 3,871 crore as of December 24 end versus 3,847 crore in the September 24 period, and net debt position stands at 150 crore in December 24 versus net debt position of 69 crore. So this is the overall picture that has built for KEI Industries in the third quarter, which has just gone by.
Okay, thank you for that, Anushi. Mr. Anil Gupta joining us. He's CMD at KEI Industries. Mr. Gupta, very good morning and thank you for your time here at NDTV Profit. We truly appreciate it. Let's talk a bit about your quarter. Inline revenues, I think margin miss and what's happening with EPC is what is a bit of concern. So let's get to that straight away.
Thank you very much. First of all, I talk about EPC. EPC business, we have for last 3 years back, we have given a guidance that we are gradually reducing this business because of longer working capital, and hence in line with that guidance, we are gradually reducing the business, and even our export, where we did 150 crore of EPC exports last year for our Gambia project. This year, that revenue is nearing negligible, maybe in 0, 10, 15 crore range. So actually in exports, we have grown in wires and cables by more than 20%. But due to EPC decline, the number is looking, less. So far as our margins are concerned, margins are, 0.5% down, mainly because of a lot of volatility in the commodity prices like copper and aluminium, and also the volatility in the forex like dollar, which affects all the commodities.
No, so just a couple of follow-ups there. Of course, your engineering, procurement and construction, that is your EPC segment. You said you want to reduce dependence on it, but it has come down quite sharply, nearly 60% this time round. It's also a higher margin segment. So I just want to understand, Mr. Gupta, is this drop that we've seen part of the plan or because of the circumstances? Is, if you're getting what I'm saying, is this because the business has not come in or you were aiming for this kind of a drop this quarter?
No, it is planned. We are aiming for, reduction. We have not taken new projects. We have not bidded for new projects. That is the reason it has come down. So it is a planned activity.
Important clarification. This is a planned activity as far as EPC is concerned. Let me then understand, do you see the pain from commodity cycle as well as dollar fluctuation, etc., now easing out?
See, nobody knows about the commodity. Nobody can predict the commodity prices or, exchange rates. So we have to live with it. But you can see that our margins are very marginally impacted due to these fluctuations, and we have maintained our, commodity procurement and commodity stocks. Vis-a-vis our orders very efficiently. So I think whatever is the degrowth of 0.5% in margins, we should be able to make it up in the full year.
Mr. Gupta, this is Hiral on this side. You mentioned about EPC completely being a planned activity. By which quarter will EPC be out of the P&L? That's number one. And two, will the C&W and the other aspects be able to take over the loss in terms of revenue that you will see out of this segment?
Our EPC revenues are hardly 400 crore, which is just 5% of our turnover. Secondly, we do not plan to completely exit. We will continue to maintain at 400 to 500 crores of business in EPC segment. And we are just taking one project maximum in a year to maintain our presence in this business. Although our focus is not there. So far as its impact on our total revenues are concerned, it will not be there because we are steadily increasing our wire and cable volumes and wire and cable businesses and capacities. So we will see a growth in our overall turnover in the coming quarters and the year.
When you mentioned about cables and wires as well, your revenues have seen a growth of around 26% on year-on-year, and sequentially it's a 10% growth. What has been the volume growth in this quarter for cables and wires?
Volume growth is approximately 17% in this quarter.
And what will your overall guidance be in terms of volume growth for the fourth quarter of FY25 as well?
our overall full year growth in volumes should be around 16 to 17%, which was initially guided in the beginning of the year. And value growth will depend on the pricing.
This is FY26. What will 26 and 27 look like then?
FY26 will be around in the same, but FY27 should see more than 20% volume growth, year after year, because by that time our new capacity will come up in production, and that will give us more leeway for improving our sales.
My last question coming to you is with regards to exports. Your C&W, that's cables and wires exports, have seen a growth of 31%, which is around 10% of your revenues currently. Was 10% in the third quarter of FY24 as well. How much do you think will that increase from here on, and will that be margin accretive?
It will definitely be margin accretive, and we should see a growth in export of wires and cables by around 30 to 35% from the last financial year. But as soon as our new capacities come up on board, this volume of exports will grow substantially, because we have developed a lot of new markets for our export products.
Okay, so exports will be a business that we will be watching out for pretty closely, and how margin accretive will be. But interesting is going to be the volume growth that we are expected to see in the coming quarter and in FY26 and 27. Thank you, Mr. Gupta, so much for joining us on the show and sharing the views. So that's the management of KEI Industries. Let's quickly pull up the stock and the scorecard, if you see from a long-term perspective as well today. Minor moves, 0.9% lower, but in the last probably 12 months, 28 to 29% is the kind of returns that we've seen on the counter. And what's interesting to watch out for is what's happened vis-a-vis Havells India. If you just pull up a Havells India as well, the consolidated revenues for KEI grew 20% versus a 7% that we saw in terms of Havells. Now, looking at both of this, if you see Havells, that is down almost 1.6% in trade. But let's quickly slip into a short break. On the other side, we'll speak to Ambit's Nitin Bhasin to talk about what next for the markets and what is his expectation from Budget 2025. Please stay tuned.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
I present the budget for a historic
With Budget 2025 right around the corner, there is one question on everyone's mind. Will this finally be the year salaried individuals get some much needed income tax relief? Let's dive into the story behind the tax slabs, the rising cost of living, and why economists are calling for reforms. First things first, Budget Day is set for 1st February 2025. expectations are sky high, especially among salaried individuals. But before we talk about predictions, let's rewind a bit. The first big moment for taxpayers was back in the Union Budget for FY 2020-21. That's when the government introduced an optional personal income tax regime with lower tax rates but fewer deductions. Remember that? It shook things up for taxpayers who had to choose between the old system with deductions or the new simplified one. Fast forward to 2023 budget, Finance Minister Nirmala Sitharaman made some tweaks to the new tax regime, expanding 2 income tax slabs and increasing the standard deduction from 50,000 to 75,000. Sounds promising, right? But here's the thing. It didn't touch the old regime at all. So what exactly is standard deduction and why does it matter so much? Think of it as a fixed amount you can subtract from your taxable salary. It's meant to help with everyday work-related expenses. While it's been raised over the years, the question is it enough to combat the rising costs we're all facing today? Did you know the standard deduction was actually scrapped back in 2005, but it made a comeback in 2018 at 40,000, and since then it has been climbing steadily. Now economists have a big ask for budget 2025. Cut income tax rate.
Welcome back. Markets holding steady at least. I think that's a bit of relief above the 23,100 mark at this point. IT looking decent, banks losing steam. I just want to pull up the intraday of the Bank Nifty before we go to our next piece that we are covering, the next stock that we're covering this morning. Yeah, Bank Nifty taking a bit of a tumble there. And weakness seeing there. Broader markets continuing to crack. I mean, look at the midcap, about 1.5% down, the midcap 100. And the 150 also nearly 1.5% down. So the pain in the broader markets definitely being seen there. Should we quickly look at the small cap before I go to our piece on Oberoi Realty? And yeah, look at that, 1.5%. So broader markets under pressure, those stocks under pressure, and one of them is Oberoi Realty. The stock has slid. Mixed reviews from brokerages is the key reason over there. But what are those brokerages saying? Why are we seeing about a 6% drop in Oberoi Realty? I know she's joining us for more.
Hey Tamanna, so I'll speak about what the brokerage are saying now. This is post the conference call which took place yesterday. Now we already saw the stock declining over 6 to 7% in trade today. This was because of the pre-sale estimates which were there in the 360 West project, which were higher, which came in lower than what the street had anticipated for. So Jefferies have maintained their hold rating, but they have cut the target price to 2030 now. They say that the Q3 was a miss on the burden of high expectations that we are seeing. But if you look at the pricing and the margin side, the focus was visible as the company is now choosing over higher realization in most projects. In fact, even in the con call, the company did mention that despite the price increases taking place, they are still taking a 20% of an increase in the prices, especially in projects like Thane, which is something that is really interesting what was mentioned over there. A couple of new projects are added in MMR as well, and bid for large Western Mumbai projects is being submitted. Now do note that the 6,000 crore fundraise had happened and the company plans to utilize to acquire large parcels for this. Antique also has a revised buy rating and they are seeing a target price of 2,593 with a 39% of an uptick. But they have revised their pre-sales estimates by seeing a 10%, 5% and an 11% of a downtick in FY25 to 27 period, but see strong cash visibility going forward. Citi has maintained a neutral call. This is with a target price of 2,415, 31% of an upside here as well. However, they maintain that the pre-sales which came were in line with expectation and the company continues to execute well, which is in the high residential operating margin. So margins are key focus going forward for the business as the company is choosing to operate in projects with higher margins. JP Morgan is an interesting one. They have in fact upgraded the rating to overweight from neutral. This is with a target price of 2,350 versus 1,760. With the main focus of margins for the next 2 years should benefit from luxury pricing and the late stage inventory ramp up, which is going to take place in the next 12 months or so, as indicated by the yesterday's con call. Also, a lot of interesting projects lined up in the next 12 to 18 months. So this is what the streets are saying. We are looking at some revision in terms of where the pre-sales estimates are, but margins is a supporting factor for the business going forward.
The margins are going to be the supporting factor for the business. Oberoi Realty taking a beating. In fact, real estate as a pack is down nearly 20% from its peak. So I think valuations is something that the street is reading, which probably are expensive. That's what we should be watching out for. But another stock that is down and about in trade is assigned DLM. I think across parameters, that stock is, under pressure. Stock has fallen 12%. In fact, trading at a 52-week low as well. Let me first head across to Varsha to understand as to what has gone wrong, because from its peak of 883, the stock is corrected by almost 40%, Varsha. Today, almost 12 to 13%. What are the factors which are not working for them? In fact, we'll be speaking to the management as well today. You'll have a lot of questions for them.
Yes, Hiral, absolutely. But the only good thing about the Q3 numbers were revenue, which did beat estimates. But if you see, margins and profits were down by one-time acquisition of Altec, which is a US-based company. But the concerning point here is their order book. If you see, order book excluding acquisition has fallen quarter on quarter, and over the past few quarters it has been falling down. So one thing is that if I were to talk about the EBITDA, so EBITDA saw one-time impact of rupees 8 crore due to the one-time expenses related to acquisition, and profit also saw one-time impact of rupees 5.9 crore post-tax, and this expense was led by acquisition of Altec. The other key highlights, their net working capital stood at 120 days versus 127 days, which was on a good side. 3 large deals are at advanced stages, and pipeline is in excess of $1 billion. Order book stands at almost 2,000 crores versus 1,900 crores quarter on quarter, but this order book is inclusive of the recent acquisition that they have done, and organic order books saw a decline on quarter basis, a key concerning point for the company. If I were to talk about the conference call highlights, so they've announced acquisition of Altec in the previous quarters, and political developments will actually present an opportunity for localized products production for the company, and large contracts that they signed last year are showing traction, and on-ground manufacturing in USA will help growth opportunity for the company. Now this is in terms of the acquisition that they did, and they're seeing a pipeline of $1 billion in terms of opportunities. And lastly, they do not need any kind of capex. They have huge capacity expansion that they've done.
All right, thank you for that, Varsha. Nevertheless, that stock is seeing massive pain today, 13% down now on Scient DLM. That space is really going to continue to take a beating. Now, this is very interesting note on Incred, and it's talking about, I would say, a space that has been top of mind for the markets. I'm talking about Zomato and Swiggy. Zomato again down 2% today, had suffered yesterday as well. Let me quickly pull up Swiggy, again down 3%. Now, Incred has done a comparison of both of them, and Mahima is joining us to recap this.
Interesting note, as you rightly mentioned. Before I move on to what they're saying exactly in the note, they've initiated ad rating for both Zomato and Swiggy, with Zomato with a target price of 270 and Swiggy with a target price of 540. They're saying that the monthly transaction user runway is still on a good runway, and they're saying that it's a blue sky scenario, suggesting a long-term runway going ahead. Now, in terms of large opportunity in food delivery, profitability will support in terms of expansion in quick commerce, and this scale and platform play with structural growth drivers in place. Now, quick commerce opportunity is large enough to accommodate several players again, but for them, they prefer a Zomato over a Swiggy, and cash cow food delivery could support quick commerce business growth going forward. So what they're saying is that they're penciling in growth of quick commerce, but going forward, food delivery could support quick commerce, but it will be a cash cow going forward. And advertising revenue and monetization could also aid the take rate for both of these companies. For Zomato, they've said that leadership in food delivery business, with better control over unit economics and potential EBITDA breakeven in Blinkit, could help offset the rising competitive intensity and capture share of incremental profit pool, which is why they're more bullish on Zomato. And they're saying that for Swiggy, early success of Bolt platform, improvement in food delivery execution, and doubling of the number of dark stores could help capture market share for them, and this could also give them incremental growth in terms of quick commerce. So very interesting note, and these are the couple of reasons as to why InCred is bullish on both Zomato as well as Swiggy.
Right, so that's with regards to Zomato and Swiggy. And what's interesting is, in spite of initiating coverage on both the counters with a buy rating, they still prefer a Zomato versus a Swiggy, and that's mainly on the back of the execution capabilities that InCred has been talking about. Though both the counters have been trading under pressure for a second consecutive session. Yesterday, the cuts were deeper. 10 to 12% was the kind of downtick that we saw on both these counters. But moving on, with just about 9 days left for the union budget, a lot of speculations are being made on the healthcare sector. My colleague Haripriya had a conversation with the people of Bangalore and asked them what are their expectations in the sector. Let's listen into what she has to say.
We are in one of Bengaluru's busiest area, Indiranagar, and we are speaking with people here to understand their budget expectations related to the healthcare sector. Ma'am, tell us, there's an upcoming budget coming up, so what are the expectations from the government? Where do you think there can be more improvements made?
As per the healthcare domain, what I generally feel is there should be more subsidized rates for, normal general public, you can keep one rate, but at least for specially abled, disabled people, there should be more subsidized rate is what I expect. And more infrastructural, changes should be made. I guess the budget is allotted, but I don't know on what level is it, being implemented and reached out to the general public. So, yeah.
This causes problems.
Yes, it does. It does cause a lot of problem, especially, if there was some, quicker methods, to get the treatment to the specially abled kids, it would be really helpful. Not only kids, the people who are specially abled, especially because I am here in front of an hospital. One of my cousin is inside. She is specially a disabled child. She doesn't have the patience to wait, right, to get the treatment. So I feel there should be some, sort of improvements on that part. Not people, most of them, they do not have the knowledge about what are the facilities that are, that these people can avail, right? And insurance claim is one more thing which I would like to emphasize for these kids, right? You need to produce so many documents, right? They have a specially abled kid card also is there, right? Isn't that enough to, get the insurance claimed and the bills are insufficient? I don't know. That process should be a little bit, faster and more transparency should be there. And that is what I feel.
What do you think the government can do better? Is there any problem in the implementations that you've seen?
One of the schemes, that is Ayushman Bharat Yojana, that has been implemented in 2018 to be precise. They say first to begin with the Ayushman Bharat Yojana card that is available or accessible to people. There is lack of awareness as to how to even make the card to begin with. Second thing is it says it covers 5 lakhs per family every year, irrespective of gender, age, and it's not only for senior citizens. But they say that there are so many empaneled hospitals. Step into any of the corporate hospitals in Bangalore, let's say public or private, they say that there's no funding that is available. And and there's no person to help as well. You step into the insurance desk, right, in any of the hospitals, they say sometimes they're not aware themselves that there is some scheme like this exists.
So they say the funding from the government has not come?
They say we are not aware of it, there is no funding that has come. That is especially like aided hospital or like a lower, for example, my parents are old, and when we were getting my father treated for oncology, none of them were aware of the schemes that was there. They said none of this exists. We can't help. If you have insurance, please step in. Otherwise, no. Corporate hospital is a corporate hospital at the end of the day. There's no specific person assigned at the desk to say this, from government or a third party to say there is this scheme that you can use for family. It's a family floater. But those things are not available. So I think
if it is implemented, if there are impaneled hospitals, the list should be available as to which area where we can go. There should be a point of contact that we can access, and the cards should be made easier, maybe in Bangalore one and things like that. More focus on that and more awareness on the scheme in itself would be helpful. ಏನು ನಿಮ್ಮದು ಬೇಡಿಕೆ ಇದೆ ಬಜೆಟಿಂದ? ನಿಮಗೆ ಏನು ಅನ್ಸುತ್ತೆ, ಎಲ್ಲೆಲ್ಲೇ ತೊಂದರೆ ಇದೆ?
ಸೇಮ್ ಅದು ಆಯುಷ್ಮಾನ್ ಭಾರತ್ ಬಗ್ಗೆನೇ. ಆಯುಷ್ಮಾನ್ ಭಾರತ್ ಸೆಂಟ್ರಲ್ ಗೌರ್ಮೆಂಟಿಂದ ಒಳ್ಳೆ ಸ್ಕೀಮ್ ಇದೆ, ಬಟ್ ಜನರಿಗೆ ಅವೇರ್ನೆಸ್ ಇಲ್ಲ. ಮೋಸ್ಟ್ ಆಫ್ ದ ಹಾಸ್ಪಿಟಲ್ಗಳಲ್ಲಿ ಕರೆಕ್ಟಾಗಿ ರೆಸ್ಪಾಂಡ್ ಮಾಡಲ್ಲ, ಜನರಿಗೆ ಟ್ರೀಟ್ಮೆಂಟ್ ಬಗ್ಗೆ ಇನ್ಫಾರ್ಮೇಷನ್ ಕೊಡಲ್ಲ. ಯಾವುದೇ ಕೆಲವೊಂದು ಎಕ್ಸ್ಕ್ಲೂಷನ್, ಈ ಟ್ರೀಟ್ಮೆಂಟ್ ಇಲ್ಲ, ಆ ಟ್ರೀಟ್ಮೆಂಟ್ ಇಲ್ಲ ಅಂತ ತುಂಬ ಈ ಒಂದು ಅದರಲ್ಲಿ ಇದ್ರ ವೆಬ್ಸೈಟ್ನಲ್ಲಿ ಇದೆ. ಇಫ್ ದೇ ಹ್ಯಾವ್ ಶೋಡ್ ಆಲ್ಸೋ ಟ್ರೀಟ್ಮೆಂಟ್ ಈಸ್ ಇನ್ಕ್ಲೂಡ್, ಬಟ್ ಮೋಸ್ಟ್ ಆಫ್ ದ ಹಾಸ್ಪಿಟಲ್ಸ್ ಈವನ್ ಫಾರ್ ಗೌರ್ಮೆಂಟ್ ಹಾಸ್ಪಿಟಲ್ಸ್ಲೇ ಡಿನೈ ಮಾಡ್ತಾರೆ ಟ್ರೀಟ್ಮೆಂಟಿಗೆ. ಅದು ನಮಗೆ ಬರಲ್ಲ ಇದು, ಅಥವಾ ಫಂಡಿಂಗ್ ಇಲ್ಲ, ಅವ್ರು ಹೇಳಿದಾಗೆ ಫಂಡಿಂಗ್ ಇಲ್ಲ ಅಂತ ಹೇಳಿದೆ ಏನೋ ಒಂದು ರೀಸನ್ಗಳು ಹೇಳಿ ಅನ್ನೆಸೆಸರಿಲಿ ಪೇಷಂಟ್ಸಿಗೆ ಇದು ಮಾಡ್ತಾರೆ. ಆ್ಯಂಡ್ ಅವೇರ್ನೆಸ್ ಡೆಫಿನೆಟ್ಲಿ ಅವ್ರು ಹೇಳಿದಾಗೆ ಅವೇರ್ನೆಸ್ ಕೂಡ ಇಂಪ್ರೂವ್ ಆಗಬೇಕು. ಡೆಫಿನೆಟ್ಲಿ ದಟ್ಸ್ ಬಜೆಟ್ನಲ್ಲಿ ಮೋರ್ ಅಲೋಕೇಶನ್ ಶುಡ್ ಬಿ ಗಿವನ್ ಟು ಹೆಲ್ತ್ ಕೇರ್ ಸೆಕ್ಟರ್ ಇನ್ ಟರ್ಮ್ಸ್ ಆಫ್ as madam said, for senior citizens, for disabled people, they should be get more benefited from the healthcare schemes.
All right, so that was the view on budget. And you know, for our budget coverage right here on NDTV Profit, we want to get you voices from what is being expected on ground. We get you voices on what market is expecting, and we're trying to give you a 360-degree view. Helping us do that on Talking Point this morning is Nitin Bhasin, Head Institutional Equities at Ambit. Nitin, great to have you on the show. Thank you so much. And always a pleasure chatting with you. All right, let's start with, you know, frankly, the biggest talking point right now is the corporate numbers. Budget is at one go. I think Trump is in, you know, the background, but it's the corporate numbers. And I'm keen to know your view. Are you seeing a big fundamental problem here or a blip?
Good question. You know, if you look at the September quarter's numbers, they're clearly a shocker because the number of downgrades that we saw in the September quarter was pretty much very high. There was issues around consumption, issues around margin pressure because of the rising input prices. And I think going into the December quarter, our expectation was that downgrades perhaps will be there, but perhaps not to the acute extent of what you saw in the September quarter. So I'm expecting that there will be some more downgrades, but more so in the mid caps and the small caps, and hence that should be washed out for. So we are perhaps after 4 years of good earnings into a little bit of a weak patch, which can extend anything between, I would say, 2 quarters to 4-5 quarters or so before we form a view that this pressure is over, and now investments either from the government or from the companies, corporates, is leading for them for an acceleration again. But I wouldn't be surprised that we see 1-2 more quarters of earnings downgrades and more pressure on the earnings. The present quarter numbers don't give a very good sign yet because it's just about a week, 10 days. IT, the 3 heavyweights, marginally surprised. Kotak was good. But beyond that, I think what we expect of Nifty sales is panning out the way we thought. But after that, we are yet to see numbers to show, which gives us some trend right now. So I would say in a downgrade cycle, let's watch out for the well-balanced numbers to come.
Interesting point that you're making with that earnings is slowing down. What is the impact that you're expected to see then in terms of Nifty 50 earnings this year? Because then it seems that 2025 as calendar year is not really going to be easy going for equity markets, and probably we will barely manage to touch that low double-digit gain kind of a number.
So, you know, if you look at India's last 14 or 15 years of earnings trajectory, we at sell side perhaps started with a lot of optimism and we used to go through downgrades. But post-COVID, the scene was pretty different. And we've seen either the last 3 or 4 financial years, either earnings were upgraded or they held to the starting estimates. In this particular year, which is FY25, we are expecting not more than, I would say, as of right now, closer to about 8% of earnings growth. When you started the year 12 months back, perhaps we're all closer to 14-15%. So I doubt if this 8% number also stands true. We might be closer to 7% or 6.5-7% earnings growth for this year, which is very muted after reasonably holding earnings well for the last 4 years. Next year, the consensus is building closer to 15% earnings growth. There could be some more downgrades into that. So we are in a weak earnings environment, as I was speaking earlier. So which means that there will be pressure on stock market returns. And for the last 1 month, 3 months, what we have been highlighting to our institutional investors in the asset allocation, you got to be in more large caps, you got to be more in IT, you got to be more in banks. These are the sectors where we see less pressure on earnings downgrades compared to the mid caps and the small caps. So hence, you would have a very different trajectory of earnings downgrades amongst mid cap, large cap versus the amongst mid caps and small caps versus the large caps.
Nitin, thought comes to mind, I'm sure in some of those conversations that you just talked about, there would be also a reassessment of returns, of Nifty returns as well as, equity returns that your clients could expect. What are you telling them? Give us a glimpse of what those conversations are going like. And is it a bit about managing expectations right now?
I think, the last month and a half or 2 months has been very rapid, especially in the mid cap and the small cap. After 9 years, we are seeing some sort of a starting point of the year being so weak. What we are telling investors is expect CY25 to be very low return market, stock picker market, and more importantly, it's the mega caps within the Nifty that could actually be outperforming. You can see that in the last month also, Nifty may be down about 2% and banks and IT index could be down 4%. But we've already seen about 7-8% declines in mid cap and small cap index. That's what we are highlighting, that this year you may make muted returns, but asset allocation will help you outperform the market if you are staying in large caps or mega cap companies. That's the sort of conversation. And what of sectors that you choose where earnings downgrade risks are lesser? That's for the clients that what we are indicating to them.
So Nitin, the key thing that everyone focused on was the way the capex spending from the government has panned out in the first half. There was slowdown. Now, the number that comes in terms of the budget is key, and how their allocation changes. Probably that will help you understand if there is any shift that would be happening in terms of the markets. What is your expectation, taking into consideration the expectations your investors have?
Well, we all want that the country should be actually either from the government or from the corporates witness an increased investment momentum, because that is a multiplier effect for both jobs, consumption, near term as well as in long term. But I think all of us are focusing on what will they spend. This question that we have raised yesterday in our budget note is what are we trying to do to solve our revenue sources? Because if you see, our revenue sources define how do we spend money. I think there's a lot of room if we compare ourselves to the EMs. We all take a lot of confidence in how post-COVID our tax collection improved. But that improved for one time, about 80 or 100 pips. Otherwise, we are sort of stuck between 8.8% to 9.2% of GDP in our tax collection. How that number changes or accelerates will be the key, because that just gives government a lot more muscle power, or let's say money to spend in capex. How I'm looking at this year, I think we would like to hear that the government announces 15 to 20% increase in roads, perhaps 15 to 20% increase in railways, and even on the same lines goes out and thinks about how to give money for PLI. Because the amount of money that we are thought to give for PLI, on the 4th year also, we are way, way behind. Not even 10% of the disbursals have happened, what they had planned for PLI. So I would say road, railways, and incentives for real hard large capex on new industries like renewables or EMS is what I would be looking out for in the budget in terms of capex. But more importantly, what are we trying to do to solve our revenue sources, because that will define in the long term our capability to spend continuously rather than in a very, let's say, frugal manner. So this year, there has been a slowdown after 4 years on government's capex. We haven't yet seen October, November, December numbers looking up. How do they talk about capacity building, project identification? Those have to be watched out for. So that are my thoughts on the budget in terms of it's the revenue that we need to solve more. It's the capacity that we have to solve for to handle that large sums of money. We need to now put FY25 behind because we have underinvested in capex, but we have to look forward.
We have to look forward. I think everyone's desperately trying to look forward, but you need clarity on what is, in that view that you can see. Nitin, but thank you so much for joining us. Always a pleasure to chat. Nitin Bhasin, Head Institutional Equities at Ambit there, talking about what you expect from the budget or what he is expecting from the budget. And our focus on budget is big right here on NDTV Profit. So we want to invite all of you to a very special event we're having this Saturday on the 25th of January. We're going to be having some of the biggest names. And Hiral, this is exciting because we're speaking to some of the biggest names in the market. We're giving our viewers an opportunity to call in, send their video calls, ask their questions on what they want and everything under the sun. It's an Ask Me Anything with some of the top names. There you go. Star-studded panel there. Ramesh Damani, you're going to be hearing from Prashant Khemka. You're going to be hearing from Nilesh Shah of Envision, Gautam Shah, and Saurabh Mukherjee, among others.
Absolutely, and it's right ahead of the budget, right, Tamanna? So a lot of your questions that the viewers will be having with regards to expectations from the budget and what actually could pan out is going to be key. In fact, you could record a video message and send it to us on WhatsApp at 8169443399. That's the number that you need to focus on from here on, Tamanna, I think, for the next 2 to 3 days.
Yeah, absolutely. So you can also be part of this. Send in your questions, and Hiral has mentioned where. We need to take a very short break on India Market Open, but stay tuned. Ask Profit next.
They say fortune favors the prepared. The more prepared you are, using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
This January, the world will come together at the World Economic Forum at Davos to bridge differences, because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
Budget 2025 is around the corner and Macquarie has come out with its budget estimates or expectations on each sector. The first sector is the banking space. They do not expect favorable treatment for deposits and possible capital infusion for PSU banks and insurance companies might take place. Moving on to the next sector, NBFCs is the counter. Credit guarantees similar to SMEs for MFI sector can be expected. In the insurance company space, that is the next sector to watch out for, no change in tax rates or any product or any corporate profit tax rate change can be expected in this budget of 2025. The next sector to watch out for will be cement and metals, where they are expecting announcement on import duties to restrict imports on certain metals and certain materials. Moving on to the auto space, outlay for PM E-Drive and PLI can be expected. Policy initiative to drive localization of key EV-related parts can also be expected. The next sector in focus would be the consumption space. Mid to high single-digit increase in cigarette taxes can be expected. The budget, interim budget which was announced last time did not have any tax rate change in cigarettes, which is why we did see an uptick in stocks like ITC and VST. But this time you could see mid to high single-digit increase in cigarette taxes. Reduction in taxes for low middle class consumers could take place, which could boost consumption in the rural as well as the urban spaces. Moving on to the next space, jewelry is the space where no reversal of custom duty cut on gold will take place. In last budget, there was a custom duty cut announced on gold, silver as well as platinum. There will be no reversal on this as per Macquarie. Moving on to the next space, pharma and healthcare, potential support for higher R&D via tax reduction can take place, and PLI for anti-diabetic and weight loss medication could also be one of the factors that the budget might consider. And modest increase in allocation for Ayushman Bharat is something that Macquarie is expecting from the pharma and the healthcare space. Infra is the next space. Capex allocation for key ministries like railways, roadways, etc. Can be expected in this budget, and announcements around additional dedicated freight corridors can also be expected in this budget 2025. Defense is another area where initiatives to boost defense exports can be expected, and announcements around that will be expected, and initiatives fastening domestic defense equipment procurement could also be one of the things to watch out for in this particular budget. Lastly, in terms of power, green energy thrust to continue. Steps to promote initiatives across the value chain, that is to promote green energy, might also be seen during this budget. Oil and gas is the last counter where Macquarie expects that OMC's compensation for LPG under recoveries might be seen. So these are Macquarie's expectation on different sectors as to how budget may come out with different changes in different sectors and how it may impact these sectors.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company.
Hi, good morning. Thanks so much for tuning in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew, and with me is Mahima Vachrajani, and we'll take you through the next 1 hour of trade. This show is geared towards getting you answers to all of your stock-related questions, and there are several ways in which you can send your questions to us. The first one, of course, is the WhatsApp number that you see on the screen. It's up there. And the other number is a calling number. It's a landline number where you can speak to Mahima or me. By the way, we were discussing this. We can take questions in several languages. Of course, we prefer English, but then in case you want to speak to us in Hindi, Marathi, Gujarati, maybe a little bit of Malayalam, I will try. But the point is that we've got experts to answer all of your questions, and today is a day when you might have a lot of them. Let's take a look at the markets and where they stand right now. You have the benchmark indices that have bounced a little bit from yesterday's crack, and they're trading with gains of about 0.4%, holding above 23,100. Remember, For the first time since June, you had the benchmark Nifty 50 break below the 23,000 mark yesterday, and that's a very crucial level to watch out for. If you close below that number, I'm sure my technical expert today will tell you what will happen. But the broader markets are still seeing significant weakness. In fact, you have the midcap index that's trading with cuts of about 1% and not 1.5%, but 1.3% or 1.2%. And you have the small cap index that's trading with cuts of about 1.4% at this juncture, as a result of which the market breadth is tilted very firmly in favor of the declines, and you have quite a few stocks that have reacted very sharply to their earnings on the downside. We were talking about a few stocks at the start, Mahima, and you have a few of these stocks, IndiaMart, Intermesh. On the face of it, the numbers looked okay, but then you delve a little bit into the details and it's not looking very good. I can't remember who, but there's a very sharp downgrade on the stock. You have a few others, ICICI Pru, Cyan DLM. You have quite a few of these that are reacting very sharply on the downside. What's on your list?
Right. So, just to point out, yesterday, I think Astha or Swati, one of them said that, I think Swati said that, it's a very stock-specific market. And, experts on our channel are also saying that if your earnings are not panning out well, the stock is really, kind of getting hammered. And that's what happened with Intermesh. The numbers looked good prima facie, but subscribers for them have significantly gone down, which means the future for Intermesh, IndiaMart Intermesh looks bleak, which is why the stock is seeing, the downtick that it is seeing. It's down 7.5%. Cyan DLM, again, revenue did beat estimates, but it's the order book execution that is kind of concerning, and which is why the stock is down around 12.5%. Rosary Biotech is another counter which is also seeing pressure, and this is because their margins did take a hit. The net profit was down around 8%. It's down around 4% as we speak. Tanla Platforms, other counter which is seeing pressure. The results were not at all good. The margins slipped down to 13.9% versus that of 15.2%. The stock is down 6.5%. PNB Housing, although, is on the other side of the spectrum. The total income was up 10%, net profit up 36%. It did see good gains in the start of the trade, but I believe the way markets are going, it was also pulled down in the red, and it's down around 2%. ICICI Prudential, numbers in line with estimates, but margins have declined due to shifting towards the lower margins, ULIPs and group funds, which is why we are seeing a downtick of around 8% on the counter. Let's also put up Jana Small Finance Bank. This is one counter which opened significantly in green, and it's still holding up. And it's almost at its day's high, up 17%, where the net interest income was up 8%. Net profit, however, is down, but the gross NPAs and net NPAs have improved by a tad bit, which is why the stock is seeing the significant uptick. So 17% up on Jana Small Finance
Okay,
Bank.
and I'm sure that our viewers have a lot of questions about these stocks and others. Incidentally, we've got our first caller, but before we go to Anup, who's calling us from Cochin, let me introduce our guests today. We've got Avinash Gorakhshankar as well as Vaishali Parekh joining us this morning. Good morning to the both of you, and thanks so much as always for taking the time. I'll go to our first caller today. Anup is calling us from Cochin, as I said. Morning, Anup. What do you want to know about?
Yeah, good morning, Alex. So, I just wanted to know about the Ratnavir Precision Engineering.
Okay, Ratnavir Precision. Okay.
Yes.
What about it do you want to know?
170.
Okay, 170. All right.
Yeah, 1800 quantity.
Okay. Okay, and what is the time frame that you have?
So something like more than 18 months.
18 months. But what about this did you like? Because it's a stainless steel washers manufacturer, from what I can see. It's a very small company, less than 1,000 crore at this juncture, and it is actually down about 8% over the last 6 months, been more or less flat, but you're still in the green. It's been flat over the last 3 months. When did you buy this?
So I bought in November actually.
In November, okay. And what did you like about the company? Why did you buy it?
So their sales are sales and their OPMs are good actually.
Okay, understood. I'm going to take a chance and ask Avinash. Avinash, very small company, less than 1,000 crore market capitalization. Do you have any idea of what you can do with this for the next 18 months?
No, I think, good morning, Alex. I think my sense is that, this company is an engineering company based out of Vadodara.
and it makes stainless steel tube washers as well as components for the solar and the green energy sectors. Exports about 40 to 45% of its revenue. So I think numbers, for the last 2 quarters have been quite impressive. The stock had initially underperformed, after it went public. But I think looking at the good numbers, the stock started moving up. I would say that, if the investor has a time horizon of at least 12, 18 months, I think he should hold on. Current year is definitely going to be good. Plus the new facility, again in Vadodara, an expansion is going to start from the new financial year. So I think that would obviously give a big kick up to their revenue and profitability estimate. So I think since it's an ancillary play on the engineering and the solar sector, which are growing quite rapidly, and they have a fairly good order book, I would not be surprised that they should do better. So I think continue to hold. I think he could expect a decent risk reward, but I think as mentioned, time horizon of at least 12 to 18 months would be definitely be good for getting a good risk reward.
That's the view coming in on Ratnavir Precisions. Moving on to the next query. Vaishak from Kerala has a query on TCS. He's holding 55 shares, bought at 4275 a piece, and he wants to know as to whether he can hold it for the next 1 year or not. Vaishali, I'll come to you on this one. TCS had a flattish growth in the past 2 quarters, and we've seen some signs of recovery. So fundamentally, we're seeing recovery, but not very good in place. But how does the chart look?
So chartically, there's really nothing much happening on TCS. But overall, if you talk about the IT sector, in a market like this today, it's attempting to show the bounce, and overall, the trend is quite positive. So I think these are levels fair valuation to start considering these stocks. So now that he has held on and he's bought it and he's holding on, I think just continue holding, at least exit and a bounce. Maybe you can see a return up to 4,500 or so. So for now, it's a hold.
Praveen is calling us from Karnataka. Praveen, कॉल करने के लिए बहुत बहुत धन्यवाद. क्या जानना चाहते हैं आप?
सर मैंने कोचिन शिप लिया 2445 रेट पे 8 शेयर.
ओके.
और तो अभी उसका रेट बहुत कम चल रहा है, तो क्या करूं, होल्ड करूं या शेयर करूं?
कब लिया था ये शेयर?
जुलाई में लिया था.
ओके. और उस टाइम पे क्या सोच रहे, किस रीजन के लिए आपने परचेज किया था? लॉन्ग टर्म फंडामेंटल्स देख के आपने बाय किया था?
जी लॉन्ग टर्म देख के किया था, क्योंकि उस टाइम मैंने 700 से नोटिस किया हुआ था. 700, 500, 2445 जिस हिसाब से ग्रोथ हो रहा था उस हिसाब से मैंने बाय किया था. लेकिन उसके बाद नीचे फॉल डाउन ही हुआ है.
और आप कितना होल्ड करना चाह रहे? लॉन्ग टर्म होल्ड करना चाह रहे?
1 साल तक.
1 साल तक. ओके. अविनाश, it's a tough ask, right? You're talking about a significant recovery that will have to be made in the stock price for him to get his cost back. This is a stock that I think a lot of people have bought in their portfolios, but they've seen a little bit of a disappointment if they bought at the higher levels, and a lot of people have. What is the strategy that you would employ?
No, I think first of all, Alex, I think he needs to give in some more time. I think 1 year could be a short period because most of these defense stocks have corrected significantly. I think looking at the fundamentals, Cochin Shipyard is a very large player in the defense ship market, enjoys an order book of more than 4,000 crores. And I think orders are booked at least for the next 2 years. Plus, they are also exporting some of their ships. So I think business is going to grow very rapidly. But I think if he wants to make an alpha year, I think he needs to, average a little more. I think he's got a very small quantity of just 8 shares. So I think if he can add a little more at around 1,400 odd levels, that would bring down his average cost and keep it at least a 2-year time frame. Because, in these companies, 1 year could be a little shorter period. Of course, what the budget, presents for the defense sector is another, thing which could possibly spring a positive surprise if some big announcements are made. But otherwise, I think over the next 2 years, if he can patiently wait, he can definitely get a decent risk reward. I think he needs to stay invested for a long period of time.
All right, that's the view coming in on Cochin Shipyard. Moving on to the next query, B. Chakraborty from Kolkata has a query on Asian Paints. He's bought 100 shares at 2231 a piece. He wants to know as to what could be, the stop loss and target for the next 3 months. Vaishali, I'll come to you on this one. Asian Paints is the counter. We're seeing pressure on the entire painting sector and brokerages are also turning bullish. But 3 months, how does it fare on charts?
So I would say technically it's really corrected quite a bit. It's just making an attempt to bounce back from its oversold zones. So I would say 2150 should be taken as a stop loss. And I think at least for near term, it is showing sign of upward move. So 2400 would be the next target to look at. So keep a stop loss of 21,550 and hold on.
21,550 is the stop loss. Moving on to the next caller, Yuvaraja, I believe, is calling from Karnataka. A very good morning to you. How can we help you? Hi, we can hear you.
Hello.
Hi.
Hello.
Yeah.
Hello.
Go ahead with your
Good
query.
morning, ma'am.
Good morning.
Yes, ma'am. I have purchased an Indus flower, Gandhara oil, ma'am.
Okay.
I have to buy, I have to hold, or I have to wait or not. I have to.
All right. How long can you hold it for the next 1 year? Can you hold it? Do you want a technical perspective or a fundamental perspective?
I have a fundamental, ma'am.
Okay. I'll come to you, Avinash. Gandhar oil is the counter. What's the view?
No, I think clearly, the stock was purchased at a higher level. But if you see the bigger challenge for Gandhar oil, it's that most of its raw material are, crude related. So basically, if crude prices go up, and if the rupee continues to depreciate, then it is going to be a double whammy for the company. So my sense is that unless the investor can patiently wait for the next 12 to 18 months, I think in the near term, there are very few triggers. I would not be surprised that the third and the fourth quarter, possibly the fourth quarter and the first quarter of next financial year could be equally challenging. So I think continue to hold. But yes, I think to give a long-term view, the business prospects are pretty solid. But, the raw material side, volatility and the price of crude is going to be the key, risk factor, at least in the near term.
Just want to draw your attention to a special program that we have lined up on the 25th of this month, that is Friday. 3 days to go now, and this is a show that is geared towards getting you answers to your questions, but the people that are going to be answering your questions are the who's who of Dalal Street. Big names that we're talking about, and we're talking about Mr. Damani, who will be answering your questions, Prashant Kemka, as well as Nilesh Shah of Envision Capital. Ramesh Damani, of course, is going to be in studio, I believe. We also, on the technical side, got Gautam Shah from Goldilocks and Kush Bora. Saurabh Mukherjee, Marcellus, is going to be doing a session with us as well. The number that you should reach out to is the same number that you are sending us messages on this particular program, which is flashing on your screen right now. What we want you to do is hold your camera in a horizontal format if possible and send us a video recording of your question. Chances are that if your question is insightful and is interesting, then we will feature you on the show, and the likes of Ramesh Damani or Mr. Prashant Khemka or one of the other experts will take it up over the course of that day. This is Saturday and we'll be live for quite a bit of Saturday, so I'd encourage you to tune in definitely. And why don't you take the opportunity to also send us your question? Chances are that you could feature on national television. All right, let's go to the next question, and we've got Anu, who's writing in from Karnataka, and she's asking about a stock that posted its results not too long back. Yesterday, in fact. KEI is the name of the counter. She's bought long back at levels of 90 rupees per share. Is that even right? My goodness. 90 rupees per share. She's bought quite a while back, therefore. The stock is currently trading at 3,998. She's held for quite a while. What is the perspective? The stock is under a tad bit of pressure today, if I remember correctly. Avinash, there was a miss on the margins and there was a miss on the profit in the quarter gone by. What is the view on the stock? Would you hold?
No, I think, Alex, this is something like, a huge multi-bagger gain by the investor. So I think 90 rupees becoming almost 4,000 rupees. So I think, talking about the company, this is a large player in the cable and wire market. And I think most of the cable and wire companies, according to me, are poised quite well, because looking at the kind of growth in infrastructure plus the kind of power projects which are being implemented, KEI is definitely looking at expanding its capacities and benefiting from this growth. So I think, 1 quarter number may not spoil the show completely. So, if the investor has a slightly medium-term call, he should, continue to hold. I would not be surprised that you could see a good re-rating, because a lot of institutions, domestic funds, FIs and even PMSs have got in the stock. So I think this minor blip is not going to affect the long-term kind of wealth creation. So despite the fact that a lot of money has been made, if the investor can hold on, I think some better pricing can be expected over the next 12-18 months.
I want to refer to the numbers since we spoke about it. KEI Industries, the margins contracted about 80 basis points to 9.6% in the quarter gone by, and the net profit has risen just about 9.4% to 165 crore rupees. UBS had a note on KEI. It has cut its target price to 5,750, which is still a considerable upside from the current market price. So that's something that you should bear in mind.
Right, absolutely. Let's move on to the next caller then. Swaminathan from Bengaluru is calling in. A very good morning to you, Swaminathan. How can we help you?
Yeah, good morning. This is regarding Pilani Investments.
Okay.
And I purchased at 5,300 rupees, around 25 shares.
Okay.
Just wanted to know the medium term, whether I can hold it or sell it.
Right. From what I understand is that this basically is a non-deposit taking NBFC reserved, registered with the Reserve Bank of India and functions in the core investment company with main activity being investment in shares and securities of Birla Group of companies. I just want to understand as to what is the specific reason behind buying Pilani Investment specifically?
Yeah, because the book value of the company, if I'm right, is around 13,000 rupees.
Right.
And they have a very good, blue chip companies under their investments like Grasim, Ultratech, and other big companies.
Right.
So based on that, I thought this should go up. That's what my guess was.
Understood, Swaminathan. Avinash, I'll come to you. Swaminathan has done his study well on the company, but your take on this company if you have the coverage?
No, I think, this is a very old company of the Birla Group. As you rightly mentioned, it's the holding company. But, normally holding companies, according to me and overall according to the markets, they're normally discounted, almost by 50% to their, market values, whatever market values they hold in the group companies. And unless and until there is some, value monetization, these companies are basically treated as mostly dividend kind of earners because most of the income for these companies comes in the form of dividends. So I think, the investor should understand that capital appreciation in these companies will take a long time unless you've got a 2 to 3 year kind of time frame. And if some monetization happens, if some equity shares are listed separately or, there's some sell-off which the group decides to do and encashes and obviously books that money in the profit and loss account, big capital appreciation is not going to be possible. I think it's at best a good dividend yield kind of, opportunity, that too over the longer period. So I think, if he's got that kind of approach in his mind, then I think it's fine. But if he's looking at capital appreciation, then I think he should not remain invested in this company.
Vaishali, it seems like because of the texture of the market and the way that it's moving, the short-term guys are ducking for cover and not too many. In fact, we're getting most of the questions that are fundamental in nature, but still Darshan Mandviwala from Surat in Gujarat, he's saying that he's invested currently in Hindalco, but he's looking to deploy right now for 1 year. What is the best entry price in your opinion?
So technically, I think Hindalco has really done with its corrective move, and we saw just in the recent past 560 was the low that was made. So I think that should be the level that he should be taking it as a support. And since he's looking at a long-term perspective and market is volatile, consider this as a very strong support 560 and start accumulating this stock, because I think overall, even for a longer term period, the trend is quite good and good for accumulation from these levels.
That's a view on Hindalco, positive on the charts. Mohan is calling us from Hyderabad. Mohan, good morning, and how can we help you today?
Sir, good morning, sir. Good morning, madam. Good morning, Avinash sir and madam Vaishali. I would like to ask Mr. Avinash sir about Hyderabad batteries, HBL batteries.
Okay.
HBL batteries, I bought 500 to 540.
Okay.
It went up to 700 also, but now it came down.
Okay.
I would like to know the future of this company.
HBL Power Systems, right, you're talking about?
Yes, exactly.
HBL Power Systems, okay. Any chance you have a view on this, Avinash?
Yeah, I think Alex, HBL Power is a very strong player in the Kavach system, which has been developed for the railways. And I think this budget also there are expectations that the government is going to increase the outlay quite significantly. Already, HBL Power is sitting on an order book of more than 2,500 crores. They also have a large exposure in the aviation and the defense market. So I think the investors should actually hold on to the investment here. I would not be surprised that the next 2 years are going to be equally promising and much stronger in terms of top line and profitability growth. In fact, the third quarter numbers have also been quite good. So overall, I think it's a good business, and I think they have been in the right product at the right time. So I think continue to hold. Give a time frame of at least 12 to 18 months. I think good amount of risk reward, even from the current level, could be possible.
Hats off, Avinash, to your research, because by the time that I've pulled up the stock and the screener on my laptop, you've already given us key details of what the order book stands at. So kudos to you.
Moving on to the next query, Ankit from Ahmedabad is holding 5 shares of Tata Power bought at 444 rupees, and he wants to know as to he should average it out at current levels of 360 to 365. Okay, currently the stock is trading at 357. Vaishali, averaging out, is that a good strategy for Tata Power?
Definitely, because I think this too long-term trend is intact. The prominent support lies at 340. So as I said, that market is quite uncertain. So there is going to be some volatility. But yes, these are fair levels. So I would say, exact bottom fishing is not possible. But one should start accumulating in tranches from here on.
Start accumulating Tata Power in tranches. We have to slip into a very quick break. Vaishali, Avinash, do stay with us, and viewers will be back on the other side to take more of your questions, so do stay tuned.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
I present the budget for a historic
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about 3 key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold, into the mutual fund industry over the past couple of years, will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate, and what that means is that depending on which income slab you fall in, if you're in the highest tax slab and you're paying 30% on the income above a certain threshold, your gains from debt mutual funds are also taxed at 30%. That wasn't always the case. Long-term capital gains came into effect after a period of 3 years, and they were taxed at 20% with indexation benefits. Of course, that doesn't remain the case anymore. So the mutual fund industry is asking for a rollback to the previous tax treatment because they say that the debt market in India is growing, is emerging, and it needs to be incentivized. The third change that they're suggesting has to do with the income distribution schemes. Of course, there are two types of schemes in mutual funds. One is the growth scheme, where all gains are reinvested by the fund manager. And in the second case, which is the dividend distribution scheme as it used to be called, the income is distributed on an ongoing basis to unit holders. Now, the thing is, income above 5,000 rupees that is distributed in this manner will have to have tax deducted at source, or TDS, as things stand right now. And the mutual fund industry is suggesting that this threshold be raised to 50,000 rupees, and they expect that this will benefit a lot of people because they won't then have to have tax deducted at source. Of course, there are more proposals that they've made, but we'll see what the finance minister takes up when she presents her budget for 2025.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by
Welcome back. You're watching Ask Profit, a show where we answer all your stock related queries, whether they're fundamental or technicals. Viewers, you can ask all your stock related queries on WhatsApp or either call us. We have our next caller online. Ray from Bengaluru is calling in. Ray, a very good morning to you. I believe your query is on PB Fintech.
Yeah, right. Good morning.
Good morning. Go ahead with your query.
I'm holding 14 shares of PB Fintech at 2135 per share.
Okay.
I bought it on 2nd Jan.
Okay.
And I have a long-term view for platform companies in general. My sense was since it is getting into hospital sector also,
right,
it would have better future going forward.
Right.
But since the time I bought, it is falling quite a lot. So I just want to know if I can average it out at this level, or should I mean, what should be the strategy going forward?
Right. I think your query is crystal clear. Avinash, I'll come to you. PB Fintech is the counter. What's the view?
No, I think, Mahima, if the investor has a 2 to 3 year kind of time frame, platform companies inherently make losses in the initial years. And then once operations break even and the scalability of the business is proven, then I think, it's going to be a big runway for growth. So I think already, if you look at the global markets, selling online insurance policies is a very normal part of the game. In India, we still have insurance agents which do a large part of the insurance selling network. So I think, the market opportunity here is pretty large. The insurance penetration in India is very low. So I think given that, I think definitely Policy Bazaar, which is the portal for PB FinTech, definitely should grow very well. In fact, my sense is that if the investor has a 2 to 3 year kind of time frame, I think definitely this looks a promising opportunity. But yes, I think you need to give in a long runway to wait for the rewards to come in.
Okay. Finally, a short-term question and a technical one being sought. In fact, on State Bank of India, Ilya Raja is writing in asking what the levels are to watch and what level to enter. 750 or very close to that mark, about 17-18% down from the 52-week high. Does it make sense, Vaishali, to buy right now?
See, the trend is still showing signs of reversal. I mean, there's a downward projection even now. So I would say wait for this. In all likelihood, this can go towards 740, 720 levels. So these are the levels that I would say start buying, because that would give him a fairly good risk-reward ratio.
All right. So that's the view on State Bank of India. Suman is calling us from Hyderabad. Hi, Suman. Thanks so much for calling. How can we help you today?
Yeah, hi, yes. I wanted to know this KNR constructions. Can I buy enter now?
Can you enter now? For what period are you talking about? And is this fundamental or technical?
I'm asking about the fundamentals now.
Okay. And what time frame are you thinking of?
2 years.
2 years. Okay. So you're interested in the infrastructure space, and what drew you to KNR construction specifically, Suman?
So KNR, they're improving their bottom line very well actually.
Okay. So
the order book.
You track the earnings, yeah. The stock is up about 8.5% over the last 3 months. Avinash, is this a good time to enter, and what are the prospects on the fundamentals for KNR?
I think within the EPC and construction market, it's a quality player in the market, Alex. I think what is most noteworthy about the company is that, their execution track record has been very solid. They've always completed projects ahead of time. And I think the investor has rightly mentioned that, they have a large order book of almost 3,000 to 4,000 crores. So I think order book visibility continues to be very solid. In the coming budget also, hopefully, the construction companies will be given some sort of boost according to me. And that will be a near-term sentimental trigger. But yes, I think if he can hold on for the next 12 to 15 months, definitely I think he could get a decent risk reward. Valuations also appear to be pretty reasonable, around 12, 13 times on your forward numbers. So that, additionally makes the stock pretty look attractive from a medium to long term.
View coming in on KNR Construction. Moving on to the next counter, NTPC Green is the counter. We have, Ravichandran has bought 1,000 shares, and he wants to know as to what could be the outlook for the company from the next 1 to 2 years perspective. I'll have to come to you, Avinash, again. NTPC Green, what's the view?
No, I think this is a recent listing, Mahima. So, I think if the investor has a couple of years in mind, they are basically a solar power generating company and a subsidiary of NTPC. So my sense is it's a very fairly, risk-free assured business, because the order book continues to be very strong. They plan to even double their capacity. So, I think clearly if the investor has a medium to long-term view, he should not be worried with the mild correction which he has seen in the stock price. I think he should continue to hold, but keeping a time frame of at least 12 to 18 months, as of now.
12 to 18 months looks good for NTPC Green is the view coming in. Now moving on to the next caller, Murlidhar from Gwalior is calling in. Murlidhar, a very good morning to you. कैसे मदद करें आपकी?
गुड मॉर्निंग मैडम एबी कैपिटल पे मैं पूछना चाह रहा था, उसमें एक प्रेस एंट्री ले सकते हैं क्या अभी?
एबी कैपिटल स्पेसिफिकली क्यों? आपने फंडामेंटल्स देखे हैं कंपनी के या चार्ट्स देख के पूछ रहे हैं आप?
चार्ट देख के मैडम, थोड़ा करेक्ट है अभी तो।
ठीक है, और टाइम होराइजन क्या है आपका? कितने टाइम तक आप होल्ड करना चाहेंगे एबी कैपिटल को?
5 to 6 months तक।
Okay, Vaishali, AB Capital, how does it fare on charts?
Well, it is quite corrected, but I think further corrective move cannot be ruled out. So look for a level of 160 to 155.
160 to 175 is the level, is the range to watch out for. Kunal is calling us from Delhi. Kunal, good morning, and how can we help you today?
Hi, good morning. I hope you are having a good day.
We're having a great day. I wish that the markets were having as good a day as I am. Please go ahead.
That's true, that's true. So I am holding RK Forging at the price of 705, 100 shares. So after the current Q3 results, so I wanted to know the outlook of the experts that can we hold it or should I sell it?
Okay, so Kunal, I'm assuming that you have a long-term fundamental view and you're still in the green. When did you buy this?
This was a few months back at the price of 705.
Okay, got it.
I don't know the exact date, yeah.
Yeah, that's fine. Give me an indication. All right, so you want to know, based on the fundamentals, what's the long-term outlook? Avinash, Ramakrishna Forgings, would you hold on based on the fundamentals?
Yeah, I think Alex, RK Forgings is a very large, forging player based in Eastern India and largely caters to the commercial vehicle sector. In fact, Tata Motors is one of their key clients. And most importantly, now they've entered the railway market. They're going to manufacture wheel rims along with Titagar, wagons in a joint venture. The order book continues to be pretty solid. I think in terms of capacity, now they are number 3. And most importantly, even the export market has opened up for them. So I think, despite the fact that there has been some margin pressure in Q3, I think overall the order book continues to be very solid. And hopefully, if the railway market continues to grow, I think they have opened a new non-automotive market, which actually will give them significant growth ahead. So I think, if the investor can hold on for the next, say, couple of years, this is a stock which definitely can grow significantly. In fact, the stock is already plus for the investor. But I think even from these levels, significant amount of wealth creation can happen, provided, investor can stay invested for the next couple of years.
All right, so that's the view coming in on RK Forgings. Moving on to the next query, Mahalakshmi from Hyderabad has a query on JBM Auto. She's holding 125 shares at an average price of 1895. She's saying that there's demand for EV, but the stock is down to 2,400, and she's been holding this shares in quite some time now, and she wants to know whether she can average it out or hold it for the next 2 years. She's also saying that please suggest me a further course of action. She's a housewife who's 66 years old. Since it's 2 years, Avinash, I'll come back to you again. JBM Auto at current level, should she average out or keep holding the current shares that she has?
No, I think she can definitely average out because see, this company has been a very large vendor to Maruti. They make sheet metal components, but they have diversified into electric vehicle buses. And I think the government's focus, specifically pan-India, has been to encourage, city buses, specifically the electric, buses. So I think this is definitely going to be a good trigger point for the company. So I think, if the investor has a 2-year kind of time frame, definitely some averaging can be done. There is no doubt that the company's business model is very solid and the business opportunity is pretty large. So I think keeping a 2-year view, I think one can definitely nimble into the stock at the current level and take a long-term view here.
All right, so that's the view coming in on JBM Auto. Moving on to the next caller, Sandeep from Hyderabad is calling in. Sandeep, a very good morning to you. I believe you have a query on Hero MotoCorp.
Yes, ma'am. Very good morning, ma'am.
Good morning.
My query is on Hero MotoCorp. I bought it on 2nd Jan.
Okay.
Expecting that it would grow from 4,300 levels.
Okay.
Because it has already fallen by 30% or 33%.
Okay.
So I just wanted to understand how much fall further it may have, being one of the best two-wheeler companies in the country.
Right.
I just wanted to see how much fall it can have and how we will be able to buy it further more at certain levels. Just wanted to understand.
Okay, Sandeep, when you bought it on 2nd Jan, was it the charts that you saw or the fundamentals that you saw?
Yes, ma'am. It was a 2-day chart. It was moving upwards, and that was the second day. Usually we see that it was moving a bit upper.
Okay.
So I thought that from the next day onwards it would further is a possibility of moving up.
Okay, so how long do you plan to hold this? And
3 months,
do you want 3 months? So I'll get you a technical view on this then. Vaishali, I'll come to you. Hero MotoCorp is the counter.
So I think the furthermore downside cannot be ruled out because there is some corrective move, and overall you see full auto sector is under a good pressure. So I think this can go towards 3,800. So depending on how much he can hold and what is the risk he can take, 3,800 is quite likely.
3,800 is quite likely. Sona BLW is the name of the counter that we're talking about next, and we got Prakash from Chennai who is writing in and looking for a fundamental outlook. He's holding 600 at a price of 501. He wants to increase his holding here. Should he sell and re-enter at a lower level or buy additional quantity is a question right now. He is in the green, and which is why that question makes sense. Avinash, on the fundamentals?
No, I think again Sona BLW, Alex, is a play on the electric vehicle sector. They have more than 25 global electric vehicle companies as their customers, and they are one of the large players in the market. So I think, here, if the investor is taking at least the next 2 years in opinion, both the global market as well as the domestic market is growing quite rapidly for electric vehicles. And I think to that extent, Sona BLW is very rightly positioned. So I think keeping a 2-year view, he can definitely average at the current level. But I think he needs to take a 2-year time frame to stay invested.
Take a 2-year time frame on Sona BLW. The next question is a caller. In fact, we've got Shweta calling in from Bengaluru. Morning, Shweta. How can we help you today?
Yeah, hello everyone.
Hi. Please go ahead.
Yeah. So I have purchased MHRIL. The quantity was 50.
Okay.
And the price was 368. And it was last month that I purchased.
Okay.
But now see that the stock has fallen to 330.
Yes.
So I want to ask if I should continue or sell it away at this price.
Okay. Shweta, help me. Sorry. Can you help me with the time frame that you had in mind when you bought the stock?
Around 1 year.
Okay. So it wasn't on the fundamentals that you bought, right? You bought based on the trading. You had a trading idea.
Yeah.
Got it. Vaishali, on the charts then, for 1 year, bought at levels of 360, I believe, or thereabouts. 330 is the current market price. What are the prospects?
I think it should be done. The corrective move should be done. Take 300 as a support because we've seen a one-way fall right from 500 levels. So we are already in the oversold, and I think overall, I think this is Mahindra Holidays, right? MHRIL. So I think overall this industry is doing pretty well. So I would say keep 300 as your support and perhaps add more.
All right, so that's the view coming in on Mahindra Holidays. Moving on to the next query. This query is from Murli from Tamil Nadu. His query is on Sun TV. Okay, interesting one. The average price of buying is 726 and he's bought 25 in quantity. Is averaging the shares advisable? Vaishali, this is one of the counters which is, kind of volatile when it comes to trading. What is your view with respect to Sun TV?
I would say rather focus on still other quality stocks. Avoid this right now.
So stay away from Sun TV is the view coming in from Vaishali. Moving on to the next caller, Venkat Rao from Hyderabad is calling in. Very good morning to you, Venkat. How can we help you?
Good morning. This is Venkat Rao from Hyderabad. I bought one HFCL shares and 150 shares at the rate of 150. Now it is trading at 98 or 100 rupees. What can I do? Sell or hold or selling?
Okay. When you bought it, did you buy it considering that you'll hold it from a longer term perspective?
No, I'm long term, 1 year waiting period.
1 year waiting period. Okay. Avinash, I'll come to you. HFCL is the counter.
No, I think you can continue to hold. See, I think recently HFCL has got new orders, from the telecom department, and I think they've got a large exposure even in the defense market. So my sense is, the stock has been pretty volatile. But if you see the numbers, Q3 was a slight disappointing quarter. Numbers in terms of margins and profitability was more or less flat. But I think clearly if the investor can wait for the next 12 to 15 months, I think he should get a decent risk reward. So I think continue to hold.
Continue to hold on HFCL. Hopefully my next viewer is going to tell me their name. I have asked, but I found the question very interesting. VST Industries is the name of the counter, and what they're saying is that the share. So Vikram has replied finally. Vikram from Pune. The shares have fallen after the bonus shares were distributed and have not recovered since. The stock is currently at 327. But I found what was interesting is the advice that he's seeking. Avinash, I'm not sure if you've come across this terminology. It is HODL, which is actually a crypto terminology, hold on for dear life, which is the option HODL hold, sell or buy. And HODL is basically a holding for the very, very, very long term. So what is the advice that you would give on VST Industries?
No, I think my sense is he should continue to hold. I think whenever the company gives a bonus, Alex, as everyone is aware, obviously the incremental dilution impact gets into the market and the stock gets averaged out. But I think if you look at the business model, there are very few, cigarette companies. And in fact, just to tell you, VST Industries has got very large marquee investors, which continue to hold on to their position. So I think, the liquidity of the stock may not be very large. But if you look at the business model and the kind of growth opportunity, I think, at least the next 12, 15 months, if one were to hold, I would not be surprised that, they have a decent market share and a good product offering. So I think they should continue to do well. But in the short term, the stock may remain in a very close range. So I think longer term, if he's got the patience and the conviction, he should continue to hold.
I think even the kind of announcement in the budget will be a wait and watch in terms of, taxes on the cigarette for VST Industries as well as, ITC. Moving on to the next query, Krishna from Vizag has 500 shares of Angel One bought at 3021 a piece. He wants to know whether he should keep holding them or not. Vaishali, Angel One on the charts?
I think this too is on a selling mode, so I would say. But however, it is at a good support level. So 2200 key, hold it with a stop loss of 2200.
Hold is the view on Angel One. Yash is calling us from Pune. Yash, good morning. And how can we help you today?
Yes, good morning, sir. I bought Vodafone Idea at price of 18,000 shares. So should I hold it or sell it?
When did you buy, Yash?
Almost when the IPO was launched.
Okay, so you've recovered some FPO, you mean? Yeah. The follow-on public offer.
It was 25 April 2024.
Got it. Okay, so the FPO is when you bought 11 rupees. So you've held in that entire time frame when it went all the way up to what, 17, 18, thereabouts, and then fell all the way down to what, 7, 6? Yes. Okay, so you've had quite a bit of patience. Yash, can you help me as to why you bought Vodafone Idea?
Vodafone Idea, sir, in perspective of it was giving a competition to Jio and Airtel, so versus that, and looking the fundamentals about it.
Okay, Yash, just a quick follow-up. Do you have more stocks beyond Vodafone Idea that you're holding?
Apart from that, other companies I have.
Yeah.
CG Power at 125 quantity at 846 price. And the date was...
No, not date. Any other stocks that you're holding, can you tell me briefly?
CG Power, 125 quantity, 846. Then apart from that, Amaraja Batteries, 50 quantity.
Okay.
And price was 1446.
Got it. So basically 3 or 4 stocks, right?
Yes, I have more than that.
Okay.
But in short,
Few stocks. All right. Avinash, Vodafone Idea, high risk, high reward strategy so far, and it's proving to be high risk for most people. Bought at levels of 11 rupees, 18,000 quantity. What would you do with this?
No, I think, my sense is that it's a sell on rise because, obviously Vodafone is in the news of late. They've won one order where they've got a refund of 1,600 odd crores plus. There have been some unconfirmed reports that, the government may change the AGR, rules, which could also benefit the company. See, I think one thing is very clear that Vodafone is one of the weakest players in the telecom market if you compare it with Bharti or Jio. And with the kind of 5G rollout capex required, I think it's going to be an Herculean task to actually gear up in terms of increasing their market share. So I think, my sense is it's better that once the stock comes to his cost price, I think he should exit. That would be a better strategy because going forward, at least for the next 2-3 quarters, I don't think the company is going to come in the profit. They would continue to record losses.
And they're losing market share. Yash, so be very careful with your investment. We've said this all week and in fact over the last several weeks, be very careful with your investments and don't take such a large exposure to one particular stock if you're not very certain about the fundamentals and the future. All right, it's time to hit the rapid fire segment, and this is where we throw as many questions at our experts as possible over 2 minutes and we try and get them answered. The first question we're taking today is on, we've got Angel One already, but we'll take Motilal Oswal Financial Services. Karan from Kerala is asking, 860 is the buy price. Would you buy at the current juncture or would you average? What's the view on the charts, Vaishali?
So Motilal, buy at this level.
Okay.
All right, LIC is the next counter. Gul has got 5 shares. He wants to know at what price he can add more and average it. Vaishali?
So LIC housing, you're asking me about LIC. Okay,
LIC.
I think this level is, yes, it's good to buy at these levels.
Okay. KFin Tech, average price of 1,050. Siddharth wants to know, would you hold or would you exit? Horizon is 5 years. Avinash?
Yeah, I think continue to hold.
Morpin Labs bought at 62 a piece and holding 9,000 shares. What could be the next course of action, Avinash?
Well, I think continue to hold. I think next 12 to 18 months look quite promising.
Okay. We can't comment on unlisted shares, by the way. Suzlon Energy is the name of the counter. Bought at levels of 59.75. Shubhankar wants to know, hold or buy more at this point. Vaishali, on the charts?
Hold with stop loss of 52.
All right, Sign DLM is the next counter. What's the view with respect to the Q3 numbers, Avinash?
No, I think numbers were quite disappointing, but I think the order book continues to be positive. So I think continue to hold for the longer term.
Okay, Ircon International, 330 is the buy price. Loss is being incurred by Arjun. Would you hold or exit? Avinash?
Yeah, I think continue to hold. Hopefully, budget should provide some, big benefits. So I think for a 12 to 15 month time frame, please hold on.
Suzlon Energies is the counter. 50 shares bought at 59 a piece. Buy additional shares at this juncture. Vaishali?
Buy near 52 and 53 and keep a stop loss of 52.
Okay. All right. Very quick view. Hindalco bought at levels of 689. I know you've already told us about this, but the last trading price at 610, I believe. Would you hold on at this point, Vaishali?
Hold.
Okay. All right. We slipped in one sneakily at the end. Vaishali and Avinash, thanks so much for joining in, for answering all of the questions that you did. Pleasure having you on the program. All right, and that brings us to the end of this edition of Ask Profit from Mahima and myself and the team that put this show together. Thank you so much for watching. Lots coming up over the course of the day. Do stay tuned. This is NDTV Profit.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
This January, the world will come together at the World Economic Forum at Davos to bridge differences because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
everyone. With Budget 2025 right around the corner, there is one question on everyone's mind. Will this finally be the year salaried individuals get some much needed income tax relief? Let's dive into the story behind the tax slabs, the rising cost of living, and why economists are calling for reforms. First things first, Budget Day is set for 1st February 2025. Expectations are sky high, especially among salaried individuals. But before we talk about predictions, let's rewind a bit. The first big moment for taxpayers was back in the Union Budget for FY 2020-21. That's when the government introduced an optional personal income tax regime with lower tax rates but fewer deductions. Remember that? It shook things up for taxpayers who had to choose between the old system with deductions or the new simplified one. Fast forward to 2023 budget, Finance Minister Nirmala Sitharaman made some tweaks to the new tax regime, expanding 2 income tax slabs and increasing the standard deduction from 50,000 to 75,000. Sounds promising, right? But here's the thing. It didn't touch the old regime at all. So what exactly is standard deduction and why does it matter so much? Think of it as a fixed amount you can subtract from your taxable salary. It's meant to help with everyday work-related expenses. While it's been raised over the years, the question is it enough to combat the rising costs we're all facing today? Did you know the standard deduction was actually scrapped back in 2005, but it made a comeback in 2018 at 40,000, and since then it has been climbing steadily. Now economists have a big ask for Budget 2025. Cut income tax rates. Why? Lower taxes means more disposable income in your pocket. That extra cash could boost savings, increase spending on essentials, and even revive demand in sectors hit by sluggish consumption. Sounds like a win-win, right? In fact, during a recent pre-budget meeting, experts suggested exactly this to Prime Minister Narendra Modi, arguing that it's time to ease the financial burden on taxpayers while stimulating economic growth. As per an NDTV Profit exclusive, the upcoming Union Budget could bring significant income tax relief with potential modifications.
Hello and welcome. You're watching KYC, which is Know Your Company, and today we're going to focus in on a software company, New Gen Software Technologies. The stock has been a 16 bagger or 15 plus bagger since the day of listing in 2018. But of late has come under pressure due to its Q3 numbers. We'll try and delve deeper into everything that's transpiring. First off, with regard to the company, and let's stick to the basics first. It's a global provider of software product development, and it drives digital transformation through a platform. It also provides services around Gen AI as well as cloud, and it got listed in February of 2018. Just to try to understand this slightly better, I'm going to try to help that. One was incorporated in 1992. It's a application development platform company. A large chunk of its revenues, so around 54%, is annuity, 60% as of FY24, and 45% is largely software as well as implementations. You will have sale of products as well as sale of services, which will comprise the balance in terms of the revenue mix. The worry here has been with regard to growth in the annuity business, whether that comes back in a big fashion, how quickly can it revive, or whether the larger focus will be on sale of products, sale of services. Then what does that imply to both margins as well as growth prospects for the company? That's something we'll want to really talk about. But basically that's the real breakup, and that's why the stock has been under pressure as well. So we'll try and break this down a little bit better. And for that I have with me Rucha Somaya, who tracks IT quite closely. and she'll obviously take us through some of the metrics that we look at, and let's pull those up as well. You'll have the income statement, the balance sheet, the cash flows, as well as the return ratios that we will talk about, and how the company has fared over the last 3 to 4 years maybe, the shareholding pattern as to what's happening there, the street credentials as to what's happened to the stock price. Yes, over the last maybe 2 to 3 trading sessions, it's been under a lot of pressure, but outside of that, it's given very, very strong returns, as I did say. Then you have street coverage as well as valuations, which we will talk about. All of these key and essential to understand companies that you are investing in, and that's basically the goal that we are trying to solve for through this show. Let me welcome on board Rucha Somaya for exactly this. And Rucha, talk to us about how the income statement for this company has evolved, and what are the finer metrics with regard to Q3 in particular that is standing out, that has left the street a little bit disappointed?
Yes, Harsh. So as you rightly mentioned, most of this, the business of it comes from annuity, about 60%. So that was majorly the problem in the third quarter, because annuity revenues were not seeing growth. And even if you look at the kind of revenue CAGR that this company has provided over the last 3 years, the compounded annual growth rate at 23% might seem good, but is not healthy when you compare that with peers. EBITDA, again, a 3-year CAGR of about 15%. Again, not a good sign over here. And if we particularly talk about the Q3 numbers, as Harsh also mentioned, annuity business is the business which is, 60% of the total revenue proportion, which did not do well in the third quarter. And that is why the stock has been tanking. Even yesterday and in today's trade is down about 9% in trade. This was largely because of longer execution cycles affecting growth. Now remember that most of the IT companies also mentioned about how the execution cycles were long 2 quarters back, but they were really optimistic about how clients will make decisions after they talk about the CY25 budget. But this clearly was not seen with New Gen, and that is why the stock has been tanking, Harsh, because of their third quarter numbers. So overall, a thumbs down in case of income statement check.
Okay. If we can quickly focus in on the balance sheet as well, and let's pull that up. We're looking at equity capital plus reserves. Currently, equity capital is 140 crore. Reserves is around 1070 odd crore. So you're looking at total equity plus reserves of roughly 1100 to around 1200-ish crore. That's the kind of number you're working with. You're also looking at borrowings, which are currently at around the 37 crore kind of mark. So very, very healthy in terms of the profitability that the management has delivered, which is reflecting on the equity of the company. And you're looking at borrowings, which is just very small in comparison to the overall equity. So a large part of the funding cost comes through equity. I also want to quickly highlight that the liabilities have gone up as the business has scaled, and there is a certain 300 odd crore of current liabilities which lie in the balance sheet as well, along with all of this. Again, looks like a healthy set, because you're looking at very, very large amount of equity versus some of the other liabilities that are there on the balance sheet. And even in terms of cash and cash equivalents, if we can pull that up, looking at a healthy 330 odd crore of cash, plus you have investments of another maybe 350 odd crore. So your total cash plus investments that the company is sitting on is 700 crore, which is again a fairly large balance. And not surprising, right, Rucha? Some of these IT companies generally sit on very large cash balances in any case, and therefore this is not much of a surprise, but it's healthy nonetheless. So definitely a thumbs up on the balance sheet side of things.
You're right, Harsh. So generally, most of the IT companies are debt-free only, and that is why they are, called as a cash cow, or yes, a lot of shareholder returns is where they are compared. But let me then get on to the kind of cash flow generation which this company has. If you look at a FY24 number, it's about 264 crore. But to give a comparison, over the last 3 years, CAGR of about 44%, which is healthy enough for an IT company like New Gen, whose large focus is on say annuity or product side of the business. So a thumbs up in terms of cash flow generation. But Harsh, talk to us about the kind of return ratios and then the shareholding pattern as well.
Yeah, so I mean, for an IT company, generally return ratios are fairly healthy in that sense, and therefore in relative terms, you'll see return ratios staying fairly steady at 27%, being extremely healthy compared to other segments. But also understand that IT companies, by their very nature, churn out very, very good return ratios in general. And I'll just pull out a couple of metrics here. The ROCE for a Tata Consulting is around 64%. For an Infosys, as I see it, is 40%. And therefore, when you're looking at the ROCE metric at 27% for Newgen, is there scope for improvement? Very, very likely. But as the business scales, that will likely happen. And therefore, it's a neutral on this one, largely because the growth opportunities lie. But at the same time, the ROCE number in comparison, some of the larger IT peers are definitely slightly discounted in that sense. And therefore, a 27% ROCE, very, very healthy. But nonetheless, you will likely see that number go up when growth starts to spike, which has been the case. But as the company scales, you likely see that number go up. And we'll try to understand that metric also better, Rucha. But it's a neutral on the ROCE metric.
You're right, Harsh, and even as you mentioned that as the business grows, likely that ROCE will grow. But the company itself mentioned that the business is not right now growing, especially the annuity side of the business, because of its longer execution cycle. So this can be a wait and watch for investors who are looking for a return which is actually more than the kind of return which Newgen gives. But let's also talk about the kind of shareholding over here. Free float is about 55%, 54% promoter holds, and in terms of FI and DI distribution, domestic institution holds about 9.5%. Foreign institution holding very, very less, 0.5% over here. And yeah, other than that, 34% to 35% is what we have on the shareholding pattern.
Okay. Also, one quick piece I want to highlight here. The shareholding pattern was approximately 55.2%. It's slowly and gradually tapered down to 55.1 in December and 54.3 in June of 2024. That's something you may want to keep your eye out on. Maybe some bit of that dilution due to ESOPs, but outside of that, it seems like there's also been a wee bit of dilution made by the management, but a fairly steady number in that sense, 54 to 55% in terms of their shareholding. I'll move on to Street Cred. The performance has been fairly solid when I'm looking at it over the longer term, but let's look at it in the short term and try and understand what to make of that number. The last month, of course, has been a tough month for Newgen. The stock is down 22% from the highs. The last 6 months, the stock is up despite this 22% of underperformance over the last month or so. You're seeing the stock up 21% in the last 6 months, and the one-year returns are also fairly solid at 52%. No question about the 5-year returns. It's been a 10-bagger in the last 5 years, and therefore definitely warrants a thumbs up. But the last few days, you've seen a bit of a correction, and that's where you may want to start understanding this company better to try and understand, is there an opportunity here? Anyway, Rucha, on to credentials. We've spoken about credentials, beg your pardon, but on to street coverage.
So as you rightly mentioned, 14% over the last 6 months, and this is the kind of return potential which the street is giving for the next 12 months. So not really a great picture over here, which the analysts are expecting. 4 buy calls, 2 hold and 2 sell each is what we have. But let's move on to the valuation perspective. A thumbs down over here as well, because of it's around 58 times its FY25 or let's say even a little more extended over the next 4 quarters valuation. If we talk about peers, OFSS at 48 times, Birlasoft at 25 times, might seem to be more, return reward attractive, but high valuation gives this one a thumbs down over here. But talk to us about the SWOT analysis, Harsh.
Yeah, before we go to SWOT, let's just sum up all these metrics and try and get a clear picture as to how this company is stacking up in terms of all the metrics that we've just discussed. And there you go. You've got the income statement. Not exactly negative, because what you are seeing is a decent growth on the top line, but your annual revenue has seen some bit of pressure. Good to take perspective and understand as to why that is so. Balance sheet is extremely healthy. There's very low debt, and therefore the risk there is very low. Your cash flow has compounded at a healthy pace as well. Your return ratios are neutral because some of the competitors are doing better for sure. And of course with scale that might likely play out as well. You have shareholding which is neutral. Management holds 50% plus, so fairly decent holding as well. You're seeing street cred as definitely a positive. The outlook and the returns that have been given have been extremely good. Your street coverage is a neutral. Few brokers cover it, and you have just about a 14% upside in comparison to the kind of upside that the stock has already given. So it's a flattish kind of upside because it's been a 10 bagger in the last 5 years, and your valuation is definitely on the more expensive side, given that it's one of the smaller IT companies. And 5 out of 8 is the rating that we give on Newgen Software on the back of all of that. But let's quickly go across. We have Virender Jain, who's the CEO at Newgen Software, who's joining us to talk to us. Welcome, Mr. Virendra Jeet. Sorry, I beg your pardon, I got the name wrong. Virendra Jeet. Mr. Jeet, good having you here. I want to first understand from you as to what's led to the slight bit of softness on the top line in Q3 FY25, and does this at all change the outlook going ahead for you, maybe over the next 2 to 3 years? What can we expect in terms of outlook?
Good morning, and thank you for having me here. And you're absolutely right. I think we have been growing at a very healthy rate for a very long period of time, at least 9-10 quarters, consistently above 20%. And as you think, we also we want to maintain a historical growth rate of above 20%. And this is the first quarter which has been below 20% after many quarters. Having said that, if you look at 9-month numbers, we are still above over 20%. We are more close to 23% growth. And I think, as I earlier informed on what has really helped us, while the new deal win ratio has been extremely good this quarter, you will see the license revenue has grown by 70%. Our annuity models, which are typically a fallout of our implementation completion and then the ATS and the support revenues, they have slightly gone down because of so the larger implementation cycles over some of the orders which we have got over last 1.5 year. And this has really led to that the new deal momentum has not really compensated for the gap in that. We don't see this as a permanent issue. We think that these execution things should get sorted over a couple of quarters, and the normal revenue streams of annuity should start compounding again. Today, I think we are almost at the lowest of it's almost like 9% YoY growth on the annuity part. I think over next 2 quarters, we should see that gradual improvement in that, and in 3 to 4 quarters, it come back to the growth rates. Having said that, we are still looking at maintaining our growth rates and we want to compensate through new deal acquisition in terms of getting more and more deals in the market. The marketing is looking healthy for us. Our traditional markets are performing well. APAC is right now leading from front, but it's also a smaller base of revenue. And US is where we are investing and we're trying to crack that puzzle.
Mr. Jeet, just a quick follow on. What's led to the softish number, and what gives you the confidence that recovery will happen on the annuity part of your business?
Yeah, so I think let me again explain. So if you look at the numbers, I think our business generally follows about new deal acquisition because all other revenue streams are downstream. And if you look at the new deal acquisition has not softened. In fact, it has accelerated. What has softened is typically once the new deal gets implemented, we have 2 more revenue streams kicking in, which is the support and the AMCs. Those have got delayed for a substantial amount of time due to larger implementation cycles, especially in some of the larger orders which we have taken over the last 2 years. Now, this is a phenomena which does not, because finally these executions have to resolve. They will take their time, and finally the revenue streams will kick in. So there is no reason that they should not kick in. On the other side, most of the deals which we have taken over the last 2 quarters and are now taking don't have these challenges. They are shorter implementation cycles, and they should start following the traditional cycle. So I would internally believe that this is a one-off, example of couple of quarters. It is not going to last beyond that. I'm gung-ho. I'm bullish about the business because our deal momentum continues to be good. So we keep on winning across all territories. We are investing in growth. And I think you will see that from the kind of license wins and the deals wins we also managed in this quarter. The other thing I think which is very cautious, we keep on advising everybody to look at business on an annual basis, because we are still at a revenue number of roughly between 1200 to 1500 crores. A single deal in a quarter can change numbers drastically. Both it can be in the positive side as well as in the negative side. So I would always advise to look at this company in the numbers and annual number basis. And we have maintained that we should have always a potential to grow about 20% annually. And I don't think there's any reason why we can't continue doing that.
Okay, thanks for that, Mr. Jeet. But you talked about the longer execution cycles. Other than the shorter ones which are there in the pipeline, I want to particularly focus on the longer execution cycles. So, most of the clients, as you mentioned, are talking about how the decision is getting delayed and pushed out. So that can be because of the macroeconomic uncertainties as well, and no one is sure that will recover, right? So by the time a longer execution is still pending, revenue growth will not come back, right? So then the picture for the near term is a little bit hazy, don't you think so?
No. I think what we understand, I think it has nothing to do with execution cycle. These are only businesses which have been won and are in execution. And part of our revenue, if you understand, I'll again explain the way our business is. We end up selling our software licenses, followed with implementing those licenses. And as soon as the implementation is in process, our two important revenue streams kick in, which is the ATS, annual technical support, which is roughly around 18 to 22% of our license, and followed with additional support revenue. These two streams don't kick in unless the implementations get covered. We don't need, for implementation, we don't need new contracts or new permissions from client. We need to execute them and get the completions from that. So I don't think these are the economic scenario is linked to the past business. The economic scenarios or decision-making cycles can link to the deal acquisition velocity, which we are getting in future. In that case, right now, we are not seeing too many challenges in that, especially in the emerging markets. We don't see the challenges which we have in US and Europe. So we continue to win these markets. And we are hoping all that the US resolves itself and we are getting slightly more better momentum in the US. I hope that clarifies.
Yes, it does. It does, sir. Want to understand how margins will evolve, both on the EBITDA side as well as the PAT side. Your EBITDA margins got better as a result of everything that's transpired this quarter. Likely that they will come off as revenue starts to normalize, maybe next quarter onwards or the following quarter. So my sense is, or from whatever you've been saying, it will take a quarter or two for revenue to come back, and therefore margins will come off as a result. How should you see the margin trajectory as well as the PAT margin trajectory?
I think, we are a company which always invests for growth, and so our costs are slightly front loaded. So in the beginning of the year, over many years, we have been projecting always for a higher than 20% growth. So our costs are always pegged between 17 to 20%. So any annual growth rate which is above 20% will keep on expanding margins. So I think for even this year, you have seen the margins have expanded. Our PAT has grown for 9 months to 40%. And for the quarter, it has been at 30%. So, so I don't think the Q4 can make significant impact on the margin and the PAT in such a way. Having said that, what we keep on doing is that the function of business, as we grow, the margins do expand because it's a 65% gross margin business. And between our license and ATS, 50% business has no direct costs. So they're typically what you call extremely high gross margin businesses. So with every little growth, you will have expansion of margin. But on the other hand, product companies do have to invest aggressively in sales and marketing and R&D. Today, our investments are roughly around 10% in R&D and roughly around 22% in sales and marketing. With increased growth and increased expansion, we will keep on increasing our investment in sales and marketing and R&D to make sure that we keep on capturing and maintaining a higher growth momentum. So I don't see margin challenges if the company keeps on performing at a growth of 20%. Any year, if we crash below 20%, which slightly, the less likelihood, but if case it happens, in those years, we will have flatter margins or even a decline in margin.
So you're investing, or rather you're spending on marketing as well as building your products. Yes, R&D. And therefore, this 10% and 22% or that the numbers that you gave, is that on top line that you spend annually?
Yeah, that's on the top.
Okay, understood. And do you capitalize that cost? So therefore, does it get built into your ROCE? I'm just trying to understand how return ratios will work.
Our all costs are taken in the P&L.
Understood. And therefore, your ROCE will continue to remain elevated and only get better from here as your top line grows?
I think, see, this is a function of typically the product companies. Basically, they keep on improving on all numbers as they grow, as they become larger, because that's the function of their business. So we do hope to continue keep on improving all these numbers. But we also, unlike we have also, our purpose of building this company is to keep on making a larger company and take larger global share and our place right at the table. So we keep on investing in R&D and keep on investing in sales and marketing. And but our, in terms of a guidance that as a kind of a prudence, we do want to maintain a healthy net margin of roughly around 20% and roughly around 23% EBITDA margins. As long as we are there, we feel comfortable. Beyond that, we keep on investing on growth.
Thank you so much, Mr. Virendra. It's been great speaking with you, understanding the business as well as the Q3 numbers and the outlook going forward. But out of time on this one, honestly, from Brucha, myself, everyone who puts the show together, thanks so much for watching. And we hope you found this productive. Stay tuned to this show, KYC, as well as more on the other side. Stay tuned to NDTV Profit.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
I present the budget for a historic
Well, Budget 2025 is around the corner and Macquarie has come out with its budget estimates or expectations on each sector. The first sector is the banking space. They do not expect favorable treatment for deposits and possible capital infusion for PSU banks and insurance companies might take place. Moving on to the next sector, NBFCs is the counter. Credit guarantees similar to SMEs for MFI sector can be expected. In the insurance company space, that is the next sector to watch out for. No change in tax rates or any product or any corporate profit tax rate change can be expected in this budget of 2025. The next sector to watch out for will be cement and metals, where they are expecting announcement on import duties to restrict imports on certain metals and certain materials. Moving on to the auto space, outlay for PM E-Drive and PLI can be expected. Policy initiative to drive localization of key EV related parts can also be expected. The next sector in focus would be the consumption space. Mid to high single digit increase in cigarette taxes can be expected. The budget, interim budget which was announced last time did not have any tax rate change in cigarettes, which is why we did see an uptick in stocks like ITC and VST. But this time you could see mid to high single digit increase in cigarette taxes. Reduction in taxes for low middle class consumers could take place, which could boost consumption in the rural as well as the urban spaces. Moving on to the next space, jewelry is the space where no reversal of custom duty cut on gold will take place. In last budget, there was a custom duty cut announced on gold, silver as well as platinum. There will be no reversal on this as per Macquarie. Moving on to the next space, Pharma and healthcare, potential support for higher R&D via tax reduction can take place, and PLI for anti-diabetic and weight loss medication could also be one of the factors that the budget might consider. And modest increase in allocation for Ayushman Bharat is something that Macquarie is expecting from the pharma and the healthcare space. Infra is the next space. Capex allocation for key ministries like railways, roadways, etc. Can be expected in this budget, and announcements around additional dedicated freight corridors can also be expected in this budget 2025. Defense is another area where initiatives to boost defense exports can be expected, and announcements around that will be expected, and initiatives fastening domestic defense equipment procurement could also be one of the things to watch out for in this particular budget. Lastly, in terms of power, green energy thrust to continue. Steps to promote initiatives across the value chain, that is to promote green energy, might also be seen during this budget. Oil and gas is the last counter where Macquarie expects that OMC's compensation for LPG under recoveries might be seen. So these are Macquarie's expectation on different sectors as to how budget may come out with different changes in different sectors and how it may impact these sectors.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims?
Hello and welcome to NDTV Profits. You're watching Markets at 12 and my name is Rucha Sumaya. Let's have a quick look at the markets right now. Well, very volatile day of the markets. If we currently have a look at the Nifty 50, it is up in the green but marginally as we speak right now. Off the day's high, nearly at day's lows is how I will put this one. Nifty IT is also doing well in trade, up about 1.5%. Yes, there you go. Banking index is very, very volatile, down about 0.5% versus up about 1% in the green a couple of time back. Let's have a quick look at the sectoral heat map as well. Up in the green, we have sectors like Nifty IT. Yeah, that one is the only one in the green, but down in the red we have Nifty Realty, Media, Energy. Realty is the one which is losing the most, but let's also have a look at advance and decline ratios. Definitely in the favor of a decline as we speak right now, and clearly it is a straight picture over there. Almost 1:6.1 times is the kind of decline is what we can see right now. Let's have a quick look at the constituents of the Nifty 50 index. Down in the red we have a BEL, Tata Motors, Trent also down from its 52-week high of 8,000 levels. But up in the green, we have the likes of IT names, Infosys, TCS, Sun Pharma as well right now. Let's have a quick look at the Nifty IT as we speak, the kind of constituents that are doing, actually persistent is the one which is losing the most, 7% down ahead of its third quarter results today. Coforge is also down in the red ahead of its third quarter numbers. But the one which is doing well is Wipro and Infosys. Remember, Wipro also had great results, after which the stock was up around 7%. Quickly having a look at the banking index, the constituents over there. Well, down in the red, we have the likes of AU Small Finance Bank. PNB is falling in trade, Canara Bank. But up in the green, we just have HDFC, just thereabout, trying to maintain its stance in the green. But let's shift focus to stocks in particular. Cyan DLM, which is cracking post its third quarter numbers, is down about 11.5% in trade. Near to the day's low, but what is actually making the stock tank today? We have Varsha who joins in with more details. Varsha, please take it over.
The only good thing about the Q3 numbers were revenue, which did beat estimates. But if you see, margins and profits were down by one-time acquisition of Altech, which is a US-based company. But the concerning point here is their order book. If you see, order book excluding acquisition has fallen quarter on quarter, and over the past few quarters it has been falling down. So one thing is that if I were to talk about the EBITDA, so EBITDA saw one-time impact of rupees 8 crore due to the one-time expenses related to acquisition, and profit also saw one-time impact of rupees 5.9 crore post-tax, and this expense was led by acquisition of Altech. The other key highlights, their net working capital stood at 120 days versus 127 days, which was on a good side. 3 large deals are at advanced stages, and pipeline is in excess of $1 billion. Order book stands at almost 2,000 crores versus 1,900 crores quarter on quarter, but this order book is inclusive of the recent acquisition that they have done, and organic order books saw a decline on quarter basis, a key concerning point for the company. If I were to talk about the conference call highlights, so they've announced acquisition of Altech in the previous quarters, and political developments will actually present an opportunity for localized products production for the company, and large contracts that they signed last year are showing traction, and on-ground manufacturing in USA will help growth opportunity for the company. Now this is in terms of the acquisition that they did, and they're seeing a pipeline of $1 billion in terms of opportunities. And lastly, they do not need any kind of capex. They have huge capacity expansion that they've done.
Okay, thanks for that so much, Varsha. But the focus these days is around the two food delivery, or I should say quick commerce name, which is Swiggy and Zomato. Well, Swiggy is down to its 8-week low post its first worst drop since the time it got listed, down about 3.5% right now. And if we can also pull up how Zomato is doing, well, Zomato is also down in the trade because of its poor third quarter results, and quick commerce, which was the new favorite of the market, seems to be very competitive and hitting bad to these two food delivery names. But we have Mahima who's tracking these stocks very closely, and there's an Incred note on this one. Mahima, talk to us about what the note is talking about. Is there any potential for these two stocks going ahead?
They've initiated ad rating for both Zomato and Swiggy, with Zomato with a target price of 270 and Swiggy with a target price of 540. They're saying that the monthly transaction user runway is still on a good runway, and they're saying that it's a blue sky scenario, suggesting a long-term runway going ahead. Now, in terms of large opportunity in food delivery, profitability will support in terms of expansion in quick commerce, and this scale and platform play with structural growth drivers in place. Now, quick commerce opportunity is large enough to accommodate several players again, but for them, they prefer a Zomato over a Swiggy, and cash cow food delivery could support quick commerce business growth going forward. So what they're saying is that they're penciling in growth of quick commerce, but going forward, food delivery could support quick commerce, but it will be a cash cow going forward. And advertising revenue and monetization could also aid the take rate for both of these companies. For Zomato, they've said that leadership in food delivery business business, with better control over unit economics and potential EBITDA break-even in Blinkit could help offset the rising competitive intensity and capture share of incremental profit pool, which is why they're more bullish on Zomato. And they're saying that for Swiggy, early success of Bolt platform, improvement in food delivery execution, and doubling of the number of dark stores could help capture market share for them, and this could also give them incremental growth in terms of quick commerce. So very interesting note, and these are the couple of reasons as to why InCred is bullish on both Zomato as well as Swiggy.
Okay, well, InCred seems to be bullish, but the stock seems to be down in the red. But let's move on to our next story, which is the Lodha brothers. Well, these are the most recent entrants in the growing list of high-stakes family disputes involving listed entities in India. Now, this is following the Kirloskar and Kalyani family disputes. Charu, who has tracked this story very closely, brings us more details on this one. Charu, please take it over.
Hi, so as you rightly said, this is the era of a lot of family disputes. Some of them are around intellectual property, some are about the control of a particular listed entity, and some are about allegations of mismanagement. Now, currently we are in the middle of a very interesting dispute which stems from the usage of a surname as a brand, which is the Lodha real estate company, and it is the brand that everybody has been trusting, especially in places like Mumbai. So why are we listening to it about it? Why are we looking at the case currently? So Lodha versus Lodha, these two brothers separated back in year 2017, and they divided their assets and businesses and decided that they are going to go their separate ways. However, another agreement was finalized between them in the year 2023, where they decided that they will not be using the name Lodha collectively. One of them, which is Abhishek Lodha, is going to be using the name Lodha for his legacy businesses, whereas the other brother Abhinandan Lodha is not going to be able to use these names. However, it has been claimed by a macrotech developer group, which is Abhishek Lodha's group, that Abhinandan Lodha continued to use the brand name despite being asked not to, despite being in an agreement to not use it, and that is why he has also claimed a hefty compensation of about 5,000 crore rupees from the Bombay High Court for this infringement. Now we are coming at a point where the court will have to decide whether in an intellectual property case someone can be stopped from using a particular surname in their businesses, in their brand names, and let's see how it plays out.
Okay, well, thank you so much for that. But shifting focus, let's a review coming in from the Investor Corp's Rishi Kapoor and JSW Group's Sajjan Jindal on the impact of the Trump 2.0 and what lies ahead straight from the World Economic Forum at Davos.
Well, you know something, right? People often say this half-jokingly, but there's probably an element of truth to it, which is President Trump, to some extent, one of his own KPIs to monitor how successful he is in rolling out his policy agenda is to see how the markets are performing. So to your opening question, which is it a great time to be an investor? The answer has got to be yes, because the largest capital market in the world has a new administration in place that are very focused on the economy, on its growth, not just over a quarter or over a year, but over a longer run period, and achieving that growth in a manner that is truly benefiting the grassroots person, across the length and breadth of the United States. So, that certainly is encouraging, but even more encouraging to your other point, Neeraj. I was similarly encouraged by the fact that one of the biggest wild cards that we were all acknowledging is an uncertainty heading into the inauguration, which was tariffs and the impact on, in particular, the trajectory of inflation and interest rates as a second-order effect. Where will the administration come out on day one? And the fact that President Trump, stated, a very prudent point of view, thoughtful, which is, look, we need to assess, we need to investigate, we need to analyze, we need to evaluate. And based on that, we will decide what we need to do. And it probably also signals, therefore, that's not going to be a one-size-fits-all, right? I'm not in the camp of assuming that just because no tariffs were announced yesterday, we are done. That's not the case. That would be naive.
Yeah.
But I am encouraged by the fact that there is a degree of prudence, seems to have been embedded into the administration's policy agenda.
Okay. So what is it, I mean, so for a large global investing firm, what does it mean for investing in the US? Because it's been 2 years of US, as you use the term, exceptionalism, right? Do we see a year 3 or will 2025 be different? 1, from a perspective of investing in the US, and 2, from a perspective of investing across the rest of the world.
I think that's a great question, Neil. So, first of all, I think the baseline expectation has got to be one of continued US exceptionalism. Okay. Not just because of the change in administration and their views towards making the US a more business-friendly destination for capital investment, but also because of the significant lead that the US has in the field of technology, specifically technology, but also energy. As President Trump pointed out, they are sitting on huge reserves of energy. They can actually be a low-cost producer of energy and benefit their manufacturing sector accordingly, and so on. So, the way I think about this is it's a macro and a micro assessment. From a macro perspective, acknowledging that US exceptionalism is likely to continue in 2025, clearly the US is a macro tailwind. There are 2 other markets with a similar macro tailwind. One that you and I are both very close to, being India. I think for understandable reasons, we can get into that. And the second is the Middle East, the GCC in particular, which we can also do a double click on. 2 other markets that are not benefiting from macro tailwinds, but do present some very interesting idiosyncratic micro investment opportunities, whether in select countries or sectors or even individual companies, are Europe, because it's not a one size fits all in Europe. In fact, Europe has a headwind, right? But select sectors in Europe, select companies in Europe, select countries in Europe, we would definitely, and we are investing in select asset classes. And the second is China. China is the second largest market in the world, right? Whatever we say about China in terms of slowing economic growth, etc., there are pockets, in China where they have unquestioned leadership, right? Including, clean tech, right? Climate tech. So China offers, in certain domains, a very attractive risk reward, but very selective.
Yeah, I was going to come to that too. By the way, so Europe, it surprised me when I looked at the stats about how well has Greece, has Spain, etc. done in 2024. We forget that it's not just Argentina or some other markets, but even some of the European markets which have done well. So quite exceptional, really. But China, Rishi, the larger view seems to be that people go in and eventually burn their hands and come out unless you know China very well and know what to pick within China. So it's not buying China as a market, but buying specific pockets in China.
And in addition to, looking at the right pockets of investing activity in China in particular, it is most important to align yourself with a local partner. Okay. It's not enough to go in as a foreign firm and just hire people from within China just because they happen to be China. What is, I think, more impactful in a good way is genuine partnership with Chinese institutions that are not just plugged into the ecosystem, but have a clear following, an understanding of the local market, the flows, the sentiment. That is to some extent for a foreign firm hard to discern, right? We entered India, as you recall, with a very similar mindset. We said just because a few of us happen to be of Indian origin, that doesn't mean that we understand the Indian market. Yeah. That's why our entire team in India is local, right? They grew up there, their entire investment experience base is there, they know the entire ecosystem of stakeholders, whether it's promoters, owners, investors, the accounting firms, the lawyers, etc. And that really helps. Same thing, you need to be able to replicate in China, and the most expedient way to replicate it is through partnership with a local firm. That's what we did. We partnered with China Resources Group, we partnered with China Everbright, but most importantly, recently, we partnered with CIC, with the largest, wealth fund out of China.
So knowing Trump, it's no surprise that he's the most. If anything, he's the most uncertain person, right? So he can do anything, anytime. So that's his nature and that's his style and that's what he thrives on, right? So that's one. But talking about what impact he could have on India, so I'm not sure because I don't think India has at least my industries are not dependent on the exports to the United States, and therefore I don't see much of an impact that my group will have on if there were more tariffs from the US. We don't export anything to the US. Right. Whereas we have businesses in US which will benefit from tariffs because the US prices will go up, and hopefully that will benefit our business in the US.
Sure. But sir, you're a large captain of India Inc., so to say. From that chair, not from a JSW chair, how do you view this impacting Indian businesses, or do you believe that it could actually help them thrive simply because it could enhance the China Plus One story even more?
Yeah, so given the uncertainty of Trump administration's decisions, if at all, it will help India, in my view, because India is a friend. He considers India a friend, and he's very against China. But he could change that as well. You never know him. But whatever I know of him, he's not very friendly with China, and today China is selling all the products into the US, and any restriction that he will bring on Chinese goods will help China Plus One or China, one minus China.
Got it. Okay. And speaking of China, and I also want to come to this whole concept of globalized organizations, WTO, etc. I believe you have some thoughts there, but before that, just a view on what China is doing, can do, and cannot do, and the impact on various industries, including the commodity industry, because it has far-reaching implications on what commodity prices do, right? What are your thoughts, Mr. Jindal, on that?
No, so let's understand China. China has got a huge capacity built up in their country over the last 20, 25, 30 years. China is become the factory of the world. On the commodity side also, they produce over 50% of steel, over 50% of zinc, over 50% of copper. So you name it, and they have over 50% of the world capacity lying in China. Now China is obviously slowing down, and they are not consuming all that what they're producing. So what they're doing is that they are trying to capture other markets in the world and trying to export those surpluses that they have. And when they want to export, then they are doing it at marginal cost or below marginal cost. Therefore, what it is doing is that the countries like India, which has to build new capacity, is not able to compete. And the industry in India will not make money, and therefore they will not be able to invest to rebuild or to build more capacity. And we will then perpetually depend on Chinese imports. So that's what our government, they don't want it, and neither the domestic industry want it. So therefore, we have to have some protection from China and the products which gets circumvented. The Chinese products comes through other countries into India. So that the government has to be smart and has to protect.
I'm sure you have the government's ears, right? So in some sense, Mr. Jindal, is there a political reason or an international reason why some of these tariffs, which seem obvious to so many people, can't be levied in the shape and form that people believe is the right way to do?
So yeah, there are a couple of reasons. One is that the government is bound by the world WTO rules, and so therefore they just don't want to dismantle that whole system. They are working to find ways and means how to manage within the WTO guidelines and stuff like that. That is one. Second thing is that there is a thought process within the government that the small scale industry or MSMEs, they will get more expensive commodities. If we block China, or if we reduce, or if we put tariffs, this domestic prices will go up, so they think that they will get hurt. But in reality, that won't happen because there is enough competition within India. But I'm only saying that when there is an unfair competition, so that needs to be looked into by the government. And there are various methods, various things which government can address, through which government can address.
There's some mention this morning, CET time, about China trying to do some bit of stimulus measures. Now, the balance sheet of that country is a bit of a black box. You never know what it can or cannot afford. What's your best estimate or guesstimate, sir, about how much can China stimulate and the implications thereof for even your industries?
So China keeps coming out with their stimulus. If you have observed China over the last 2, 3, 4 years, whenever there is a slowdown or whenever there is a problem, they come out with a stimulus and try to revive their industry. So I think I won't be surprised if they come up with another stimulus to revive their industry, because their inflation is very much in control and their currency they keep depreciating to handle the exports. So therefore, I don't see them to not provide the stimulus.
Okay, because if they don't do that, then it results in fears of more dumping of a lot of goods, which might not be something that industry in India would like per se.
Yeah, that's true, but we should not really depend on what China does. We have to move into a situation where we have to take our own thing in our own hands. We have to, put like what the US is doing, they are putting tariffs. What Europe is doing, they're putting quotas and tariffs. Why can't we do it? We are a big manufacturing industry. If we are serious about our manufacturing base to increase to 25%, then we have to protect our industry and let the industry grow to that stage where it can, take head on the Chinese onslaught.
Got it, sir. Okay, a few questions on the group as well. I mean, let me start with, your plans for steel, ambitious, well-known. You reckon, independent of what happens in China, the global demand and Indian demand would lead you to meet the targets that you set out for yourself? There's a lot of talk also about how at the peak of the cycle, steel companies tend to announce expansions only for them not to meet at a later stage. Would just love your thoughts there.
Yeah. No, so we have announced that by the turn of the decade, by 2030-31, we will be a 50 million ton steel company. Now, at the moment, as we speak, we are 35 million tons. So that expansion will happen. I don't think there is any roadblocks to that expansion, because this is all brownfield expansion, all lined up, everything. But I would like to see JSW Steel grow faster than that, and that calls for support from the government in not allowing Chinese steel to be directly or indirectly dumped into India. That's it. That's what we need.
So that's straight from the World Economic Forum. But before we wrap on this edition of Markets at 12, I want to alert that it's just 9 days left for the budget 2025. And what should you expect from the budget this time? How should you trade, and how can you profit from the expectations and the budget of 2025? We'll record a video message of your questions and send it to us on WhatsApp. Your questions will be answered by a panel of top market experts, which includes Ramesh Damani, Prashant Khemka, Gautam Shah and more, only on NDTV Profit. So do that right away, but stay tuned to NDTV Profit. Lots more action on the other side.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about three key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold, into the mutual fund industry over the past couple of years, will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate, and what that means is that depending on which income slab you fall in, if you're in the highest tax slab and you're paying 30% on the income above a certain threshold, your gains from debt mutual funds are also taxed at 30%. That wasn't always the case. Long-term capital gains came into effect after a period of 3 years, and they were taxed at 20% with indexation benefits. Of course, that doesn't remain the case anymore. So the mutual fund industry is asking for a rollback to the previous tax treatment because they say that the debt market in India is growing, is emerging, and it needs to be incentivized. The third change that they're suggesting has to do with the income distribution schemes. Of course, there are two types of schemes in mutual funds. One is the growth scheme, where all gains are reinvested by the fund manager. And in the second case, which is the dividend distribution scheme as it used to be called, the income is distributed on an ongoing basis to unit holders. Now, the thing is, income above 5,000 rupees that is distributed in this manner will have to have tax deducted at source, or TDS, as things stand right now. And the mutual fund industry is suggesting that this threshold be raised to 50,000 rupees, and they expect that this will benefit a lot of people because they won't then have to have tax deducted at source. Of course, there are more proposals that they've made, but we'll see what the finance minister takes up when she presents her budget for 2025.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential.
Hello and welcome to NDTV Profit. A very good afternoon to all the viewers. You're watching Profit Buzzers. I'm Hiral Tatia, and with me is Varsha. Varsha, clearly good afternoon. An interesting day of trade for the markets after the kind of sell-off that we saw in yesterday's session. Today also the pressure continues. We're again testing that 23,000 mark in trade. Pretty much flat but near the day's lowest levels. Let's quickly pull up Nifty 50 as well as Bank Nifty. Post that. There you go. We are at the day's lows right now. 23.21 is what we're looking at. We tested 22,989 in intraday trade today. Bank Nifty is also seeing cuts of almost 0.7%. You have HDFC Bank that will be reporting numbers shortly by around 1 p.m. So that's going to be a key aspect we should be watching out for, because that could put pressure. It's trading with gains of almost around 0.2%. Yesterday, it was one of the top losers. Let's pull up the sectoral heat map to understand what are the sectors that are losing out and where is the pressure building in. You have IT, which is absolutely resilient today with gains of 1.3% coming in there. And what's interesting is that it's mainly the large cap IT stocks which are trading in the positive. There is some bit of pressure with regards to the mid-tier as well as the small cap IT majors in today's session. Apart from that, real estate, a 4.5% to 5% is the kind of cut that we're seeing on that sector. In fact, that's going to be one of the themes that we should be following up from here on as well. Because from its highs, I think 20-25% is the kind of cuts that has already come in with regards to Nifty real estate. Energy is trading under pressure. PSU Bank is down in trade. Metals, oil and gas, bank, all of them out and about. So that's with regards to where large cap, the sectoral picture goes. If you see the advance decline ratio on Nifty 50 of 20 advances versus 29 declines, let's see if that is the overall market trend as well, because there you go. You have Tata Motors, SBI, Bharat Electronics and L&T which are contributing. But what's holding up is Infosys, TCS, HDFC Bank. These are the names which are actually supporting, and that's the reason why you're seeing that 100-100 balancing act between the Nifty. In terms of stocks, Infi, TCS, Wipro, Tech Mahindra and Sun Pharma, as we mentioned. BL is the top loser there as well. Trent is seeing an exceptional day of trade, 2.5-3% cut today. Let's just pull up a 5-day chart of Trent to see the kind of performance. This is just today's, but let's just pull up a 5-day chart of Trent, because we will have to now do some analysis what's happening. 18% is the kind of cuts that we've seen in the last 5 trading sessions with regards to where Trent is concerned. So some concerns mounting. Maybe it's on the valuation front because the stock had run up also. So that's what the markets are looking like. But clearly, Varsha, similar kind of an aspect that you're picking up in terms of broader markets as well, because yesterday the broad markets were really beaten down. And I think from a valuation perspective, there is not too much of confidence taking that there could be further earnings downgrades as well.
Absolutely, Hiral. So yes, broader markets are actually mirroring benchmark indices. If I were to talk about Nifty midcap 150, it's down 2.2%. Let's see who are the losers. You have Persistent Systems, then you have Prestige, PB Fintech, Oberoi Realty. Well, pre-sales numbers did not meet for this counter. Then you have Macrotech and also Kalyan Jewelers. If I were to talk about the gainers, let's see who are the gainers. You have Indian Hotels, Ashok Leyland, Dr. Lal Path Labs, then Pal Krishna Industries and Dalmia Bharat on the gainers list. Well, if I were to talk about Nifty small cap 250, let's pull up that. It's down again 2.4%. Now the losers, what's under pressure? You have India Cements, the sell-off seen in the stock of the India Cements extended to day 3 with the shares down over 15% to a 6-month low on Wednesday. Well, the numbers were also not that good. Then you have IndiaMart. Well, the concern here is company reported a surprising decline when it comes to paid subscribers. So IndiaMart is under pressure. Then you have Keynes Technologies, Sirma, SGS and Tanla Platforms. Well, Tanla is under pressure on the back of weak earnings that the company has seen. On the gainers list, you have MCX, Easy Trip, Bombay Burma on the gainers when it comes to small cap 250. So clearly, Hiral, broader markets are actually not looking that great.
Absolutely. If the mid-cap 150, almost a 500 point cut from the day's highest levels. I think 1300 point is the kind of cuts that we are seeing in terms of, the overall markets as well. So clearly pressure is building up. What's important to understand from here on, from a few of our guests that we've spoken to since morning as well, is that the earnings is something which is going to see a downgrade from here on in the third quarter. There could be further pain in the in the first and the second quarter of FY25 as well. And probably from there, we will see some bit of a recovery that will creep in. Now, what this means is the expectation of a 14 to 15% earnings growth that, probably fund managers were looking at, that's trimmed down to around 6 to 7 to 8%. And that also is at risk. And that is what the markets are mirroring. 2025 as a year, what fund managers are indicating is going to be a year of caution. the best place to invest is going to be in large caps, avoid mid caps and small caps, and overall BFSI, IT, these are two sectors that fund managers are betting big on as well. So that's what the overall picture is looking like. But let's quickly head across to the key themes today. On number one, we'll have a Q3 review of Cyient DLM, India Cements and Tata Tech. Three stocks that will have reported numbers and are reacting. And you have HUL and HDFC Bank that is in focus that will be reporting numbers in the second half of the day today.
The next theme would be CAPEX and strategic initiatives. You have Newland Labs, Centum Electronics and Geo Financial Services.
Moving on number three, we will be talking about the brokerages of the day. You have Incred, which has initiated an ad on Zomato and Swiggy and still prefers a Zomato over a Swiggy.
Next theme would be big voices from Davos, Anish Shah, Kenneth Rogoff, Rishi Kapoor and Sajjan Jindal.
And you have healthcare sector's budget wish list today. That is what we will get you, what the public wants from the government. But let's first move on to the first theme that we're talking of, a whole host of companies that have reported numbers. Let's first pull up a Cyient on the screens and see what the counter is doing in trade. Absolute pressure, 13.5% downtick. If you could just pull up a one-year chart as well, because from the highs, the stock is down nearly 40% if I'm not mistaken. And the pressure has built in because the margins have been under pressure, and this is on the back of the acquisition that they have done. In fact, my colleague, Varsha over here, who's sitting with me, also spoke to the management. First, let's hear out that conversation and get clarifications from them as to what went wrong and what is anticipated going ahead. Let's hear it.
Yes, absolutely. So, yeah, nice to be here. And yes, as you did highlight correctly, there were some acquisition expenses that we did reflect in this quarter. And also due to the customer mix of the type of revenue that we shipped, specifically a high volume defense program that does operate at a bit lower margins, that client mix does bring it down a bit. So that program actually will be completed next quarter. And even starting the next quarter, let alone the next fiscal year, we should see a good improvement on the margins, on the bottom line. And, our baseline that we like to, be operating the business at is at about a 10% EBITDA, which, we trust will be operating at here going forward.
But for FY25, you're expecting a flat margin, right? Though exit quarter, that is quarter 4, will be good. But overall, in FY25, the margins will be flat.
From FY, depending where we end up on Q4. But yeah, really, the business and our client mix and the type of sectors that we serve, a good baseline for our business is about 10% EBITDA. That can vary quarter on quarter. Based on factors, but we also even see that improving beyond 10%, maybe even up to 12% or more as we start to deliver more programs that have engineering services built to spec programs where we are involved in the design and manufacturing, which is the case for some of the larger programs that we've announced recently.
Got it. But, Anthony, when it comes to your standalone business, you've only grown 11% considering, what's the reason for this execution being low? Because H2 is the stronger quarter for Cyient DLM. And how are you looking at Q4? And any reason the growth has been only 11% when it comes to standalone business?
Yeah, we've had we have seen this year some softness in the industrial sector. We've actually had good growth on really from our top main clients in aero and defense. And so that's helped keep the overall business and outlook pretty solid in that regard. And then also some key opportunities that we are working. We do anticipate being able to announce those orders, and as we close those programs, that will also provide some opportunity there.
So on that, are you anticipating any headwinds across your segments based on the talks that you have with your customers or the opportunities that you see in the market?
Yeah, as we look out, we definitely see good growth opportunities in aero and defense sectors of the business. On the industrial side, we see a little bit of a mixed outlook. It depends. It's a little bit more client specific. And we have some new logos that have come in there that are driving some growth, and then we've had some existing clients there in the industrial sector that have softened a bit. And similar in medical, we're seeing the same thing there. But overall, when you kind of balance it out, we do anticipate an overall growth scenario going forward. Whether it's going to be at the 30% long range guidance from a CAGR perspective, we'll be able to provide more visibility as we progress throughout the quarter.
Right, so that's with regards to Cyient DLM. In fact, let me also welcome in Gaurang Shah from Geodit Financial. Gaurang, good afternoon and welcome to the show, and a pleasure to speak to you. How are you looking at a Cyient DLM? Because the pressure is built in. Acquisition, yes, is putting pressure right now, but what would you recommend?
Well, thank you, Viral, for having me on this platform and the show. Good afternoon to all of you all. So let me give a very candid disclosure. We've been maintaining a positive stance on Cyient Limited for a pretty long period of time. I'm talking about Cyient Limited, not Cyient DLM, since we don't cover the stock. But let me give this perspective on defense-related companies. Since Cyient is a parent company, Cyient DLM performance could affect it. But come to the defense part. Now, coming to 1st Feb, the budget day, next week, Saturday, we expect a large part of policy revision towards Make in India, Made in India, enabling more competitiveness in the Indian counterparts, which are contributing to the defense FDI that the government opened up about 3 to 4 years back, if I'm not mistaken, and I stand to be corrected if I'm wrong. Export opportunities are plenty, but the problem is the kind of policy and environment. Government has already spoken about reviewing those policies as and when it is necessary. And I also believe one thing, Hiral, that budget is not the only platform wherein government makes new policies or changes policies. There have been plenty of opportunities for the government to do that, minus the budget platform. So the company is quite strong, Cyient DLM. Unfortunately, because of the numbers, which are a little bit obscure in some quarters and better than expected in some quarters, the stock prices react accordingly. But we are very positive on the entire defense theme, including companies which are into drones, companies which are into modernized warfare technology and production of weapons accordingly.
Right. Thank you, Gaurang, for that. Well, moving on, India Cements is under pressure after a double-digit decline in the top line. Let's go to Mika for more details.
So we did see a weak set of numbers from India Cements. Revenue was down over 15% to 940.81 crores. The company actually posted an EBITDA loss of 190.09 crores versus a profit of 46.37 crores a year ago. However, net profit was at 116.52 crore versus a loss a year ago. However, the net profit was only posted due to a deferred tax liability of rupees 87.68 crores and the impact of tax reversals of discontinued operations. Lastly, what dragged EBITDA down was obviously a double-digit decrease in the top line, which had a trickle-down effect, and also an 11% increase in the material cost, as well as a 13% increase in power and fuel costs.
Right. Thank you, Mika, for all the details. Well, Gaurang, India Cements is under pressure. Now, how are you taking Q3 numbers, and what will be your advice to the investors? Right time to buy?
Well, again, a prudent disclosure from my side. On India Cements, we have an accumulate rating. So from these levels or on dips, if you are long-term time horizon, I would definitely recommend to accumulate. We had news flows in terms of Ultratech trying to acquire some stake a couple of months back. And now let's speak about the entire sector. So we have almost more than half a dozen companies in the entire cement universe on which we are extremely positive. I think government policies and in the budget, infrastructure creation is going to be a core thing that's not only restricted to real estate sector, but also pan India in terms of different states and modernization of infrastructure that is already existing. The real estate sector doing well augurs extremely well for cement manufacturing companies, and along with that, government spending on infra and private capex picking up. All these will, somehow contribute to the consumption of cement going up. We also had cement bag price revision, I believe, in month of December, and we believe that possibly this year also you might see another hike in cement bag prices. Operational efficiencies are in place. Input cost has come down. Profit margins could be better than what we've seen earlier.
Right, so that's with regards to India Cements. But moving on, another stock that we are watching out for is IndiaMart. It's an interesting one because optically, again, numbers don't look bad, but there is a concern on one aspect, which is the paid subscribers. And I think since 2 days, Puneet has been doing and looking at stocks which don't look bad optically, but there are concerns coming in there. Puneet, what is it that's not working for IndiaMart, because the stock is again down almost 9%?
Well, definitely, it's a paid subscriber pain that's, causing the stock to downtrend in trade today. Now, paid subscribers are actually fallen in this particular quarter, and that's a major surprise for the company. That's what brokerages have taken as well. So while the results were optically very strong, as you rightly mentioned, brokerages are downgraded on the paid subscriber base. So let me start with Nomura first. They've downgraded the stock to a reduce from a neutral rating earlier, cutting the target price to 1,900 rupees per share from roughly 3,150 earlier. So it's a major downgrade and cut in target price as well. There are three key points that they're making. The unexpected decline in paying subscriber base was a key negative. Lower gross margins of the company is another key aspect. With the sticky high customer churn is also another key aspect that they're looking at. And finally, weak gross customer addition has been another key negative on the stock. The other ones, Nuvama on IndiaMart as well. They've retained the reduced rating, but lowered the target price to 1,970 rupees per share from 2,500 earlier. They mentioned that margins are elevated due to lower investment cost, and that's a key negative for the long term as well. They've also mentioned that the elevated churn in the silver category, which is one of the highest subscriber base, is another key aspect because over the last 6 quarters, the company has been trying to boost up the subscriber base in this particular category. That hasn't paid off. In this particular quarter, we saw the lower investment as well, and that's another key negative. Finally, they see that they are yet to see any kind of meaningful move or kind of a change for the company in terms of strategy to have the kind of high subscribers base stick and use the platform as a whole. So overall, it's a big negative in terms of the paid subscriber base, and going forward, things don't look very outrightly well for something like an IndiaMart. The results were good, but something like the lower investment grade was one of the key negatives this time.
Absolutely, and that's something which is having a major bearing on the counter. Gaurang, how are you looking at IndiaMart Intermesh? 9% cuts, opportunity to buy, or do you think this is the best time to avoid a stock like this?
Well, honestly, Hirul, I won't give a straight away buy, sell, and hold since the stock is not under our coverage. But my sense is that competition is going to inch up as we go into the future. There are already, huge technological changes that we are witnessing, including AI and Gen AI. And of course, the kind of competition that is likely to come through. So holding on to your margins and improving the profitability is going to be a tall task for any company. I would say that there are better sectors to look at rather than look at this sector right now.
Right. Better sectors to look at as well. In fact, 2 stocks that I'm going to talk about right now. One is ICICI Prudential. That stock is down almost 8% and trade, and this is again post the numbers have come in. Now overall, if you see in terms of the quarter, let's just quickly pull up the stock. The numbers have been again in line with expectations. The growth has come in at the cost of margins, and the VNB, that's the value of new business growth, that is what is impacting the stock, which has been lower than what the street was estimating. And clearly, the margin decline is due to the shift towards low margin ULIPs business. Now, the only concerning area for ICICI Prudential will be that majority of their chunk comes in from ULIPs, and if this business slows down in future, there could be concerns at that end. So ICICI Prudential, that's one stock. Gaurang, very quickly, ICICI Prudential under pressure, but as a insurance sector, if you see the valuations are absolutely cheap, the stocks have been beaten down as well. And so far, all the life insurance companies that have reported numbers optically don't look bad. Do you think this should be an opportunity to enter insurance then?
Well, purely yes, we are optimistic about the sector. Insurance and that is life insurance and non-life. The problem is what kind of product contribution comes onto your balance sheet. And as you were mentioning, if ULIPs are going to form a large part of your revenues and profitability, then I think the focus needs to be shifted here. Because according to me, and I again stand to be corrected if I'm wrong, ULIP is not an insurance product. And I strongly oppose it in terms of the way it has been pitched. I'm not talking about ICICI Pru, but I'm talking about generally. So, one needs to relook at this particular product. Now, coming to the performance, yes, given the numbers, you have to see the kind of reaction that you are looking at right now on ICICI Pru with close to about 7% plus downtick. But like I mentioned, we remain positive. We have a buy coverage, a hold and a buy on ICICI Prudential. And likewise, we have recommendation on LIC, SBI Life and HDFC Life. In non-life general insurance, we are positive on ICICI Lombard.
Okay, understood. So that's with regards to insurance. Elecon Engineering is another one which we need to pull up, and this is on the back of the commentary that's come in terms of the quarter. Their revenue has absolutely remained flat at around 417 odd crores versus a 409 crores. What's important to note for this one is the gear division. Now, if you talk about the gear division as well, which accounts for almost 50% of their revenues, has seen a marginal growth of around 2% in the third quarter. There have been delays with regards to where order inflow goes, and what they've said in their commentary is that they're seeing sluggishness in the domestic market, which has resulted in a delay in their capex investments as well. So both of these aspects are going to be something that we need to watch out pretty closely post the numbers come in. Very quickly, 30-second answer, Gaurang, on Elecon Engineering.
Well, challenges are there, Hiral, but I think the sector looks quite promising. No specific comments since we don't have coverage on Elecon.
Okay, right. Sector looks challenging. But moving on, let's now look at more earnings. Anushi on Rosari Biotech, Tanla Platforms and Jana Small Finance Bank.
Hey, Varsha, so starting off with Rosary Biotech, now if you look at the numbers, it's a thumbs down. We have seen revenue up around 10.6%, but despite that, it was not able to meet the estimates of 776 crore. Margins have also contracted to 12.6% versus 13.7%, and net profit was down about 8%. So what dragged this earnings despite the revenue uptick is firstly the increase in material cost by around 25%. Higher stock and trade purchases also 82 is the one of the main contributing factors to this. Employee benefit expenses and other expenses also saw 37% and 22% of an uptick. Coming to Tata Platforms now. Revenue remained majorly flat at 1,000 crore versus last year, but EBIT was down about 8.6% at 139 crore versus 152 crore, and margins saw a contraction to 13.2% versus 15.2%, and net profit about 9% of a downtick. The key highlights for this results are muted revenue growth in digital platform and enterprises and communications segments. Margins were impacted due to the increase in employee costs along with some other expenses which were higher this time around, and indirect cost also accounted for 9% or 9.7% of total revenues as compared to 7.7% last year. So this is the result as to why even the stock is facing some pressure in trade today. Now coming to the good part, that's Channa Small Finance Bank, decent set of numbers that we are seeing. The stock is around up today in trade as well. Net interest income stood at 488 crore versus 455 crore. So 7% of a YOY uptick and down about QOQ basis it remains flat. OPEX stood at 491 crore versus 393 crore, up around 25% on a year-on-year basis. Now, if you look at return on assets, that stood at about 1.3% as compared to 1.2%. So 13 basis points of an improvement here. On the asset quality side, gross NPA ratio decreased to 2.8% versus 2.97%, and net NPA ratio stood at 0.94% as compared to a 0.99%. So improvement in the asset quality is what we are looking at. Quickly coming to the loans and the deposit part. Loans were up around 21% on a YOY basis, and deposits saw about a 24% of a growth, and CASA ratio stood at 18.43%. So this is the overall thing that earnings that you're looking at.
Right. Thanks, Anushi. Well, Gaurang, bad quarter for Rosari Tanla. Well, good quarter for Jana Small Finance Bank. What are your picks?
So Tanla will be the one that I'll first speak about. Rosary, we don't have a coverage, but I'll comment on the small finance bank sector and how interesting it is to us. So on Tanla platforms, like I mentioned, we have a positive coverage. We believe that difficult times are there, but companies capable of overcoming such difficult times and then translating in difficult times into possibilities and opportunities. So if you have investment, hold on. If you don't, looking at corrections, use these corrections to invest in from a long-term point of view. Now coming to Jana Small Finance Bank and likewise other small finance, we have coverage on small finance bank like AU Small Finance, Credit Access Grameen, Ujjivan Small Finance, Equitas Small Finance. So we like the sector. And the best part about this sector, Varsha, is that the run rate in terms of return of principal and interest is in some cases more than 90%, which reduces the possibility of your gross and net NPA going up and then you ending up providing for it in the balance sheet. So we are positive on this sector.
Right. Well, that's it. Time for a quick break. On the other side, we brings you more things.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
This January, the world will come together at the World Economic Forum at Davos to bridge differences because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
I present the budget for a historic
Hey everyone, with Budget 2025 right around the corner, there's one question on everyone's mind. Will this finally be the year salaried individuals get some much needed income tax relief? Let's dive into the story behind the tax slabs, the rising cost of living, and why economists are calling for reforms. First things first, Budget Day is set for 1st February 2025. Expectations are sky high, especially among salaried individuals. But before we talk about predictions, let's rewind a bit. The first big moment for taxpayers was back in the Union Budget for FY 2020-21. That's when the government introduced an optional personal income tax regime with lower tax rates but fewer deductions. Remember that? It shook things up for taxpayers who had to choose between the old system with deductions or the new simplified one. Fast forward to 2023 budget, Finance Minister Nirmala Sitharaman made some tweaks to the new tax regime, expanding 2 income tax slabs and increasing the standard deduction from 50,000 to 75,000. Sounds promising, right? But here's the thing. It didn't touch the old regime at all. So what exactly is standard deduction and why does it matter so much? Think of it as a fixed amount you can subtract from your taxable salary. It's meant to help with everyday work-related expenses. While it's been raised over the years, the question is it enough to combat the rising costs we're all facing today? Did you know the standard deduction was actually scrapped back in 2005, but it made a comeback in 2018 at 40,000, and since then it has been climbing steadily. Now economists have a big ask for budget 2025. Cut income tax rates. Why? Lower taxes means more disposable income in your pocket. That extra cash could boost savings, increase spending on essentials, and even revive demand in sectors hit by sluggish consumption. Sounds like a win-win, right? In fact, during a recent pre-budget meeting, experts suggested exactly this to Prime Minister Narendra Modi, arguing that it's time to ease the financial burden on taxpayers while stimulating economic growth. As per an NDTV Profit exclusive, the upcoming union budget could bring significant income tax relief with potential modifications to the new tax regime. Sources suggest the government is considering adjusting personal income tax slabs and reducing tax rates for incomes up to Rs 10 lakh to boost disposable income. The new tax regime, which restricts exemptions and offers fewer deductions, is already the default option for taxpayers, with 72% having shifted to it. Notably, the July budget increased the standard deduction to 75,000 and revised both tax slabs and rates. Under the new structure, income up to 3 lakh is tax-free with progressive rates ranging from 5% to 30% for higher income tax brackets. As Budget 2025 nears, there are growing expectations for reforms aimed at easing tax compliance, particularly for NRIs, that is non-resident Indians. Here are the key suggestions highlighted by Deloitte. Firstly, simplifying the tedious process for property transactions involving NRIs. Currently, buyers must withhold tax at a higher rate, obtain a TAN, and file e-TDS returns. Introducing a challan-cum-statement system similar to residential transactions could streamline the process and reduce the burden on buyers. Second, enabling tax payments from overseas bank accounts. Presently, tax payments must be made through Indian banks, making it cumbersome for NRIs. Allowing payments from foreign accounts would enhance convenience. Third, improving e-verification by extending OTP options to foreign mobile numbers. This change would simplify tax filing.
Welcome back. You're watching Profit Buzzers. Let's just quickly pull up Nifty as well as Bank Nifty and see what's happening in trade right now, because from the day's highs, you've seen a 140 points cut coming in terms of Nifty 50. We're still around that 23,000 mark. And in terms of Bank Nifty as well, it's interesting to see what's happening on that front. Again, cuts coming in near the day's lowest level. Sensex has seen a fall of almost around 390 points. And you have Bank Nifty, which is at the day's lowest levels with cuts nearing 400 points as we speak. So that's the setup of the market. The pressure has continued. Whether there is a recovery in the second half of the trading session or not is going to be interesting, because HDFC Bank will be reporting numbers and a HUL from Nifty 50. So both these counters will have some bit of a bearing as well in terms of the market performance. But first, let's pull up a HUL on the screens. It's 0.4% higher. Consumption has been a concern area as well for market participants. But first, let's head across to Mahima to understand what is the street expecting from a HUL and what is that key commentary that we should be watching out for. Mahima, over to you.
Q3 again is going to be a muted quarter for HUL. In terms of the Bloomberg estimates, we're expecting an uptick of around 3% in the revenues. EBITDA is going to remain flat. Margins will take a hit to 23% from 24%, and this is on the back of the raw material inflation that is going on. And net profit may rise by around 5%. Now, in terms of what to expect, single-digit growth overall. Demand to remain muted, especially in urban areas. Margin contraction due to raw material inflation. Volume growth to remain range bound, and this is because company would have taken price hikes, and improvement in rural consumption is something to kind of expect. Now, what to watch out for? Their commentary on the new subsidiary. They've now decided to make a new subsidiary with for their ice cream business, which is Quality Walls. The commentary coming in on that. The commentary coming in on minimalist acquisition is also something to watch out for. Demand recovery in urban areas and the quantum of price hikes that the company has taken will kind of determine as to how the margins pan out. In terms of brokerages, Axis Security believes that revenue is expected to grow on 3%, 1% volume growth versus 3% volume growth in Q2, 2% price hikes are expected, and EBITDA margin is likely to decline owing to higher input costs. Nuama says demand trends to remain similar to Q2. Exceptional items are likely to form as a sale of Pureit. Systematic says that faster growth of small packs will impact the product mix, and hence this will also impact the margins. Winter portfolio to underperform, and price hikes won't fully offset the sharp inflation in palm oil. Lastly, HDFC Securities believes that urban slowdown and increased competition across categories would hurt the performance of HUL, and hyperinflation in raw material index to weigh on gross margins, and higher royalty rate and termination of GSK consumer distribution contract will also kind of hurt margins. So margins will definitely take a hit when it comes to Q3 numbers for HUL.
Thanks, Mahima, for sharing the details. In fact, before we go across to our guest to get an understanding of HUL, let's just take a slight detour and focus on the World Economic Forum, which is currently happening at Davos. In fact, NDTV Profit has been bringing you extensive coverage with speeches and conversations with business leaders, global experts, and head of the state. Let's actually listen into what Neeraj Shah has to speak to with Anish Shah of M&M.
Well, thanks for tuning in to day 3 of the World Economic Forum coverage in Davos on the NDTV network, and it's an absolute delight to be talking to Dr. Anish Shah. Needs no introduction, of course, but would be lovely to understand from him how is he seeing the atmosphere, the optimism or the lack of it, and the mood in the Trump 2.0 era. Dr. Shah, thanks for joining in. The day 1 was obsessed with what Donald Trump might or might not say and do. He brought out the uncertainty factor for sure by saying that, hey, tariffs are coming, but let's wait and watch here. How do you see the mood here at the WEF when it comes to growth and outlook for 2025? And your own view, of course.
Good morning, Neeraj. Pleasure being here with you.
Thank you.
Based on discussions with various global CEOs, we see much more optimism than I would have expected. And that optimism is coming from the fact that the US economy is likely to be further on the upswing. That's driven by many of the actions that President Trump will take. Yes, there will be some issues with regard to tariffs, some level of deglobalization as well, but there will be bilateral deals, and that's one of the areas that countries will look forward to. So, on balance, we see a much greater level of optimism with regard to the global economy.
Okay. What's your own sense here? Because you are present in the US, so US economy doing great is good for you. I mean, US exceptionalism, third year in a row, who knows, it'll be great for you. But you also have such a larger presence in India too. How does all of this augur for growth in 2025 from your perspective?
So we are very optimistic. We see the US as an important market. We've been manufacturing tractors there for the last 25 years, and we've got a very good position in the tractor space that we play in the US. In addition, Tech Mahindra is well positioned there. We've got a lot less dependence on H-1B visas, and therefore we're ready to grow in the US. India has great fundamentals, and India will add as much GDP globally as will the EU by 2030. So we're seeing this market as a very important one, and we are driving our growth ambitions in India.
Got it. What do you feel about the first 3 quarters, if I can call it a lull, so to say, relative to what we've seen in the past? Is it a pause before an uplift? Is it possible to even predict that? Or is it a wait and watch approach when it comes to the Indian economy per se? And again, what is it that you hear from your counterparties that you speak to who might be investing into India through you?
So we believe the fundamentals are very strong. We will always have some blips along the way. We saw rural being weaker for the last year or maybe 18 months. Rural's come back fairly well now. So we will continue to see some pockets have some level of weakness, but that's par for the course. That nothing's going to work in one straight line, but the fundamentals are strong. The path forward looks very good, and in terms of what we hear from folks around the world, they're looking at India even with a greater degree of urgency than I've seen before.
Wow. So, I mean, in some of this would be helpful for the tech businesses that you run. Though, interestingly, this whole H-1B visa and green card news scheme, by the way, does it have a material impact on the tech sector employees, or is it now a lot of hire local for the US and offshoring might be a little less than what it used to be? Any thoughts there?
I think it's too early to say. We'll have to see how this develops. I just saw that 18 states have filed lawsuits against it as well. So I think there's a long way to go before we get the final outcome as to what will happen.
Okay, fair call. A bit of a focus on auto, naturally so, because you're creating quite a ripple in the markets with the kind of products that you're launching and the kind of pricing too, Dr. Shah. Now, a lot of people are saying, calling it, my own analyst calls this a daring strategy, wherein you are daring the market that, hey, I'm coming on with a product which is priced at a punchy level. Come and try and see if you can disrupt my sales. Now, I'd love to know what went behind that thought on the pricing, because we've spoken on the product before. We haven't spoken quite on the product and the pricing together.
So our approach is to drive profitable growth, and therefore our pricing is not to just go and get sales right now and then worry about profits in the future. That's not how we work. So what you're seeing is actually the strength of our product development, the ability to develop world-class products at prices that are very competitive. And we've seen that across multiple ICE products over the last few years. You're seeing that in electric now.
Yeah, certainly. So, but is this a factor of a particular gross margin that you want to make, or is it also positioning that you want to do with the first of the, technically not the first, but the first of the really new age, cutting edge looking and feeling products that you launched on the EV side?
We will always look at gross margin as a factor, and that is an important one. When we launched the XUV700, there were the same set of questions on pricing, saying, are we being very aggressive on pricing? And that's one that has worked well for us. It's a product that gives us good margins. And similarly, we are building the EV portfolio with a set of outstanding products that are priced very well for the consumer.
Sorry, I'm just probing this a little bit more. By aggressive, I don't mean it in a negative fashion. All I'm asking is by design that you're choosing to be a bit more aggressive because you want the product positioning to be of a particular type?
We believe that it has to be a product that is affordable for the customers that we serve. And therefore, we've got to develop it in that manner. So, aggressive is not pricing below cost or pricing in a way where we're going to make losses to get market share. It is pricing based on the product that's developed with reasonable margins, and one that we feel is required to be able to create a much stronger EV portfolio that we will develop over the next few years.
Okay, last question on autos per se. So there are two strategies. I'd love to pick your brain on this. One is that people start with a low price model and then eventually inch up higher as the particular brand gets developed for a new product. Are you going the other way, wherein you are pricing or coming out with the premium product first, and then maybe you will look to launch lower priced electric vehicle options in that same category?
So our product strategy is more based on consumer lifestyles, and we will have products that meet various different consumer lifestyles. You see this in the B6 and the XCV9E. They're two very different products.
Fantastic looking both, by the way.
And yes, we hope that all of our products are fantastic looking. We've got a great team and they're doing a great job there. So for us, it's not about just price. It's about creating that product for that lifestyle. And therefore, we will have some that are more premium. We will have some that may be less premium, as you call it, but catering to a set of customers that want that type of product.
Okay. Last couple of questions. One is this whole tractor upcycle piece. Now, I'm just wondering if you are even more bullish on the tractor division in 2025, because while the Indian tractor upcycle was always a belief, what you spoke in the opening answer about the US GDP growth and what the tractor business could do out there, does it make you feel that 2025 could be one of the best years in recent times for the tractor business?
We've seen good years in recent times as well. The first year of COVID was one where the tractor market grew 27%. We don't expect that level of growth at this point in time. Sure. But our business is doing very well. We are at a 44% market share, up 4 percentage points, which is not easy to do when you're in the 40s. And that gives us, again, a lot of confidence that, yes, the market is looking positive right now. Our business is positioned well. So we will have a good year.
An affordable product in the making. That's the word coming in from Anisha of M&M. But staying with the markets, HUL and HDFC have been in focus. In fact, let me also welcome in Brijesh. Brijesh, good afternoon and welcome to the show. How are you looking at HUL and HDFC Bank ahead of the numbers? What are charts indicating? A good buy call right now?
Yeah, hi, good afternoon. So yeah, HUL specifically, if you speak, then I think it is already corrected and somewhere it is approaching the demand zone. So I would wait for some more little bit of downside. 2300 is the mark where I think somebody wants to take the long-term bet, and even from the trading perspective, that can be an opportunity. So HUL is one which we are looking into. From technical also, there is some, like we talk of the positive divergence, which is playing its role. So I expect a bounce, so maybe closer to 2300. Yes, it is a buy. Coming to HDFC Bank, 1600 is the precise level where I would like to re-enter my fresh longs. This has been the level when recently the stock took support, and timing would be a little bit difficult, but then 1600 is the level where we will be adding the fresh longs. We will be advising to the clients also. So it's maybe bounce might be limited from the current point of view, but then from the long-term perspective, 1600 is the level when one should re-enter, and if somebody is already stuck, should look to add few more longs near 1600.
Right. Gaurang, on HDFC, so company will announce its results. What are you expecting? I mean, NPA ratios are expected to be flat. So how are you viewing the Q3 for HDFC?
So I think it's going to be a little bit better, a shade and color a little bit better, Varsha, than what we saw on the second quarter front. Margins on the net margins front and interest income should be a little bit better than what we witnessed in the second quarter. And if I have to just sum up whatever numbers we have seen from the banking sector, whether it is private or public, all of them have actually gone down quite well. Now, for case in point, Varsha, look at the performance of Kotak Mahindra Bank and IndusInd Bank in the second quarter, and look at the performance of Kotak Mahindra Bank and IndusInd Bank in third quarter. When the numbers were out for Kotak Mahindra Bank third quarter, the stock was up more than 9%. So, difficult times are, what I'm trying to say, Varsha, is that difficult times are there for any sector or any company. But we should look at the capability and capacity of the management and the ability to scale up from those levels. As a disclosure, since we are discussing HDFC Bank, we have a buy on HDFC Bank with targets in excess of 1,900.
Right, 1,900 is the target on an HDFC Bank that Gaurang has. Two other stocks, Brijesh, I want to discuss with you is a Swiggy and a Zomato. Both of them under pressure over the last couple of trading sessions. How are you looking at these stocks, and do you think these are good entry levels, taking into consideration the kind of beating that they've seen now?
Not exactly. Swiggy, we would be waiting for 390, breaking the 400 marks. So let us see that levels first.
from the technical point of view, it's already the way the stock is correcting. I think it will come back to 390 levels. So we are not recommending any buy in that. And Zomato also, recently there has been a sell-off. So I think there will be a further correction. Zomato, until unless we don't see any strong move about 250, 260 levels, which was the recent breakdown point. So I don't believe there will be a fresh buying will be seen in Zomato. It will take a little bit longer time. So both we are going to avoid at this point of time. Maybe we'll see once this monthly expiry and once this month is over, post budget we might review. But then bottom fishing is not suggested at this price.
Right. Well, thank you Gaurang and Brijesh for joining us on the show, and we'll see you next time. Moving on, shifting focus, let's hear a view coming in from Andreas, who's the CEO of Hitachi Energy, on the impact of Trump 2.0 and what's ahead straight from the World Economic Forums at Davos.
This nuclear power plant, which was occupied in the early hours of the war, has remained in this situation. As you rightly say, it is in the middle or just on the front line, which means that it is extremely fragile.
Zaporizhzhia, right?
Zaporizhzhia, exactly. Six nuclear reactors, the biggest in Europe, 6 gigawatts, of installed capacity. And as such, it has been subject to sometimes shelling or more frequently than that, blackouts, which means that loss of cooling function might have led to a nuclear accident. So we are, always counting it by the day when we have situations like this. We have to be always on alert. We have a permanent group displayed there. They are doing a job in terms of interacting with the management. We are advising, we are reporting, updating on whatever is happening. This group deployed there is doing that, and in every other facility in Ukraine. So as you say, it is an unprecedented situation. Never before has a war been fought and in the midst of a vast civilian nuclear infrastructure. So this is one of the biggest challenges, not the only one, certainly, that we have, but one of the biggest challenges that the IEA is facing.
The West Asia situation, fingers crossed, might be a little better now with the hostage situation improving, but there was a huge concern that missile barrages might end up resulting in something larger. Many in Israel say that Iran is building a nuclear weapon. Is it the IEA's belief that that is the case?
No, we don't have any evidence that Iran is building a nuclear weapon, but at the same time, it is true that Iran has accumulated a vast amount of enriched uranium, a very high level of enrichment, which makes it very, very close to weapon level grade.
Life is always uncertain. I think if you look back a couple of years, we never have had a situation which was not interesting from my point of view. And one thing is clear, the hunger for energy, for electrical energy, is worldwide a phenomena which is quite new. For most of us, we haven't seen it coming. Now we are dealing with the consequences. And I think the new administration has declared an energy emergency, which I think is dealing with the fact that they acknowledge that we need more electrical energy and we have to be faster on that, which is not only unique for the United States, it's something which we see all around the world.
Right, so those are global voices that we're hearing from the World Economic Forum that's happening at Davos. But let's just quickly pull up a Polycab. Reported numbers, 13.8% is the number margin versus a 13.1%. Let's just see the counter. It did slip, recovered slightly. 11% is the profit growth that we've seen. So there is some bit of a recovery that's coming in with regards to Polycab. We will get you a detailed coverage shortly. But moving on, as we know, with the budget just around the corner, NDTV Profit actually brings you expectations from various sectors. This is our budget corner, and the spotlight is on the fertilizer space. In fact, Varsha has done a deep dive on what is on the cards. Let's listen into that piece.
The fertilizer subsidy is a crucial component of India's budget, supporting farmers and ensuring agriculture productivity. For FY26, the subsidy is expected to align closely with the current year's spending trends. ICRA estimates a subsidy requirement of Rs 1,70,000 crore for FY26, matching the expected outgo for FY25. This includes the cost of extending the DAP subsidy until December 2025. The government initially allocated Rs 1,64,000 crore for FY25, but later topped it up by Rs 6,594 crore, taking the total to Rs 1,70,000 crore. Till November, the centre's fertilizer subsidy outgo stood at Rs 1,21,000 crore. In the past, geopolitical events like the Ukraine war drove subsidy cost to Rs 2,50,000 crore in FY23, while prices for raw materials and finished fertilizers have risen recently, particularly in the P&K segment. Urea costs have remained stable due to steady gas prices. This balance has helped moderate the subsidy bill in FY24 and FY25, offering some relief to policymakers. The fertilizer subsidy accounts for about 2/5 of central subsidies, projected at Rs 4,28,000 crore for FY25. It remains the second largest subsidy after food, with Rs 2 lakh crore allocated for food and 11,925 crore for cooking gas. To promote sustainable farming, the government is expected to announce a roadmap for balanced fertilizer use, reducing dependency on specific nutrients. However, any sustained increase in the input cost or geopolitical disruption could require adjustments during FY26. In conclusion, the fertilizer subsidy continues to be a significant expenditure, supporting both farmers and the nation's food security. While current trends show moderation, challenges like rising cost and import dependency highlight the need for strategic planning and fiscal discipline.
So that's going to be a big push for the fertilizer sector. We will get you more details from a visual perspective in the next show, but completely out of time. With that, it's a wrap on this edition of Profit Buzzers. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
They say fortune favors the prepared. The more prepared you are, using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you then.
Well, Budget 2025 is around the corner, and Macquarie has come out with its budget estimates or expectations on each sector. The first sector is the banking space. They do not expect favorable treatment for deposits, and possible capital infusion for PSU banks and insurance companies might take place. Moving on to the next sector, NBFCs is the counter. Credit guarantees similar to SMEs for MFI sector can be expected. In the insurance company space, that is the next sector to watch out for. No change in tax rates or any product or any corporate profit tax rate change can be expected in this budget of 2025. The next sector to watch out for will be cement and metals, where they are expecting announcement on import duties to restrict imports on certain metals and certain materials. Moving on to the auto space, outlay for PM E-Drive and PLI can be expected. Policy initiative to drive localization of key EV-related parts can also be expected. The next sector in focus would be the consumption space. Mid to high single-digit increase in cigarette taxes can be expected. The budget, interim budget which was announced last time, did not have any tax rate change in cigarettes, which is why we did see an uptick in stocks like ITC and VST. But this time you could see mid to high single-digit increase in cigarette taxes. Reduction in taxes for low middle class consumers could take place space, which could boost consumption in the rural as well as the urban spaces. Moving on to the next space, jewelry is the space where no reversal of custom duty cut on gold will take place. In last budget, there was a custom duty cut announced on gold, silver as well as platinum. There will be no reversal on this as per Macquarie. Moving on to the next space, pharma and healthcare, potential support for higher R&D via tax reduction can take place, and PLI for anti-diabetic and weight loss medication could also be one of the factors that the budget might consider. And modest increase in allocation for Ayushman Bharat is something that Macquarie is expecting from the pharma and the healthcare space. Infra is the next space. Capex allocation for key ministries like railways, roadways, etc. Can be expected in this budget, and announcements around additional dedicated freight corridors can also be expected in this budget 2025. Defense is another area where initiatives to boost defense exports can be expected, and announcements around that will be expected, and initiatives fastening domestic defense equipment procurement could also be one of the things to watch out for in this particular budget. Lastly, in terms of power, green energy thrust to continue. Steps to promote initiatives across the value chain, that is to promote green energy, might also be seen during this budget. Oil and gas is the last counter where Macquarie expects that OMC's compensation for LPG under recoveries might be seen. So these are Macquarie's expectation on different sectors as to how budget may come out with different changes in different sectors and how it may impact these sectors.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is...
Hello and welcome back to NDTV Profit. You are watching Profit Top Trades and I am your host Puneet Zaveri. Let's quickly look at the market first because we've seen a downward reaction on the Nifty today, starting somewhere around the 23,113 levels. But it's been a downward day. You can see that high of 23,144. We haven't been able to sustain any of those kind of levels, and we've actually breached 23,000 again in the session today. Let's also look at the mid cap 150 as well as the small cap 250 as well, because those are stocks also under pressure, larger than the Nifty as well. 2.5% down almost on both these indices. Before we go across to the broader market, let's look at the top contributors of the Nifty 50 first. The gainers and the losers in the Nifty 50, because we are seeing some pressure now coming in. IT as a pack has been holding up the Nifty on the positive side. Infi, TCS, both doing pretty well. Maruti is also surprised on the positive side in the green as well, because the auto pack as a whole is down. HDFC Bank on the negative side, results are expected today. Stock's going to be a key reactor on that aspect as well. SBI also downward trade. Let's also look at the advances and the decline ratio, because yesterday we did see a very huge move on the main board indices, almost down 1200 points, and today it's been a straight, from the starting, it's been a downward spread, 1900 stocks almost on the declines, and just a few advances to report. Let's also look at the Nifty 500, top gainers and losers as well, because we are seeing a lot of pressure on a lot of stocks today in the broader market. Something like a Bajaj Holdings there on the positive side, but India Cement on the back of the Q3 earnings not responding well at all. IndiaMart again is one of the key surprises in this particular aspect, because while the results as a whole were very positive, there are a couple of negatives, which is the paid subscriber base, which has fallen in this particular quarter. That was a key surprise, as well as the margins were up because of investments. So Street not taking those numbers. And I just want to highlight Polycab as well, because we did see the numbers come in. On a revenue basis, it came at roughly 5,226 crores versus estimates of 5,300 crores. But on the margins, it was a beat, coming at 13.8% versus 13.1% on a year-on-year basis. Estimates were actually of 12.4%. So despite a beat on margins, we did see some positive reaction when the numbers came in about 15 minutes back. But it's continued its downward movement, and your commentary in the conference call will be something that's key in this particular aspect. So these are some of the big movers on the Nifty 500, but there's another one which has been moving on the downward side, and that's Cyient DLM. Now the EMS company reported its Q3 earnings yesterday, and they also held the management also held a conference call, but one of the key negatives is that despite a 40% jump in the company's revenues, the EBITDA margins were down by 4%, profits also down by roughly 40% in this particular time frame, and that's because of one-time expenses of M&A. They acquired Altec in the USA, and roughly about 8 to 9 crores expenses were on the EBITDA hit, and that was key. But one of the key negatives was the falling order book, and that's something the Street has not taken very positively. We are seeing all the stocks in the EMS space under pressure. And let's quickly pull up a Dixon Technologies, Amber Enterprises, and Keynes Technologies as well along with this, because we're seeing a lot of pressure on the EMS side, and Dixon was down 10% yesterday. Keynes is down despite announcing a QIP of about 160 crores. Keynes is under pressure. Amber Enterprises will be in focus as results are expected this week. But overall for Cyient DLM, the falling order book was one of the key negatives for the stock, and the commentary by the management, while sounded positive on Altec with the new government coming in and Mr. Trump taking in, swearing in as well and going vocal for local, but it's not enthused the Street at all. Valuations were not as high as the other EMS companies, but still downwards as well. So Cyient DLM is the first one, but on that aspect, let me get in our guest Mahesh Ojha, who's the AVP Research and Business Development at Hensec Securities. Mahesh, good afternoon, and thank you so much for joining us today. We're seeing a lot of pressure today across the broader markets. I just wanted to start with your view on Cyient DLM first. Q3 earnings, while flattish because of one-time expenses, but falling order book is not something that the Street has been enthused with. Any kind of view that you have on Cyient as well as the EMS space as a whole?
Good afternoon, Puneet. So definitely we are seeing some selling pressure in EMS space, as we have earlier discussed in earlier shows that in any disappointment in terms of revenue, in terms of results, then we may see some selling pressure on all the counters. Specifically, we have a word regarding Dixon Technology, where we are seeing 14,500 to 15,000 range. So slightly disappointment in result is tracking downside the stocks. Similar to Cyient DLM, we are order book are not much more promising, so we are seeing some much downside in terms of. But definitely these stocks are value buy. If anyone getting in them, they can accumulate in these levels, because stocks has already beaten down from a higher level, and now slightly attractive, coming in slightly attractive zone. So kindness can be picked from here. Accumulation in Dixon also advisable. Meanwhile, Cyient DLM can be accumulated in 480 to 500 range. So these stocks are slightly coming in comfort valuation zone, but current market is breather is negative. So take some time for accumulation.
Got the view, Mahesh. Let's also look at something like a Sirma. If you can pull up the last 1 month chart, we've seen a lot of pressure on this EMS counter as well. We did mention Keynes, Dixon among others. We're seeing a 9% drop on Sirma SGS as well. The 1 month chart also indicating roughly 20% drop. But another stock that's been affected and downward in this particular market is Newgen Software. Now the stock has slumped almost 25% in this particular week after posting the quarterly earnings. We have Rucha joining in to breaking down the numbers for us. And what is the key aspects that dragging the stock down? Rucha, what is some of the key negatives about Newgen Software and any kind of indications in the conference call as well?
Yeah, so you rightly mentioned Newgen is down in trade, but let me talk to you about the numbers first. Revenue was up about 5.5%. Margin came in at 26.2% versus 20.8% last quarter. Profit was also up 27%. So largely numbers seem to be better than the same time last quarter. But where the problem lies is the growth in the annuity revenue, which is about 60% of the total revenue. So annuity revenue is not growing as per expectations, and the company mentioned that this is because of delay in execution, especially in the US, and US being one of the major markets for Newgen as well. Now let us talk about what Jeffrey states on Newgen Software. Well, it has downgraded the stock to underperform from a buy rating with a target price of 1240 from around 1500 target price and implying a 22% downside. They said that though third quarter better than the last quarter, they actually missed estimates again, as I mentioned, due to slower growth in annuity revenues and also longer execution cycle. So therefore they have cut their earnings estimate by about 4 to 6% and now expect a 23% compounded annual growth rate over the next 3 years, that is till FY27. In terms of valuation as well, it mentions that at 55 times PE, the risk valuation looks unfavorable. Now let us look at the analyst recommendations over here. Well, few analysts cover this stock with 4 having a buy rating, 2 having a hold, and 2 having a sell rating and return potential of 14.5%. But when we look at the share price performance, 14% returns were just about came in at in the last 6 months over here, and in last 12 months 44% return. So next 14% return in 1 year seem to be a very less a number based on what Newgen has actually performed during the last 1 year. So we'll wait and watch from what the clients are saying, especially in the US, and whether annuity revenue recovers for the management or not.
Well, thanks for that, Rucha. We have seen the stock being a key outperformer over the last 3 to 5 years, but definitely under pressure over this past week. Mahesh, any kind of view that you have on Newgen? Because a lot of pressure, almost down 25% this week. Any kind of outlook on the same?
Yeah, definitely, Newgen was also trading at a higher PV in 1,700 odd level there. We were expecting some profit booking in these type of stocks also. So we are factoring the higher P stocks in correct valuation zone. So I think 1,050 to 1,100 level could be good level for entry in Newgen. Currently, we are seeing some selling pressure. It can be continued further. So I think 1,050 to 1,100 level could be attractive level for Newgen from a longer term perspective. We are still optimistic for 1,400 to 1,450 level, but currently stocks in downturn zone, so we may see some more pressure from here onwards.
Well, some pressure might be from your onwards, but there's a brokerage report actually in focus of InCred. They've come out with a report on the e-commerce space as a whole, where they are mentioning that they are seeing a blue sky scenario, suggesting a long runway, and specifically they're talking about 2 stocks with Swiggy and Zomato. Both have been in the news over the past week. Zomato's results not enthusing the street again, down almost 15 to 20% in this week. I have my colleague Mahima joining in, getting us the key excerpts from this report. Mahima, what is InCred's key highlights from this particular report on Swiggy and Zomato?
Before I move on to what they're saying exactly in the note, they've initiated ad rating for both Zomato and Swiggy, with Zomato with a target price of 270 and Swiggy with a target price of 540. They're saying that the monthly transaction user runway is still on a good runway, and they're saying that it's a blue sky scenario, suggesting a long-term runway going ahead. Now, in terms of large opportunity in food delivery, profitability will support in terms of expansion in quick commerce, and and this scale and platform play with structural growth drivers in place. Now, quick commerce opportunity is large enough to accommodate several players again, but for them, they prefer a Zomato over a Swiggy, and cash cow food delivery could support quick commerce business growth going forward. So what they're saying is that they're penciling in growth of quick commerce, but going forward, food delivery could support quick commerce, but it will be a cash cow going forward. And advertising revenue and monetization could also aid the take rate for both of these companies. For Zomato, they've said that leadership in food delivery business, with better control over unit economics and potential EBITDA breakeven in Blinkit, could help offset the rising competitive intensity and capture share of incremental profit pool, which is why they're more bullish on Zomato. And they're saying that for Swiggy, early success of Bolt platform, improvement in food delivery execution, and doubling of the number of dark stores could help capture market share for them, and this could also give them incremental growth in terms of quick commerce. So very interesting note, and these are the couple of reasons as to why InCred is bullish on both Zomato as well as Swiggy.
Well, thanks for that, Mahima. Mahesh, let me go across to you for both of you, because the Q3 results definitely didn't enthuse the street on for Zomato specifically, and it's taking Swiggy downward. Any kind of outlook that you have on both these food aggregators?
No, definitely, we are earlier we have discussed, and we have already suggested that both the stock can come in lower consolidation zone. So after the result, the Zomato management commentary is not favorable. So we are seeing more pressure than any other counter in Zomato. From my perspective, 190 to 200 zone is a accumulation zone, lower accumulation zone, and further upcoming time we can see some more upside in Zomato also, because habit of Indian consumer will not going to stop, and both the counter has a much more potential for upside. So I think both the stocks can be accumulated in right time for accumulation zone. The 190 to 210 zone for Zomato for accumulation for upside, 280 to 290 range could become in 1 year horizon. And from the Swiggy perspective, we are also prospective to 540 to 560 range could come in 1 year horizon. So both the stocks are in valuation wise a comfort zone. So I think both the stocks can be accumulation from here onwards.
So 190 to 210 is the kind of range that Mahesh is looking for Zomato. But another key story that we're getting is, there's some relief for the Sanjay Kirloskar brothers group, because, the Pune court has allowed KVL to use the trademark surname Kirloskar. Charu joins in with some more details on this for him.
Hi, so in this story there are two important parties. One side is Kirloskar Brothers Limited, whereas on the other side we have Kirloskar Proprietary Limited. Now Kirloskar Brothers Limited was always using the Kirloskar trademark, which is basically their own surname, and Kirloskar Proprietary Limited also got transferred this trademark once the family divided its assets in business based on a family agreement years back. Now they are embroiled in a family dispute alleging mismanagement and other allegations on each other. However, in a relief to Sanjay Kirloskar run Kirloskar Brother Limited, the Pune court that was hearing one of the aspects of the family dispute gave them some relief, saying that they are allowed to keep using this trademark. Now what was the case of KPL, which is the Kirloskar Proprietary Limited? It was saying that after getting the trademark, the company basically served termination notices, and that is why the agreement was breached and they should not be allowed to use the trademark anymore. However, Pune court did not find much substance in this argument and saw that KBL should be allowed to use the surname as a trademark.
Well, thanks for that, Charu. Let me just pull up Nuvoco Vistas as a stock, because it's recently reported its just about 10 minutes back reported its Q3 earnings. Margins are down to almost 11% versus 17%, seeing that sharp downward reaction on the stock as well. Q3 earnings for cement makers were expected to be subdued because of price hikes haven't been completely taken in. This was the first proper quarter, but commentary would be some of the key things to watch out for. But Q3 earnings definitely not positive for Nuvoco Vistas. The other stocks that actually is up on the positive side is Jana Small Finance Bank. Now the company has surged after posting the Q3 results. They logged in a 17% YOY fall, in net profits to about 110 crores. Let me just bring Harsh to break down some of the key numbers and what's driving the positivity on the stock today.
Jana Small Finance Bank, the stock on a tear. You're looking at asset quality metrics improving. So both your GNP and NNP ratios have come off. which is one key positive. The second one is with regard to provisioning, and I want to get this right. So in terms of the overall provisioning sequentially has come down by 17% QOQ. So that's the one big positive. On top of that, you look at regulatory based provisioning. That has come in at 81 crore versus 149 crore in Q2. So you're seeing sharp change on that particular number, sharp reduction, which is also visible. Third one is with regard to accelerated provision. So they've accelerated certain of their provisions which they believe will be required in future quarters, and they've provided for it already. And that also has come in sharply higher than last quarter. So there's more prudence involved. Despite all of this, your ROA metrics have come in at 1.3%. That is your ROA after all of these one-offs that you've also clocked, and which is also up around 13 basis points on a QOQ basis. And therefore, you're seeing overall that the numbers are looking sharper and better. When I'm removing the one-off provisions, when I'm removing the contingent provisions which they've added buffers for, the ROA is more than 2%, and that's probably what's driving the stock higher.
Well, thanks for that, Harsh. So overall profits are down 17%, but the better asset quality and something that's affected all small finance banks as well as banks as general, that's something that's improved. And Mahesh, let me go across to you for this because very interesting stock. It did try to list a couple of times, but finally over the last year the stock has listed. Any kind of outlook that you have on Jana Small Finance Bank or any other small finance bank in this aspect?
Well, definitely, we are tracking the Jana Small Finance Bank. I think numbers are superb because NP has come down and asset quality improved, and much more in this type of circumstance. The numbers are posted by Jana Small Finance Bank are superb. So we can think how management improving their books. So I think stocks, from my perspective, we can see much more upside in stocks or from 1 year horizon, 540 to 560 level could become in Jana Small Finance Bank. Number are attractive, superb, and we are tracking from longer time zone and expecting numbers, good numbers. So these numbers are very superb. They are focusing on NPA and assets quality. That is the management thought to showing that they are improving books. So I think from much more perspective, 540 to 560 level could become in 1 year horizon, and these numbers are very superb.
Well, Mahesh, on that note, I'll thank you for joining us today and giving us your views across all these stocks. Always a pleasure, and look forward to our next conversation. Jana Small Finance Bank, has fallen from roughly about a 730 rupee levels somewhere in June of 2024. And, today's move definitely a big positive on asset quality. But, before we wrap the show, I just want to alert that, just 9 days left for the budget of 2025. But what should you expect and how should you trade and how can you benefit from the budget of 225? Please record a question or a video message of your question, then send it to us on WhatsApp. Your questions will be answered by a panel of top market experts, including the likes of Ramesh Damani, Prashant Khemka, Gautam Shah and more, only on NDTV Profit.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about 3 key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold into the mutual fund industry over the past couple of years will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate, and what that means is that depending on which income slab you fall in, if you're in the highest tax slab and you're paying 30% on the income above a certain threshold, your gains from debt mutual funds are also taxed at 30%. That wasn't always the case. Long-term capital gains came into effect after a period of 3 years, and they were taxed at 20% with indexation benefits. Of course, that doesn't remain the case anymore. So the mutual fund industry is asking for a rollback to the previous tax treatment because they say that the debt market in India is growing, is emerging, and it needs to be incentivized. The third change that they're suggesting has to do with the income distribution schemes. Of course, there are two types of schemes in mutual funds. One is the growth scheme, where all gains are reinvested by the fund manager. And in the second case, which is the dividend distribution scheme as it used to be called, the income is distributed on an ongoing basis to unit holders. Now, the thing is, income above 5,000 rupees that is distributed in this manner will have to have tax deducted at source, or TDS, as things stand right now. And the mutual fund industry is suggesting that this threshold be raised to 50,000 rupees, and they expect that this will benefit a lot of people because they won't then have to have tax deducted at source. Of course, there are more proposals that they've made, but we'll see what the finance minister takes up when she presents her budget for 2025.
I present the budget for a historic.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday.
Welcome, you're watching India Market Close here on NDTV Profit. Another tough day of trade for the Nifty 50. And just quick intro, I'm Harsh Saita, with me is Mahima Vachajani, and we'll take you through the next 1.5 hours of trade. So flat on the Nifty currently, you're looking at an intraday, and if you can have that chart, you'll see the amount of volatility that's there. It's a choppy day of trade in that sense. And we're just very close to the day's lows. 150 to 160 odd points is the band in which the Nifty has been trading in, at least today. So that's how it's playing out. Let's look at the heat map of the stocks on the Nifty 50, and you'll see a bunch of IT names clustered at the top of that pile, and you have a Sun Pharma there. So pharma and IT seem to be in some form or shape contributing positively as much as possible to an otherwise pretty difficult day for the Nifty. So you're looking at largely here the breadth of the market maintained, but otherwise the breadth is looking sharply skewed to the negatives. In terms of pain points, so looking at BEL, Tata Motors, SBI, Trent seeing cuts of 2.5% plus in trade. So you're seeing some bit of pain there. Nearly 16 odd stocks are down 1% plus in trade as well. You're largely seeing some of the heavier weights, something like an HDFC, something like an RIL, trade in the red, and IndusInd continues to face some bit of pain. What's doing well is the likes of a Kotak, Bajaj Finance among the financials pack. Let's look at the contributors as well on the Nifty and get a sense of what's really aiding the index. Look at those. Those are all IT counters along with ICICI. And then you have HDFC and SBI top of the pile in terms of negative contributors. The Nifty Bank, if we can pull that one up as well. Some bit of pain there as well, of course, but and underperforming the Nifty in that sense, 0.8% lower on the Nifty Bank. Let's pull out the contributors, because now you're starting to see banking earnings start to trickle through. Some of the impact of those earnings also reflecting on stock prices. So only Kotak, ICICI trading in the green. Outside of that, pretty much all the PSU banks as well as the smaller private sector banks and something like an Axis trading well in the red. Some pain in some of these names here that you can see. Let's pull up the advanced decline, look at the breadth, because the breadth, it's a tough day. Yeah, that's how the breadth is skewed sharply in favor of the declines. The sectoral heat map, if we can, likely just pharma and IT likely trading in the green. Outside of that, we're going to see pain across the board. FMCG will be a pocket that we'll look for this week, because HUL's numbers will be expected. The Nifty Private Bank also, with HDFC Bank's numbers expected, 30% of the private banking index. But I want to mark out Nifty Realty. After the 4% cut yesterday, you're down another 5.5% today. So pain is very real in the broader markets, isn't it, Mahima?
Absolutely. I mean, the pain is real in the broader end of spectrum. Let's pull up the mid-cap 150 and the small-cap 250 and see how much the pain has broadened, during the day. There you go. Mid-cap 150 is down around 2.4%. The small-cap 250 is also seeing, similar losses, down around 2.7%. If we can quickly pull up, the counters on small-cap 250 and see as to where the real pain is, which stocks are pulling the small-cap 250 down. There you go. India Cements on the back of Q3 earnings, SW Solar has seen a lot of downtick in the past few sessions. IndiaMart again on the back of earnings, Century Textiles, ICICI Prudential again on the back of earnings, Macrotech, Godrej Properties and Hitachi Energy, all of these counters down within the range of 6 to 8%. So, like we were discussing also, Harsh, it's the earnings, it's the earnings downgrade that is actually the factor that is kind of, weighing down on the markets. A few stocks to, point out, like I said in the start, while pointing out the India Cements Q3 numbers, there is pain in terms of India Cements when it comes to the numbers. Couple of things not working. EBITDA dragged due to double-digit decrease in top line, 11% increase in material and power and fuel cost. Cyient DLM is another counter where revenue did beat estimates, but margins and profits were down due to a one-time M&A expense. There's organic order book excluding acquisitions have also fallen QOQ, which the street is not reading very well, which is why the stock is down. Keynes Tech, let's pull up that counter, not because of earnings but because of QIP. A 1600 crore QIP being raised is what is vague, but it's I think the entire EMS pack which is seeing pressure after Dixon came out with numbers. There's Keynes Technology, there's Sirma SGS, there's PG Electroplast. All of these counters are red and dragging down the entire broader market spectrum. IndiaMart on the back of its earnings, let's pull up that. This paid subscriber going significantly down. On prima facie the numbers look good, but paid subscribers going down is what is hurting the counter. Let's also pull up Sunteck. Sunteck saw good runway yesterday, but there's profit booking seen in that counter. Jana Small Finance Bank is one counter that has, upheld its position and is still trading 17% higher on the back of its Q3 earnings, where provisioning largely accelerated and provisions came down. Asset quality improved. Robust loan growth is something that's pulling the stock up 17% on something like a Jana Small Finance Bank, Harsh.
Okay, so those are some names for us to keep in mind. Let me bring on board Kush Bora, Nirav Ashar to talk to us about all that's happening in markets today. Kush, the weakness evident, especially on the benchmark, but even more so in broader markets.
Hi Harsh, hi Nirav. First, a very good afternoon to you and to all the viewers.
Good
I think we've been speaking about this, that this weakness is here to stay, and the key level of 23,000, which is just being taken out. But I think this is once again, coming to test. If this level is broken in the sense, you see a closing below it, then you're immediately looking at a 22,800, 22,500 kind of a level, which has been my medium-term support zone for a while now. But let me not sound extremely pessimistic. I mean, it is what it is, right? However, today the view is slightly different. I think the time to start nibbling into stocks, time to start buying selectively is around the corner. Even if I take 22,500 level, which is the medium-term support zone, as the next target on the downside, I think the risk-reward ratio is starting to become favorable for long positions. So that and a couple of other reasons, technical plus derivative data combined, I think we may be seeing this rally, on the downside come to an end, at least from a near-term perspective. I'm not saying that this is the end of it, and from here we're looking at a 26,000. But perhaps a 23,500, 24,000 kind of a move is possible. That said, I don't want to preempt when it will happen, because these rallies typically don't, start from a pinpoint. So you'll have to wait and see from where does the tide turn. But the short point is that, while the pressure might persist, I think it is time to start nibbling into those stocks, and Nifty, even Bank Nifty for that matter, might start seeing better days. Does it happen tomorrow or day after? That is anybody's guess. But the things are starting to look a little more optimistic from here on.
Right. So that's the view with respect to your Nifty and your Bank Nifty. But one counter, that I would like to throw light on is IndiaMart. When the numbers came, prima facie, the numbers looked good. There was a margin uptick. There was EBITDA which grew by around 60%, revenue up 16%. But the real pain was in terms of the paid subscribers that went down significantly for IndiaMart Enterprise. It did, surprisingly post a decline in their paid subscribers after 16 odd quarters, and margins were elevated, and this was because of lower investments that they're making and lower advertisement costs by the company. The management has also said that they will, last I spoke to them, they said that they're not very keen on investing into their advertisement area. In terms of the silver category, there was an elevated churn there. Despite the kind of efforts that have been put by the management in the past 6 quarters, that has not gone up. And Nuama has, kind of retained reduce on the counter and lowered the target price to 1970, which was earlier 2,500. And they're saying that they're yet to see any meaningful sign of improving subscriber retention. Nomura had also come out with a note on IndiaMart and EMS, where they've downgraded it to reduce from neutral. They've cut the target price to 1900 from 3150 earlier, and they're saying that unexpected decline in paying subscriber base is concerning. The loss of kind of gross addition, which was kind of the unique selling price, is disappointing, and sticky high customer base churn to weigh on collections growth going forward as well. Weak gross customer addition with stickier elevated customer churn is also concerning, and they've cut their FY25 to 27 PAT estimates by 4 to 13%. So this is how, overall how Q3 has panned out for IndiaMart Intermesh. Nirav, I'll come to you on this particular counter. How are you reading the numbers, and what is next in store for this company?
Yeah, good afternoon, and thank you for having me on your show. As you pointed out, I think as far as the historical performance is concerned, then I think this it's been quite satisfactory. But it's going to be the outlook which is going to be important. And as you pointed out, with the reduction in the paid subscribers, I think definitely the market is suspecting some headwinds and challenges going forward. So I think hence the cautious view has been taken by the markets, and valuations have been slashed to a certain extent. And I think this is broadly a story with most of the companies, because we are seeing in a lot of companies reporting their numbers that this historical performance has been quite good, whether the Q3 numbers are concerned. But the outlook is something which remains a cause for concern.
Okay, HDFC Bank's numbers flashing on your screen. I'm going to quickly read some numbers out so that we get a sense of where we are standing. Your provisions number has come in at 3,154 crore rupees. Your net profit has come in at 16,736 crore rupees. Just a shade below what we were expecting at roughly 17,000 crores. So not a big miss, or not a miss at all, largely in line it seems the set. You're also looking at your net interest income number coming at 30,653 crore, which is again a decent number, 1.8% up on a QOQ basis, around an 8% growth on a YOY basis. Looking at operating expenses, you're seeing a bit of a spike when it comes to operating expenses. That's come in at 17,106 crore versus the 15,961 crore number same time last year. So you're seeing that number has inched up for sure. Your ROA number has come in at 0.47%, which is 1.88% on an annualized basis. I have with me Aditya Shah. You're seeing a spike on both the GNPA as well as the NNPA. The GNPA has gone up by roughly 3 or 4 basis points, and your NNPA has gone up by 5 basis points. So you're seeing those spikes coming through with regard to where asset quality is concerned. GNPA up exactly 6 basis points sequentially, to be absolutely precise there. Aditya, what's your sense with regard to the first cut numbers? Growth was slow, of course, but your net interest income number doing decently well.
Good afternoon, Ash.
Good afternoon.
Can you hear me?
Yes. You're audible, Aditya.
So once you look at the results, I think the results are very stable. I am looking at the provisions number at about 3,153 crores, which is fairly stable. My primary concern on HDFC will continue to remain the asset quality as well as the margins. All other numbers are very immaterial in my opinion. The asset quality is stable, even though there is a 6 basis point spike. but we expect every lender out there to report some increase in slippages as well as deterioration in asset quality. The provisions number is up from 2,700 crores last quarter, but it is lower than the number of last year. So it is fairly okay and decent. I've not been able to calculate the margins. I'm waiting for the entire press release to come in. But if there is any slight improvement in the margins as well, the market will really like it and the stock will move up. So all the question will now hang on the margins. Other than that, the results continue to be really good.
What's the sense with regard to your provisions number, Aditya? When you're looking at it sequentially, it's gone up from 2,700 odd crore to 3,100 odd crore. So your sense with regard to that number?
So Harsh, if you look at Kotak Bank as well, on Kotak Bank, the provision number did spike up and the asset quality did deteriorate. This is an industry-wide phenomenon where we are going through a phase where NPAs are rising and HDFC Bank is also experiencing certain bit of deterioration. We need to ask them what was the NPA on the agri side of it. Seasonally weak quarter for the agri business, so that we need to concentrate on. And we need to also understand the commentary with respect to the micro lending, where a lot of deterioration has been seen. So net, yes, there has been a deterioration. Last quarter the provisions were at 2,700 crores. This quarter it is at about 3,400 crores. But seeing the size of HDFC Bank, I don't think that that's a problem. Market is not too much worried about the asset quality per se because they already know HDFC Bank does have a good book that they really hold. The question is now how the margins will move with respect to the loans. If the bank will guide that they are going to accelerate the retail loan growth, since the LDR is now below 100%, the margins will automatically improve in the next 2 to 4 quarters. So that is something that is a question mark right now. I wait for the press release to have an opinion on that.
Aditya, this is Vishwanath coming in. I had a quick question. You said the margins are unlikely to move anywhere as such. I wanted to get your view, in the current environment where the expectation is that there's going to be a rate cut at some point in time in the next month or so, and the expectation is that eventually your advances, yields on advances will come down therefore, and deposit repricing will likely take time. Do you expect any kind of reduction of margins then, therefore?
So Vishy, what happens is this mismatch between advances and deposit is a short-term thing. What investors in the HDFC Bank stock are really watching out for is long-term expansion of margins from 3.4% to about 4%, and that's where the real return on the stock really is. Of course, there will be a mismatch between the asset and liability when the rate cut really happens. I expect the rate cut as early as the next RBI meeting. So there could be a mismatch and a slower margin compression because of the mismatch could happen. But in my opinion, investors are not too much worried about that because it's a short-term phenomenon. Longer term, HDFC Bank, as the LDR starts to come in control, needs to accelerate the retail loan growth. And once the retail loan growth accelerates, the margin will come back to 4% where the investors want them to really be. So net, of course, this is a short-term concern for the bank, but longer term, what really matters is how the bank is sustainably able to expand their margins to 4%. Mind you, this quarter Kotak was able to expand their margin by a couple of basis points, but that is very seasonal and very short-termish in nature per se. So longer term, that's the trigger for HDFC Bank stock to outperform the market and give sizable returns from here on. How sustainably the bank is able to expand back its margin to where it was pre-merger.
How quickly do you believe they can do that, Aditya?
Sorry?
How quickly do you think they can do that?
I think as the asset quality cycle has turned really bad, I think it will take minimum of 6 to 12 months from here on. The biggest positive from in this quarter's result is the LDR coming down below 100%. I think it is at about 99%. The first piece of the puzzle is now solved. The next piece of the puzzle will be now to aggressively focus on margin expansion and margin coming back. I don't think this happens before 6 to 12 months down the line. But I feel HDFC Bank is particularly on the right track. They've controlled down the advances in order to control the LDR. Now once that is controlled down, they will now focus on margins also. So the result is all about future commentary and where HDFC Bank is really headed. the numbers particularly are immaterial. I don't think that the stock price will move on numbers. It will particularly move on the management commentary that we hear at 6 p.m. from the bank.
Right, on the asset quality front, you said things have deteriorated across the sector. To your mind, maybe, is there a turnaround at all you're expecting? You said about 6 to 7 months for the operational numbers to turn track, but as far as asset quality is concerned, do you think things could get worse from where they are at this point in time?
So, if you look at RBL Bank's numbers, they were a horror number. You look at Kotak's microfinance numbers, they are also relatively bad. So the industry-wide upheaval of NPA is a reality of which all banks are going to face this test. You cannot say that X bank is immune to it. Everybody who has a diversified book will face this. It is just that the larger banks with a better quality book will face a lower problem rather than an RBL bank who is particularly exposed to the unsecured side of it. So I don't feel that this 6 basis point up move in the gross NPA that HDFC Bank has seen is a concern to me. Where I would be concerned is that if the management comes and tells us that they are not able to control future NPAs and SMA 1 to book are really ballooning up, I would face a problem. But from Kotak's commentary, where Kotak was really very confident that asset quality is definitely under control, I don't think that for HDFC Bank also asset quality will be a problem. Of course, there will be a deterioration in asset quality, but the industry itself is experiencing that problem. So I don't feel a problem. And we've also not got a bifurcation of non-agri NPAs and agri NPAs. I feel seasonally this is a weak quarter for the agri side of it. So there could be a spike in NPAs. But from the provisions number, I don't see a problem. They've not made too many provisions, which could signal that they're not too much concerned about
Previously, whenever HDFC Bank's management has made comment about asset quality, they've said 1.5 to 2% is where usually their worst performing area is. And we're coming close to that sort of danger area at this point in time. You think then that pass over above 1.5% is likely?
I think from my perspective, what I think is that the top banks are far better suited in order to tide over this asset quality problem that we are seeing across the industry. Top banks having their books better positioned than a smaller bank. I feel that they are better positioned per se. I feel that 1.5 to 2% is where HDFC Bank will be. 1.46 I think is the gross NPA number this time around, and at a provision number of 3,500 crores. I think they're sufficiently well capitalized also for the NPAs to not be a problem for them. So as I said to you, if the bank management comes and says that asset quality is a big concern and we are slowing down, then the stock price will behave negatively. But I feel that the management, with not taking any contingent provisions, to say that asset quality is fairly stable, this deterioration was because of the industry-wide problems, and they will move on from here on. And I think that over a period of next 6 to 12 months, they're going to be really very aggressive as smaller banks continue to vacate market share because of their own NPA problems, to take on aggressive growth in order to get back those funds. So net, larger banks will tide over the NPAs better. We've seen Kotak Bank do better. We'll also see HDFC, ICICI, and to that matter SBI also do better.
Okay, thanks for that, Aditya. Pretty comprehensive in terms of taking views on everything that's happening with regard to HDFC Bank. Stock spiking 1.1%. Thanks so much, Vishy, for joining us.
Thanks, Harsh.
As well, and giving us all of that perspective. Nirav, Ashar, if I can quickly ask you, what's the sense like with regard to HDFC's numbers? The reaction from the market seems positive.
Yes, it seems to be quite positive in a turbulent operating environment, and I think the way they have been able to grow their advances and the deposit mobilization, handling that delicate situation, and of course the improvement in the net interest margin, 8% improvement and 1.8% on a quarter-on-quarter basis, that also definitely warrants merit. And I think on the provision front, I think the view is that this is an industry-wide phenomenon, and it is a short-term crisis as far as the larger and the professional banks are concerned, and they'll be able to navigate these headwinds over a period of time. So I think this is a short-term phenomenon, and I think overall it augurs well as far as the medium term is concerned.
Right. Before I go to Kush, just quickly, Tata Communication numbers have also come out and the stock is down 5%. And that is a sharp spike just after the results were announced. Revenue was up 3.8%. Net profit was good. I mean, the uptick in the revenue, net profit was also good to 236 crores versus 45 crore, but the margins have taken a slight hit. Kush, I'll come to you for HDFC, but before that, Nirav, if you had the chance to look at Tata Communication numbers, first cut, how do you read them?
Well, I think this kind of a fall is not warranted, but I think we've seen a lot of stocks where there have been good quality numbers, where per se there's been nothing really wrong with the numbers, but the sentiment has become so bad at this point of time that everything seems to be overvalued and stretched in terms of valuations. Hence, the markets have become very nervous, and the first reaction is that of a knee-jerk reaction as far as results are concerned. So I think there are, of course, companies which have reported good numbers. I think Tata Communications fairly good set of numbers. And of course, if one were to take into account some other companies, I think Polycab has also reported a good set of numbers. But again, the reaction has been very, very negative.
All right. And quickly, Kush, your view on HDFC on the charts?
Mahima, I'm just glad that the moment we spoke about nibbling into stocks and how the markets can go up, the Nifty is up about 100 points from there, and Bank Nifty is up about 450 points from there. So that's got to be some timing. Not taking any credit for it, just a bit of a coincidence that the HDFC Bank numbers were announced at that point in time. But this just corroborates the fact that I do feel that it's the time to start nibbling into the market. The selling has been a bit overdone, and you're looking at a bit of a rebound. As far as HDFC Bank goes, yesterday we discussed that the 1625 mark has been a medium-term support zone, also been respected for the last 7-8 sessions. As long as that is held, a near-term trade can also be made in HDFC Bank. Same 1625 is the stop loss. On the upside, you're looking at 1695 and 720 as targets. But I think the juicier trade in this one is a more positional one from a 6-12 month perspective.
Right, okay. Just a quick mention, the cabinet briefing is taking place, and the MSP for jute has been raised by 6%. Just with that update, we'll slip into a quick break, but viewers, don't go anywhere. We'll be right back with more news on the other side.
They say fortune favors the prepared. The more prepared you are, using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
Hey everyone, with Budget 2025 right around the corner, there is one question on everyone's mind. Will this finally be the year salaried individuals get some much needed income tax relief? Let's dive into the story behind the tax slabs, the rising cost of living, and why economists are calling for reforms. First things first, Budget Day is set for 1st February 2025. Expectations are sky high, especially among salaried individuals. But before we talk about predictions, let's rewind a bit. The first big moment for taxpayers was back in the Union Budget for FY 2020-21. That's when the government introduced an optional personal income tax regime with lower tax rates but fewer deductions. Remember that? It shook things up for taxpayers who had to choose between the old system with deductions or the new simplified one. Fast forward to 2023 budget, Finance Minister Nirmala Sitharaman made some tweaks to the new tax regime, expanding 2 income tax slabs and increasing the standard deduction from 50,000 to 75,000. Sounds promising, right? But here's the thing. It didn't touch the old regime at all. So what exactly is standard deduction and why does it matter so much? Think of it as a fixed amount you can subtract from your taxable salary. It's meant to help with everyday work-related expenses. While it's been raised over the years, the question is it enough to combat the rising costs we're all facing today? Did you know the standard deduction was actually scrapped back in 2005, but it made a comeback in 2018 at 40,000, and since then it has been climbing steadily. Now economists have a big ask for budget 2025. Cut income tax rates. Why? Lower taxes means more disposable income in your pocket. That extra cash could boost savings, increase spending on essentials, and even revive demand in sectors hit by sluggish consumption. Sounds like a win-win, right? In fact, during a recent pre-budget meeting, experts suggested exactly this to Prime Minister Narendra Modi, arguing that it's time to ease the financial burden on taxpayers while stimulating economic growth. As per an NDTV Profit exclusive, the upcoming union budget could bring significant income tax relief with potential modifications to the new tax regime. Sources suggest the government is considering adjusting personal income tax slabs and reducing tax rates for incomes up to Rs 10 lakh to boost disposable income. The new tax regime, which restricts exemptions and offers fewer deductions, is already the default option for taxpayers, with 72% having shifted to it. Notably, the July budget increased the standard deduction to 75,000 and revised both tax slabs and rates. Under the new structure, income up to 3 lakh is tax-free with progressive rates ranging from 5% to 30% for higher income tax brackets. As Budget 2025 nears, there are growing expectations for reforms aimed at easing tax compliance, particularly for NRIs, that is non-resident Indians. Here are the key suggestions highlighted by Deloitte. Firstly, simplifying the tedious process for property transactions involving NRIs. Currently, buyers must withhold tax at a higher rate, obtain a TAN, and file ETDS returns. Introducing a challan cum statement system similar to residential transactions could streamline the process and reduce the burden on buyers. Second, enabling tax payments from overseas bank accounts. Presently, tax payments must be made through Indian banks, making it cumbersome for NRIs.
Welcome back. Of course, HDFC's numbers has brought some bit of enthusiasm to the street. Let's look at the Nifty, and you're seeing some bit of recovery there, 0.5% or so odd from those lows of the day. You can see that bounce, 1/3% higher on the Nifty now. And let's pull up the contributors as well, because HDFC is packing a bit of a punch there. 1+% higher in trade, and post the numbers, you're seeing that there's been a bit of a shift to the positive contributors on the Nifty, where HDFC Bank has entered that list. Infi TCS doing well, so the IT stocks buzzing as well, and along with that you're seeing the big boy also contribute, and that's probably what's leading to a bit of zing on the street. Let's look at the small cap as well as mid cap indices as well. Broader markets also seeing some bit of recovery. May not be material there, but we're definitely off the day's lows. So you're seeing a little bit of uptick across the board. But onto our new segment, Heard on the Street. We all know that there's a lot of chatter in the dealing rooms about what's buzzing and why. And we have NDTV Profit bringing you all that and more with my colleague Somit Sarkar. Somit, what did you find out today?
Well, firstly, it's Nykaa. The stock has been under immense pressure for the last quite a few sessions that we have been seeing. It also fell below its 200 DMA in trade, and dealers are indicating that DIs have been exiting this counter. There has been a lot of chatter now around the high PE stocks and internet stocks not performing or growth slowing down. Amidst this, we are seeing quite selling pressure when it comes to Nykaa as well. Apart from that, it's Coal India. Strong delivery-based buying is a trend that we have seen here. Yesterday, the delivery numbers numbers were quite high for Coal India, which continues today. Buying activity has been continuing both on the DI and the HNI desk as well. Valuations continue to remain cheap, and traders are indicating that the downside for this stock from here on is quite limited. And lastly, if you look at, given the fact there's a bearish sentiment in the market, large HNIs are sticking to large quality names which are showing growth at this point, and few names that dealers have indicated where there are buy flows at lower levels, that is Bajaj Finance, Indian Hotels, Bharti Airtel and Eicher Motors. All these stocks are seeing buying actions or buying at lower levels on the HNI desk. That's what the dealers are indicating.
Well, yes, plenty of big moves with regard to delivery as well. Thanks so much, Somit, for that. That's obviously our daily herd on the street. But let me also bring on board Shivangi Sarda, analyst equity and derivatives at MOFSL, joining us this afternoon. Shivangi, what's the sense like? It's a bit choppy where the Nifty is concerned, but we're seeing a decentish recovery. What levels are you looking out for? Are you constructive or not, both on the Nifty as well as the Bank Nifty?
Hello Harsh, thank you for having me. So we've seen that the indices have been facing selling pressure, and some sort of volatility will be there and cannot be ruled out around the budget. So this will continue for the next couple of weeks, and we will need to fasten our seatbelts to ride this swing. But of course, there will be swings on either side. Bears are quite comfortable, but sell on bounce will be the one strategy that will be applied on a intraday basis. But then again, we've seen that pullback move is also visible, but call writers are also strengthening their position. So overall, you can see there is a mixed sort of setup in the indices, and we're looking at 22,800 on the downside with a resistance at 23,350 levels. So this will be the range that one can play out for Nifty, but overall pressure will remain, and one can stay little careful at these levels. Talking about Bank Nifty, we've seen that this index has not fallen as much as the Nifty index, but then overall heavyweights are also witnessing pressure here, which will sink the index down. So we're looking at 48,000 as the lower levels, where it did take a little bit of a support today as well. And as a resistance, we're looking at 49,000. So swings within this range will be expected.
Okay, so that's the view with respect to the Nifty and Bank Nifty. Neerav, I'll come to you. Somit mentioned about Nykaa, and he said that a lot of these online platforms, we're seeing slowdown in their growth. How are you reading this, especially for all these internet companies?
Well, as far as these internet platforms are concerned, then I think per se the healthcare, the beauty platforms, the products business itself has been doing quite well with a huge amount of potential. But I think the heightened competitive intensity is something which has definitely taken a toll, because a lot of these FMCG companies have their own D2C brands. Plus the intense competition which is there in the marketplace. Plus we have the organized retail, which has become very, very competitive. So I think overall this is weighing on companies like Nykaa.
Coach, picks for this afternoon?
Sure, Harsh. I still go with a mix of a long and short given the volatility in the market. But just for that, a quick update on two stocks that we discussed yesterday, PVR, Inox, and I said that, this is one trade that continues to give, and that too on the short side. So 1065 was the second target, and that was hit today. Astral was the second short target. In fact, it was an SCBT with 1440 as the second target. That too has been hit. The stock seeing some recovery from the low of the day, but not before hitting that second target. So if anyone's got these positions, not a bad idea to start booking these profits and covering these shorts. As far as trades for today go, on the long side, I've got Paradeep Phosphate. Very interesting setup here. The stock had a very broad range of 115 to 105. It's given a breakout above that level on the back of very strong volumes in the last 3 to 5 sessions. So from a near-term perspective, I think this move could continue. On Paradeep Phosphate, the second target on this one is 133, stop loss around 121. On the short side, I've got Sun TV. This too is a candidate for shorting for a while now, has remained so. If you see the volumes also on the downside haven't really abated at all. So someone can use the January futures to execute this short for targets of 628, 621, 642 is the stop loss. So Paradeep Phosphates on the long side and Sun TV on the short side.
Shivangi, yours for this afternoon?
So on my stock list is first up Maruti. For this auto space has been an outperformer from quite a long time, and the stock has made a base on the weekly basis, and the halt near this base has suggested that supports are quite strong. On the monthly basis as well, it's showing some good signs of recovery and reversal over here. So a new trend which is to begin for Maruti here. So now there has been good amount of open interest activity here, and from the last two sessions, we've seen short covering move at whatever shorts that were left at the higher zones. So definitely this one's on radar, and we're looking at the next target as 12,500 for this stock, with a support near 11,800. Now, the second pick on my radar is, of course, from an IT space, which has been ruling the market today and holding with quite a lot of strength. I'm liking Wipro here, which has given a negation of the 5 weeks lower top, lower bottom. And especially in the last 3 sessions, we've seen volumes adding up on the long side. Now, of course, there is a lot of tailwind from the IT pack, and the stock is doing quite well. So we're expecting 320 as the next targets for Wipro, with a support near 300 levels.
All right, so those were the top picks of Shivangi, but the stock in focus today is Polycab India. It came out with its Q3 earnings, where we saw revenue was up 20%, EBITDA was up 26%, net profit was up 10%, even margins improved a tad bit from 13.1 to 13.8. But the street is not reading that very well. And Puneet is joining us with a detailed report as to what has happened. Why is the stock tanking over 5% in trade today? Puneet, is it the volumes? What is the scene exactly here?
Well, they had some downward pressures because of, higher copper prices at the start of the quarter, and margins could have been bigger. But, the stock was almost down roughly 8 to 9%, and that's seen that slight recovery as we saw on the charts right now. So while, as you rightly said, results have beaten estimates on most fronts. Revenue, net profit is up almost 458 crores. Estimate was a 461, so meeting estimates there. But margins were the key aspects, coming at 13.8% versus expectation of roughly about 12.5 to 12.8%. So it's beaten the aspect on margins, but the results are not as straightforward because there are a lot of moving parts for the company. If you look at the segmental revenue performance of the company, we've seen the wires and cables come at roughly 4,300 odd crores in terms of revenue. That's a growth of almost 12%, while the FMEG business, which is the fast-moving electrical goods, includes fans as well as other appliances, that has grown 21% in this particular time frame. That's one of the key things to watch out for. With that, there has been revenue growth in the wires segment, but one of the key aspects is that the EBIT margins could have been much better for something like a wires and cables, and that's where the downward pressure on the stock. We've seen a slight recovery from the lower bottoms of the company, but the recovery hasn't been because they had some margin impact of the higher copper prices. The other aspect is that EBITDA margins improved by 230 basis points on a quarter-on-quarter basis. Hence, that slight recovery, in terms of share price performance. Margins improved on the back of normalization of wires and cable margins at the end of the quarter. But the stock is under pressure because of downward pressure of copper prices over the last 3 to 4 quarters. That's continued again. So any kind of recovery is only baked in Q4 for the whole fiscal year to have a stronger margin impact as well. Apart from that, higher channel inventory of wires, as we mentioned at the start of the quarter, was the aspect, and the light and luminous segment, which comes under the FMEG business, has mentioned that they've had some strong growth as well as volume growth. One final aspect is that the company has retained its guidance of 20,000 crores in revenues for FY26. That was under the cloud. It is expected to beat that estimate because margins have been slightly on the downward side. But overall, commentary is something that's going to drive the performance of this stock going forward as well. Copper prices being one of them that's driving because it's a commodity business. But overall as well, the recovery hasn't been as strong as expected because it was expected to be a decent quarter. So overall, multiple viewpoints to be taken in this result. And Polycab, I think the share price performance will be driven by the commentary in earnings conference call tomorrow.
All right. So that's the overall view as to what's happening with Polycab. Nirav, I'll come to you. Havells also saw a similar downtick in cables and wires segment, and it's a similar case here also. Copper prices going up is kind of impacting their margins. What's your view with respect to the first reading of Polycab results?
Well, I think it was a decent, very decent set of numbers, and as even Havells had pointed out, that wires continues to outpace the cables business. But I think both of them have done reasonably well. Cable segment is going to be a big beneficiary from the power segment, because we've seen that power T&D demand has been quite strong. The typical nature of this business is such that it is a raw material intensive business. So copper prices, one really doesn't tend to have much control over. Very little scope for cost optimization because it is a raw material intensive business. So I think the focus would be on how the revenue growth is playing out at this point of time, and the miss on the raw material front is also not very heavy. It's just marginal. So I think the market would read the results in better light going forward.
Okay, and Nirav, HDFC Bank's core NIM has come in as well, flashing at the bottom of our screen. 3.43% versus 3.46%. So you're seeing some bit of moderation coming there. Is that a concern?
No, I think the market would still want to take it in a positive sense, considering the fact that most of the challenges and the headwinds seems to be factored in the price at this point of time.
Okay, thanks so much, Nirav, for joining us this afternoon and giving us all of that perspective. Always good having you here. I want to also possibly call out the fact that deposit growth was 2.5% for HDFC Bank, sequential, quarter on quarter, and advances growth was just 1%. And maybe that margin drag is also because deposit growth outpaced advances growth by quite a bit, and maybe that's impacting margins as well. But we have Devin Choksi, Managing Director of DR Choksi Investment Managers, with us. Sir, we were just discussing HDFC Bank. In fact, we had a longish discussion, but the margin number has just come out and the core NIM stands at 3.43% versus 3.46% last quarter. One, your perspective with regard to margins, that's point number one. Point number two, if you've had a chance to look at the numbers, what do you make of it? Because we've seen a spike on the stock price, of course, 1.5% up from the lows. What's the sense from your side?
Yes, good afternoon. Well, I believe that I think the market has to reconcile. Some of the larger companies have been producing phenomenally better numbers than what their anticipation and expectation was. In fact, I think the entire market before the earnings season, as far as I think the banks are concerned, I think they have been talking negative about, I think, these companies maintaining their margins or doing better. And as against which, I think in the case of Kotak, in case of even HDFC for that matter, I believe that the numbers have not only come in line with the requirements, but also at the same time, much better in a given situation when everybody was suspect. So I think the companies are doing quite well. Economy is right on the track. Maybe I think there has been some amount of challenge because of the lower offtake, lower growth in the economy because of variety of reasons which we have discussed in the past, including the election, including the monsoon, and then I think the series of inconveniences, I think because of the hardship of doing business, could possibly have derailed some part of the growth. But at the same time, I think the businesses are not giving up. They are doing well, in my viewpoint. And so I think the market has to reconcile to this particular reality that even in a harder way of working, still, I think the companies are producing better results than before. So from that perspective, I would remain relatively more confident. Plus, most importantly, the price corrections have already happened in the stock. I think given was a situation when I think that things are not looking as good and the premiums were quoted in the stock prices. Today, I think the discounts have started quoting in the stock prices, I think against the underlying strength of the earnings. So in my viewpoint, I think market will soon reconcile this particular anomaly. And in my viewpoint, I think the business condition remains pretty optimistic from here onwards, as far as I think the growth is concerned in most of the businesses.
Right. Sir, how are you reading Polycab results? Because prima facie the results looked nice. There was good growth in terms of net profit, even in terms of revenue. But we were discussing earlier as to the copper prices have gone up, which was the same case for Havells also, and which is why the cables and wire segment was under pressure. Margins also in the cables and wire segment are under pressure, and the street is not kind of happy with the copper prices going up, I believe, which is why the stock is tanking. But your read through of Polycab results?
So I think both Havells and Polycab, which you mentioned, and I think if you look at the underlying results, I think they are not bad at all. On the contrary, I think in a given situation, when there has been a challenge due to variety of reasons which we discussed, I think they have still performed well. Save except in some situation where probably I think you are having the challenge of margin to a certain extent in some cases, not in the entire case. In case of Polycab, I think they also had a situation wherein the higher amount of inventory also took some part of the margin toll, as I see it. But these are all some of the given activities in the situation which is not to be considered or what should not be considered as a negative thing. On the contrary, I would think that I think things are quite looking positive going forward. Today, I think the entire customer segment of Polycab, on which I think they have been selling their products and services, they all are looking up, be it in the segment of railways, be it in the segment of constructions, or be it in the segment of housing. Everywhere, I think the higher amount of demand has been experienced. So, in my viewpoint, nothing wrong with the business condition per se. Maybe some pressure in the margin in a given quarter is justified because of the situation. Maybe the market is disappointed at times, largely because I think they have given extremely high premium valuations to many companies. And they are disappointed more because I think, and high premium valuation, I think they are not willing to compromise even a bit of item, I think, as far as the pressures on the margin or something is concerned. I think it will soon reconcile. As I said before, maybe I think the valuations are required to be rationalized, moderated, and then again the interest should come back into the market. Till that point of time, I think we are going to always find some fault with the result, which is not the case here, at least in this company.
Fair point. So two divergent views. They've been defending both sides, both an HDFC Bank in terms of how strong the result is in an otherwise difficult quarter, and where Polycab is concerned, no complaints per se, but just valuations being expensive. Shivangi, from your perspective, Polycab?
So looking at Polycab, it has taken a little bit of a hit in the last, two sessions. In fact, there is somewhat a pullback move today, but then, I'm not really sure how sustainable this is because it did break its support zones of 6250 levels. So 6250 still acts as an important zone over here. If it fails to, hold above the same, there would be some more downside visible here. But then again, overall buying on the, pullback move hasn't been with remarkable interest. So I believe there will be some sort of consolidation and a pressure that will be mounting up here. So I would suggest 6250 will be an important level to decide for a make or break zone here.
The stock is up around 41% in the past 12 months, Polycab. But now, let's take a look at the top 3 stocks on our radar today. Varsha brings in more on Newland Labs, Elecon Engineering and ICICI Prudential. Varsha?
Thank you, Mahima. So let me start with Newland Labs, wherein the stock is buzzing on the back of company which has announced capex of rupees 342 crore in 2 of its facilities. One is enhancement of capacity at Telangana unit, where the proposed capacity addition of peptide synthesizers will take place, which will require 254 crores. And the second proposed capacity addition of their plants, which is Unit 3 at Telangana. If I were to talk about the business outlook of the company, FY25 will be flat compared to FY24, but company is expecting good growth when it comes to FY26 due to order pipeline and strong customer demand. Then on my list, I have Elecon Engineering, which is buzzing. The stock is under pressure on the back of earnings, where if you see the gear division, which accounts 50% of revenue, sees marginal growth of 2.1% of revenue in Q3, and company also sees delays when it comes to order inflow and sees sluggishness in domestic market, which has resulted in delay in capex investment. third on my list is ICICI Prudential Life Insurance, wherein if I were to talk about, again the stock is buzzing on the back of earnings. Key takeaways, the growth is actually at the cost of margins. BNB growth is lower than expected, and the mix has been contributed to margin decline. Company is focusing on providing customers of what they want, and higher cost is expected to come off. Management, if I were to talk about what the management has to say, their linked business contribution increased due to continued traction in ULIPs, and ULIP segment has been continuing in the early days of fourth quarter as well. Slowdown in credit life business and also expect credit life to pick up. So these are all the three stocks which are buzzing on the back of news and also earnings.
Right, Kush, I'll come to you. Newland Laboratories has gained over 72% in the past 6 months, but in the past 1 month it's not done much. It was hardly 0.3% up. How are you reading the charts?
Well, not a bad move at all. And as you said, after a stellar gain that it's already posted, some correction in line with markets, is actually par for the course. In fact, in the last few sessions when the markets have been volatile, the stock's actually been consolidating with a positive bias with a good support zone around the 13,200 mark. So I think this is definitely a hold if anyone's got a position. If someone's looking to add, then I would suggest give it a day, because the 14,000 mark is a bit of a resistance that the stock's not been able to take out for the last 3-4 sessions. So a closing above this level, 14,000, will give a closing above the 20-day moving average. Also the resistance levels of the recent past. And beyond that, then you could find momentum. And if the markets, as we discussed, do kind of catch on, then the stock could accelerate, on the upside. So all in all, fairly positive on Newland Labs. For a fresh entry, the stop loss comes in at 13,200 with targets around 14,750. And once that is taken out, you're looking at a 15,600 kind of a move as well.
All right. Tanla Platforms is another counter, Shivangi. The numbers came in and it was not a very impressive set of numbers. 6 months, the stock is down 34% and currently almost trading near its 52-week low. I think we've lost Shivangi. But Kush, then I'll come to you. Tanla Platforms is the counter. How is that, faring on charts?
Just like you said, it's not performed any bit great and barely any indications that, it will going forward. So avoid any kind of adventurous trades into it. If you've got any positions, you might as well exit now before you see much lower levels of anywhere close to 580, perhaps even 550, because the stock already been sliding down, and it's also broken some of the key support zones near the 675 mark. So exit is the call on Tanla Platform.
Okay, I'm going to, Devin, if I can quickly take your view on some of these platform companies, Tanla Platforms, something like a new gen software. Any of these interesting to you? Tanla trades at 16 times earnings now. It's at its 52-week low. I'm not sure if you track it, but new gen trades at 50 times plus earnings. Guiding for a 20% growth. Of course, the miss this time around was due to some one-offs, and we'll have the management, the slice of conversation we've had with the management as well. But your quick views on that one?
No, I'm afraid both these companies are not part of my coverage, so I won't be able to make any specific comments.
Okay, point taken. Shivangi, would Newgen feature on your list? What would you do with that? Would you make a trade?
So I'll tell you something, with this kind of market volatility and swings, I would, suggest to go only with the heavyweight names which are having strength and momentum. Newgen, for that matter, we've seen that, in the last 1 week, it's wiped off the gain of the last 7 weeks. And clearly there is, a lot of struggle at these levels. Stock has actually thrown from its highs, and I believe this stock should be avoided on radar right now, and focus should be on the heavyweights one only.
Point taken. Okay, thank you so much, Shivangi. We'll let you go on that note. Let's slip into a very short break. On the other side, we'll get your top BT, ST, STBT ideas, and along with it, we'll also discuss some more stocks. Stay tuned.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
Well, Budget 2025 is around the corner and Macquarie has come out with its budget estimates or expectations on each sector. The first sector is the banking space. They do not expect favorable treatment for deposits and possible capital infusion for PSU banks and insurance companies might take place. Moving on to the next sector, NBFCs is the counter. Credit guarantees similar to SMEs for MFI sector can be expected. In the insurance company space, that is the next sector to watch out for, no change in tax rates or any product or any corporate profit tax rate change can be expected in this budget of 2025. The next sector to watch out for will be cement and metals, where they are expecting announcement on import duties to restrict imports on certain metals and certain materials. Moving on to the auto space, outlay for PM E-Drive and PLI can be expected. Policy initiative to drive localization of key EV related parts can also be expected. The next sector in focus would be the consumption space. Mid to high single digit increase in cigarette taxes can be expected. The budget, interim budget which was announced last time did not have any tax rate change in cigarettes, which is why we did see an uptick in stocks like ITC and VST. But this time you could see mid to high single digit increase in cigarette taxes. Reduction in taxes for low middle class consumers could take place, which could boost consumption in the rural as well as the urban spaces. Moving on to the next space, jewelry is the space where no reversal of custom duty cut on gold will take place. In last budget, there was a custom duty cut announced on gold, silver as well as platinum. There will be no reversal on this as per Macquarie. Moving on to the next space, pharma and healthcare, potential support for higher R&D via tax reduction can take place, and PLI for anti-diabetic and weight loss medication could also be one of the factors that the budget might consider. And modest increase in allocation for Ayushman Bharat is something that Macquarie is expecting from the pharma and the healthcare space. Infra is the next space. Capex allocation for key ministries like railways, roadways, etc. Can be expected in this budget, and announcements around additional dedicated freight corridors can also be expected in this budget 2025. Defense is another area where initiatives to boost defense exports can be expected, and announcements around that will be expected, and initiatives fastening domestic defense equipment procurement could also be one of the things to watch out for in this particular budget. Lastly, in terms of power, green energy thrust to continue. Steps to promote initiatives across the value chain, that is to promote green energy, might also be seen during this budget. Oil and gas is the last counter where Macquarie expects that OMC's compensation for LPG under recoveries might be seen. So these are Macquarie's expectation on different sectors as to how budget may come out with different changes in different sectors and how it may impact these sectors.
I present the budget for a historic
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
do you really know the company you invest in?
Okay, welcome back. You're watching India Market Close here on NDTV Profit. We have both our guests with us, Kush and Devin. Devin, let me come to you with regard to realty. Nifty Realty is now down 25+% from the 52-week highs. Now, we did see a phenomenal rally with regard to realty stocks. But what should one make of this? A 25% correction, is this that time that it's an opportunity to buy realty?
Not immediately, for a reason, because on the other side, the market capitalization also significantly got eroded. And I think that is another challenge. If you notice, I think most of the realty companies probably, I think, were thriving on the premium apartments that they've been constructing, particularly in the home segment. And that is in one area which comes immediately under threat if the market capitalization takes a beating. You are likely to see, I think, the challenge on that front by most of the developers who are developing some of the premium apartments. They might probably see, I think, a pressure on selling, if not on the price immediately. So that is going to be a significant amount of challenge that is likely to come up. Unless the market meaningfully recovers and probably starts stabilizing on the values, then I think the things are likely to remain on the sideways, as I understand most of the realty companies. Per se, I think the mid-tier segment and the low-cost housing segment, they remain good. But the fact remains that I think on the other side, the cost of fund, the rate of interest is not coming down. And that is also affecting the EMI wallet of most of the borrowers, I think, for the housing. So in a given situation, when you don't act in time in the economy, you invite problem for the actual sectors. And that's the message, underlying message that one gets. And that's where I think one wants to talk to the regulators, the RBI, the finance ministry, that in a given situation, one needs to act ahead of time in order to, I think, make the industry work better for the growth purpose.
Oh, that's a very interesting take. Okay, opportune time to take our bull versus bear segment. We put the spotlight on Oberoi Realty today. The stock has cracked over 5%. And this is on top of the crack that we saw yesterday as well. And Q3 overall seemed to be quite strong, right, Anushi?
Right, Harsh. So if you look at the Q3 overall in terms of where the financial metrics were and even the key operational metrics, so we looked at a healthy set of numbers. In fact, if you look at the booking value, that's about, so strong Q3. This is with the positive commentary. Do note that we had discussed that commentary on how the pre-sales trajectory is going to be something that we should be watching out for. In terms of where the booking value is concerned, we saw about a 144% of a growth there. Collections also saw about a 56% of an uptick, and revenue recognized about a 31% of a growth. But despite the healthy set of numbers, they have missed their pre-sales estimates. This is despite the 144% of growth. So this is our bear case scenario, the first point over here. This is because of the softer bookings that have taken place in 360 West, the Worli project which is there, due to which the brokerages have also revised their pre-sales targets in a downward motion. So that is something we should be watching out for. Now coming to the next case, and what should be watching out for is the company has a strong launch pipeline and business development on the bull side. Now if we are just talking about what is the kind of launch pipeline that we should be watching out for, in Borivali they have 1 tower, Goregaon 2 towers, and Thane they are planning to build a whole ecosystem there. Shopping Mall, Forest Wheel, that is in focus. Other than that, these all launches are expected to be coming through in Q4 of FY25 or even the early part of FY26. So it's something we should be focusing on. Even the Gurugram, Adarsh Nagar, Worli and Tardeo projects are something that is going to be beneficial. So a lot of upcoming launches in FY26, which is on the healthier business development side. But lower bookings from existing projects is a question mark. Now this was addressed in the con call as well yesterday. So what has taken place is that this lower bookings that we are looking is on the back of the higher price that have taken place is the company has taken price hikes of up to 20%. This is in a scenario wherein there are talks of price realizations now stabilizing, but the management remains very confident that they are not seeing any adverse effect despite the price realizations, price increases taking place in the market. Now coming to the third point is the annuity portfolio is scaling up considerably well. Now if you look at the Commerce 1, Commerce 2, they are almost leased out to their highest levels. We are looking at 90% plus of leasing activity here. This is on the back of higher occupancies also taking place. Commerce 3 also, by the end of this financial year, they are expected to reach the levels of where the Commerce 1 and Commerce 3 is concerned. So that is something that we have to bear in mind. So expectation is that it will be fully leased out by the end of FY25 period. But on the bear case scenario, if we talked about a strong launch pipeline and the business development side, but if there is any delay in launches, this may impact the revenue recognition and the cash flows of the company. So while the management did state that in the next 12 months or so, or before that also, they'll say a lot of these projects coming back into action. If that does not translate in a similar manner, then the cash flow and the revenue recognition targets have to be revised and reworked again. So this is something that we need to bear in mind. But coming to the final point is now in the bull case scenario, fundraise proceeds. Now do note that the company had raised about 1,500 crores through NCD. Their total target is of about 6,000 crores. This they want to acquire. This they want to use towards acquiring larger land parcels. So this will also add into the business development side. So a very, very healthy factor that we are looking in terms of showing the kind of demand momentum that is still there for the business. So that is on the positive side. But however, if you look at the bear case scenario, considering the Q3 numbers, the slowdown in what the velocity of ongoing projects is and the pre-sale estimates which have been missed this quarter, some of the key brokerages have now revised their targets downwards. Some of these include Jefferies. Now they have maintained a hold, but they've cut their target price to 2030 from 2050, which implies a 10% of an upside. While Antique has also maintained a buy call, but they've revised the target price to 2005.93 instead of 2008.26. So this is with a 38% of an upside. Despite that, we are looking at a 38% of an upside. And Citi, though it maintains a neutral rating now, it sees that the valuation from this valuations remain on the premium side, so they look at limited upside from the current ongoing levels which are there. So this is the overall roundup that we are seeing for Oberoi Realty. This downtick in the stock price that we are looking at is majorly because of softer sales that have taken place in their 360 West Worli project.
Well, thank you so much for that, Anushi. Pretty comprehensive bull versus bear case on Oberoi Realty. Kush, quickly, Oberoi Realty, how much more of a downside are you seeing on the charts?
Well, with the kind of volume-led downside for the second consecutive day, I think there's a possibility that stock could hit the medium-term support zone of 1700, 1710. So no adventurous trades recommended just yet. Let's see if the stock does indeed hit and respect the 1700 mark.
Heritage Foods has also come out with its earnings. Revenue is up around 10%. EBITDA is up around 42%. Margins have improved by quite a bit, 5.5 to 7.1%. And net profit is up 59%. The stock has seen a reversal. It's at its day's high right now, up 3.6%. Devin, I'll come to you. The entire consumption space. How are you viewing? What are the trends that you're observing? HUL is expected to have its result today, and we're expecting that rural recovery might see some kind of uptick, but it'll be offset by the kind of slowdown in the urban consumption. But the other trend that we're observing is that price hikes will take place, and which is why volumes will go down for a lot of these FMCG staple companies. So how are you reading the consumption space, and what is the outlook for the consumption space going forward?
So it's very pertinent. I think consumption space is not going anywhere. Frankly, I think both in rural as well as in urban areas, I think the necessity items are being consumed and definitely being spent for. In fact, I think we mentioned a while back about the housing. I think you are also experiencing the discretionary spend even on the automobile. So that continues. I think it is going away. What is hurting the consumer is the high amount of EMI that he's paying, and particularly the rate of interest in a given situation. On one side, everything is becoming costlier because of the inflation. On the other side, I think the RBI is employing the higher amount of monetary policy which is making things even worse. It is making even more complicated, more costlier. So as a result of which, I think the entire consumption space does get affected, and so is the impact on government tax collection also eventually. So in my viewpoint, I think though I agree that I think there is some amount of slowdown is seen in the urban space, nothing fundamentally wrong with the consumption. If the rate of interest starts coming down, you will see automatically the positive impact coming into the books of most of the companies which are the FMCG segment, or even for that matter discretionary consumption space in FMEG, or at the same time automobiles.
Okay, that's of course on consumption, and all eyes on HUL today. Kush, let me take a quick view on that note. HUL?
Not encouraging just yet. We know the entire pack has been under a bit of a pressure here. There is a base formation in place, so I will give a level which is 2300. I think if the results come out, even if they surprise on the negative side, as long as 2300 is held, I think this attempted recovery could find some traction. So watch for the 23, 2310 kind of zones as a support zone from a near-term perspective.
Okay, Nifty IT has made a good move, but we'll shift focus to the OMC space. Citi maintains a buy rating on IOCL, BPCL, HPCL. Mihika joining us with the rationale on that one.
So what Citi is saying that the OMCs are right now showing an opportunity to buy on dips. They do have a positive outlook for the stocks. They maintain a buy on all the three counters. IOCL target price at 190, BPCL target price at 390, and HPCL target price at 450, which provides a 22 to 45% upside depending on the previous close. They do expect strong numbers in terms of Q3 for IOCL, BPCL, and HPCL in Q3 as well as Q4. While there are some positive while there are some headwinds for the space for Q4, the Citi is saying that the inventory gains and the LPG compensation expected is set to offset all the negative factors in Q4, and now they're seeing a buying opportunity in the three counters due to the recent 5 to 10% correction. Also, the companies have underperformed versus their upstream peer, which is ONGC. So yeah, it's a buying opportunity on dips is what Citi is saying.
Okay. Interesting one, interesting take coming in from Citi. Devin, any view with regard to the OMC counters? You feel that there's a possible opportunity there?
No, Harsh, I think the volatility in the crude oil prices, I think, is not something which is very easy to understand.
Right.
Global dynamics have started changing, and probably today, if you hear the news, I think there is going to be an extra supply which is going to happen, which is good news for the energy segment as a whole. But what happens immediately, I think, to the pipeline inventory of some of these companies or the forward purchases that these companies may have made is not clearly known. So it's becoming very difficult, I think, for making any near-term projections about the business in the OMC segment. As such, I think we believe that I think most of this particular play a commodity play. And commodity play is not in favor and the market is on the downside. So certainly, I think one need to wait for market to stabilize first before I think buying anything into the commodity at these levels.
Right. Kush, five-star business, I was just telling Harsh, there's a sudden spike in that particular counter. Any reading from the charts?
Well, I think again very close to support zone. 635 is a good support zone. If you see the low of the day is also fairly close to that level, 633. I think it's a spike from those levels. You're right that the spike is fairly recent, but this is also volume backed. So I'm not sure if there is a news piece or if there's a result or anything. But the move is certainly quite noticeable and volume backed. The only challenge here is that the 685 mark is the 50-day moving average. The stock came close to that level and slipped from those levels. So any closing above the 685 mark will push the stock further higher, but an interesting move for sure.
Okay, Devin, if I were to club all of these NBFCs, including the housing financiers especially, because 5-star does largely secured, and therefore I'm just clubbing all of these housing financiers, are they looking interesting? I understand that you are suggesting that rates have gone up and therefore you are seeing some pressure on real estate, but that could well be an opportunity to buy housing financiers and play the real estate theme through that. Is that a good way to play the theme?
In fact, I think the housing finance is a defensive play within the real estate. And I think we believe that even the market volatility in form of, I think, whatever reasons it may have, I think the housing finance companies, they remain distinctly well positioned from a perspective of, I think, continuity of the business. In the real estate segment, companies are growing at, say, for example, 20% rate of growth. Pretty sure that the housing finance companies are likely to grow about 20% rate of growth. So from that perspective, I think we remain distinctly positive about the outcome of the housing finance business. At the same time, I think you are also mindful about the fact that when the rate of interest starts coming down, I think it is also going to be an opportunity for many of the housing finance companies to expand the book at a faster pace. And that's what I think one cannot rule out. Given the possibility that the rate of interest is coming down, I think in this calendar year, I would rather remain selectively bullish on some of the housing finance companies, including the likes of Bajaj Housing Finance, where we believe that the underlying fundamental growth story remains absolutely robust and quite compelling compared to many of the peers in the industry. I think the business model itself is, I think, quite compelling. So, in my viewpoint, I think this could be an opportunity in a given situation when the market is giving due to the pressure elsewhere on the prices.
Now, shifting focus to the World Economic Forum 2025, which is underway at Davos, my colleague Neeraj Shah, who's at Davos, caught up with Anish Shah, Group CEO of Mahindra Group and Managing Director of Mahindra & Mahindra, who talked about how the markets will fare in 2025. Listen in.
Based on discussions with various global CEOs, we see much more optimism than I would have expected. And that optimism is coming from the fact that the US economy is likely to be further on the upswing. That's driven by many of the actions that President Trump will take. Yes, there will be some issues with regard to tariffs, some level of deglobalization as well, but there will be bilateral deals, and that's one of the areas that countries will look forward to. So, on balance, we see a much greater level of optimism with regard to the global economy.
Okay. What's your own sense here? Because you are present in the US, so US economy doing great is good for you. I mean, US exceptionalism, third year in a row, who knows, it'll be great for you. But you also have such a larger presence in India too. How does all of this augur for growth in 2025 from your perspective?
So we are very optimistic. We see the US as an important market. We've been manufacturing tractors there for the last 25 years, and we've got a very good position in the tractor space that we play in the US. In addition, Tech Mahindra is well positioned there. We've got a lot less dependence on H-1B visas, and therefore we're ready to grow in the US. India has great fundamentals, and India will add as much GDP globally as will the EU by 2030. So we're seeing this market as a very important one, and we are driving our growth ambitions in India.
Got it. What do you feel about the first 3 quarters, if I can call it a lull, so to say, relative to what we've seen in the past? Is it a pause before an uplift? Is it possible to even predict that? Or is it a wait and watch approach when it comes to the Indian economy per se? And again, what is it that you hear from your counterparties that you speak to who might be investing into India through you?
So we believe the fundamentals are very strong. We will always have some blips along the way. We saw rural being weaker for the last year or maybe 18 months. Rural's come back fairly well now. So we will continue to see some pockets have some level of weakness, but that's par for the course. That nothing's going to work in one straight line, but the fundamentals are strong. The path forward looks very good, and in terms of what we hear from folks around the world, they're looking at India even with a greater degree of urgency than I've seen before.
Wow. So, I mean, in some of this would be helpful for the tech businesses that you run. Though, interestingly, this whole H-1B visa and green card news came in. By the way, does it have a material impact on the tech sector employees, or is it now a lot of hire local for the US and offshoring might be a little less than what it used to be? Any thoughts there?
I think it's too early to say. We'll have to see how this develops. I just saw that 18 states have filed lawsuits against it as well. So I think there's a long way to go before we get the final outcome as to what will happen.
All right. That was the entire outlook for Mahindra Group of companies. Kalyan Jewelers is this one counter which is hit 490 right now. Kush, again, how much more of a downside for this particular counter with respect to the charts?
Well, I might perhaps go to the extent to saying that, perhaps the downfall might just be over, at least from a near-term perspective. We are seeing the first, perhaps the second day of a meaningful bounce yesterday. That bounce gave away on the day before move. But we are starting to see that volume back up move. The daily charts are also suggesting, daily, positive divergences and rebound from oversold territories. So there's a possibility that, in the near term, this is one level where the stock might, hold its ground for some time. If it doesn't, then you're looking at a 450, 455 kind of a level on the downside. But then there's a possibility that it just might hold the ground basis a couple of technical parameters that I just laid out.
Okay, Kush, quickly, your calls for buy today, sell tomorrow, or vice versa?
Sure. No, it's a BTST trade. It's on Escort. The stock's been consolidating with a goodish positive bias, and it's seen a bit of a meaningful recovery in the last month and a half. From a near-term perspective, you're looking at targets of 3650, 3725, 3500 being the stop loss. So Escort is a BTST trade.
Okay, let's quickly look at some of the events that we have in store between today and tomorrow. You'll have several earnings, but just a couple of quick macros. One is you have ECB President Lagarde who's going to be speaking today. So some bit of context on macros and how she views developments. Second is going to be Japan imports and export data, but that's okay. In terms of earnings, there are quite a few. You have Adani Energy Solutions and Adani Green Energy, which will declare numbers. You'll have Cyient. After Cyient, DLM's numbers, Cyient will declare numbers as well. You will have Dr. Reddy's Lab to declare numbers, Emphasis, Ultratech Cement, United Spirits, all of these will declare numbers. Some stocks which will be exiting lock-in, and there are some chunky ones here. Sanathan Textiles, 3% lock-in expiry to happen. Mamta Machinery, 4%. DAM Capital, 6%. And Concord Enviro Systems, 5%. You could well see some moves on some of those. IREDA is going to be having a board meeting as well to consider QIP. So those are some stocks where you will want to keep your eye out, because there could be moves on the back of certain corporate action that may happen, as well as certain lock-ins which may expire. But Devin, if I were to request you, just give us two pockets, two spaces where you believe there's a good opportunity in 2025, given everything that's happening, or given the last 15 to 20 days, both earnings as well as macro, as well as whatever is looking up in terms of how President Trump is putting out his statements. Your sense of two sectors where you're constructive.
So one would be immediately the niche play in engineering R&D space, where the companies are specifically providing the solutions to respective verticals. Be it, I think, the verticals like automobile, or for that matter, aviation, or for that matter, entertainment, media, etc. I believe, or renewables for that matter. Those companies which are engaged in providing the solutions, engineering solutions along with the IT, and I think using the digital, they are the ones who are likely to see the higher amount of inflow of business. At the same time, I think higher amount of visibility for next few many years, because this is one segment, I think, which is emerging big time, as in my understanding. The second segment, I think, which we remain distinctly positive about is the spending, the consumer spending. So retail focused NBFCs, including the housing finance businesses, they could possibly show relatively more resilience in a given situation. And should the rate of interest start coming down, it will, in fact, I think, start giving them the maximum amount of advantage, or call a tailwind thrust, which probably, I think, would make surprise, I think, to many of the investors also in a given situation. So we remain distinctly confident about the possibilities in these two spaces which you asked for.
Right. Quickly, HUL is also expected to post its result anytime, post markets. Revenue may rise by 3% as per Bloomberg estimates. EBITDA will be flat. Net profits will see a slight uptick of around 5 to 6%, but margins will see a sharp downtick from 24% to 23%. Single-digit growth, demand to remain muted. Urban consumption, we'll have to watch out for as to how that pans out. Margins to contract on account of raw material inflation, and volume growth to remain range-bound. Key things to watch out for will be Quality Wall subsidiary and minimalist acquisition. But Harsh, markets are closing. Benchmarks have recovered, but broader markets have not.
Well, yes, a little bit of a recovery there as well, Mahima. But first off, let me thank both our guests for this afternoon, Devain as well as Coach. Thank you so much for joining us, giving us all of that perspective. Back to where markets are at. Nifty 50, if we can pull up the intraday chart, see where we've recovered from. And it's looking decently good. Look at that recovery. We're sitting at the day's high. We're sitting pretty. So surely looks like a good close, at least for today. What was a choppy day of trade has turned out to be positive. But the reversals not helping traders, I'm sure. So that's how it's playing out. Let's look at also the Nifty mid-cap and small-cap indices, the broader markets first. Try and judge the kind of recovery we are seeing there. So a bit of recovery there as well from the day's lows for sure. So 16,000 was the day's low. We've recovered nearly 200 points from there. So not bad by any stretch, a percent higher from those lows. So clearly solid in that sense. The recovery is decentish in trade today. And that was led largely by banks and IT. So let's pull up the Nifty Bank first off. Intraday, there you go. That's the spike we saw on the Nifty Bank. And if we can pull up the IT index as well, IT index also closing at the day's high, but no spikes there because the IT index in any case was doing ever so well, 2% higher on the Nifty IT index. Let's pull up the constituents of the Nifty IT index and you'll see some good gainers among the large cap counters. Look at that, the top 4 IT counters, Wipro, Infy, TCS, Tech Mahindra, all of them gaining 2% plus. Very, very healthy both on TCS and Infy, up 3% each. Wipro is up nearly 4%. So strong gains posted by all of those. Persistent is the one big loser within the Nifty IT pack. Let's pull up the Nifty Bank as well, similarly in terms of constituents. And we'll see that HDFC and Kotak standing out after those numbers that HDFC posted, 1.8% higher now HDFC. IndusInd also bouncing back, up 1%. From yesterday's close. So clearly doing well, some of those counters. Let's pull up the heat map on the Nifty 50 and we'll try and see how the breadth is improved. Not much on the Nifty per se, but we saw a couple of stocks really flip, something like a heavyweight HDFC flipped, and that's likely why we've seen the positivity in Kotak as well, and as well as IndusInd, and that kind of has helped. The entire pack has helped the Nifty stage a very, very strong recovery in the latter half of today. But that's how the Nifty heat map is looking overall. Let's also look at sectors and we'll try and cull out themes here. The Nifty Pharma Index is doing well. The Nifty IT up 2+% at close. So clearly we spoke about that as well. Pharma was also doing decently well, but really the Nifty Bank and the Fin Nifty are the two indices which have really staged a recovery. The Nifty PSU Bank still sulking. It's closed a percent lower in trade. The Nifty Auto Index just slight negative bias, and the Nifty Realty down 4.5%. Now it's down 25% from its 52-week highs. So keep your eye out on that one because there's been a very, very sharp underperformance there where the Nifty Realty is concerned. Last off, the BSE 500 top gainers, top losers list. If we can just quickly cull out some, Bombay Burma is up 16.5% at close. Very sharp. Bajaj holding up 4.5% as well, the holding company for the Bajaj group. But earnings, IndiaMart, Polycab, India Cements, Suntech after yesterday's rally closed just near the flat line, down 6.5%, dragged along with the entire realty pack. SW Solar and ICICI Pru down 6% on the back of those numbers. MCX staging a bit of a comeback, 4% higher after yesterday's hammering in trade. And Wipro also seems to have done fairly well along with other players in the IT pack. But for now. From Mahima, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
This January, the world will come together at the World Economic Forum at Davos to bridge differences, because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about three key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold into the mutual fund industry over the past couple of years will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate, and what that means is that depending on which income slab you fall in, if you're in the highest tax slab and you're paying 30% on the income above a certain threshold, your gains from debt mutual funds are also taxed at 30%. That wasn't always the case. Long-term capital gains came into effect after a period of 3 years, and they were taxed at 20% with indexation benefits. Of course, that doesn't remain the case anymore. So the mutual fund industry is asking for a rollback to the previous tax treatment because they say that the debt market in India is growing, is emerging, and it needs to be incentivized. The third change that they're suggesting has to do with the income distribution schemes. Of course, there are two types of schemes in mutual funds. One is the growth scheme, where all gains are reinvested by the fund manager. And in the second case, which is the dividend distribution scheme as it used to be called, the income is distributed on an ongoing basis to unit holders. Now, the thing is, income above 5,000 rupees that is distributed in this manner will have to have tax deducted at source, or TDS, as things stand right now. And the mutual fund industry is suggesting that this threshold be raised to 50,000 rupees, and they expect that this will benefit a lot of people because they won't then have to have tax deducted at source. Of course, there are more proposals that they've made, but we'll see what the finance minister takes up when she presents her budget for 2025.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your
Hello and welcome, you're watching Market Express and I am Aditya Rao. This is a bit-sized wrap of all the news and market action today. Let's get started with some market updates. Markets bounce back today to end higher. The Nifty ends above the 23,100 mark, whereas Sensex ends above 76,400 mark. Broader markets underperform benchmarks. The midcap index falls over 1%, with Polycap being the top laggard on the index on the back of Q3 results. The small cap index cracks 1.6%, with Keynes Tech being the top loser. Sectoral action mixed. Realty index cracks the most, followed by PSU banks and media. IT index outperform the sectoral indices, followed by the pharma and private banks. Citi has come out with a note on oil and gas companies, highlighting the opportunity to buy stocks in the space. Citi expects strong Q3 results from the companies, sees inventory gains, LPG compensation offsetting negative factors in Q4. IndiaMart shares crash after the company reports a decline in paying subscriber base. Nomura downgrades the stock to reduce from neutral and slash target price of the company. Nuvama retains a reduced stance but lowers the target on the stock and says margins are higher due to lower investment. Tata Tech stock crashes after the company reports Q3 numbers and revenue missed street estimates and margins come in line. The company faces near-term challenges in Q3 due to delay in decision-making in the US. NDTV Profit spoke to Warren Harris, the MD and CEO of the company, earlier, and he says that growth has been challenging due to policy uncertainty in the automotive industry. Oberoi Realty shares declined despite a strong performance in Q3. Jefferies maintains a hold stance on the stock, says pricing and margin focus is visible as company choose higher realizations. Brokerage firm Antique says that sales uptick was due to Thane project launch and sustenance sales remain weak. Citi maintains a neutral on Oberoi Realty, says the company continues to execute and is evident from the high residential operating margin. Cyan DLM slides amid pressure on profits and margins hit by M&A costs. The company's organic order book excluding acquisitions has fallen. The company's revenue split diversifies with the acquisition of Alltech. Varun Beverages shares have been on a downward spiral, down over 16% in last 6 months. As per NDTV Profit's research analysis, high polyethylene triphthalate or PET prices hit the company's margin. The gross debt increases 21% in the first half of FY24, and other factors like heat from Reliance's Campa Cola, predatory pricing from Campa Cola, and RIL entering rehydration category is not working for the company. HDFC Bank stock jumps after Q3 net interest income moves in line with street estimates. The operating profit of the bank comes in at 25,000 crore rupees, matching NDTV profit estimates. The provisions come in slightly higher, up 17% sequentially, and the bank reports a profit of 16,736 crore rupees, higher by 2% year-on-year, in line with Q3 estimates. Centre increases MSP on raw jute by 315 rupees to 5,650 rupees per quintal for 2025 and 26 season. The cabinet approval will result in a return of 66.8% over all India weighted average cost of production. Since 2014-15, the MSP increase has been 2.35 times till today. Keynes Tech, the stock fell after the company's board approves raising of 1,600 crore rupees. The fundraising could be done through a qualified institutional placement or QIP. Alternatively, the fundraise can also happen through a preferential allotment by one or more ways of public or private offerings. The board has also constituted a committee of directors of the company to deal with the matters pertaining to the fundraising. And that's a wrap on Market Express today. Stay tuned to NDTV Profit. There is lots more left from the Davos. So many special interviews and views on NDTV Profit.
Well, thanks for tuning in to day 3 of the World Economic Forum coverage in Davos on the NDTV network. And it's an absolute delight to be talking to Dr. Anish Shah. Needs no introduction, of course, but would be lovely to understand from him how is he seeing the atmosphere, the optimism or the lack of it, and the mood in the Trump 2.0 era. Dr. Shah, thanks for joining in. The day one was obsessed with what Donald Trump might or might not say and do. He brought out the uncertainty factor for sure by saying that, hey, tariffs are coming, but let's wait and watch here. How do you see the mood here at the WEF when it comes to growth and outlook for 2025? And your own view, of course.
Good morning, Neeraj. Pleasure being here with you. Based on discussions with various global CEOs, we see much more optimism than I would have expected. And that optimism is coming from the fact that the US economy is likely to be further on the upswing. That's driven by many of the actions that President Trump will take. Yes, there will be some issues with regard to tariffs, some level of deglobalization as well, but there will be bilateral deals, and that's one of the areas that countries will look forward to. So on balance, we see a much greater level of optimism with regard to the global economy.
Okay. What's your own sense here? Because you are present in the US, so US economy doing great is good for you. I mean, US exceptionalism, third year in a row, who knows, it'll be great for you. But you also have such a larger presence in India too. How does all of this augur for growth in 2025 from your perspective?
So we are very optimistic. We see the US as an important market. We've been manufacturing tractors there for the last 25 years. And we've got a very good position in the tractor space that we play in the US. In addition, Tech Mahindra is well positioned there. We've got a lot less dependence on H-1B visas. And therefore, we're ready to grow in the US. India has great fundamentals. And India will add as much GDP globally as will the EU by 2030. So we're seeing this market as a very important one, and we are driving our growth ambitions in India.
All right. What do you feel about the first 3 quarters, if I can call it a lull, so to say, relative to what we've seen in the past? Is it a pause before an uplift? Is it possible to even predict that? Or is it a wait and watch approach when it comes to the Indian economy per se? And again, what is it that you hear from your counterparties that you speak to who might be investing into India through you?
So we believe the fundamentals are very strong. We will always have some blips along the way. We saw rural being weaker for the last year or maybe 18 months. Rural's come back fairly well now. So we will continue to see some pockets have some level of weakness, but that's par for the course. That nothing's going to work in one straight line, but the fundamentals are strong. The path forward looks very good. And in terms of what we hear from folks around the world, they're looking at India even with a greater degree of urgency than I've seen before.
Wow. So, I mean, in some of this would be helpful for the tech businesses that you run. Though, interestingly, this whole H-1B visa and green card new scheme, by the way, does it have a material impact on the tech sector employees, or is it now a lot of hire local for the US and offshoring might be a little less than what it used to be? Any thoughts there?
I think it's too early to say. We'll have to see how this develops. I just saw that 18 states have filed lawsuits against it as well. So I think there's a long way to go before we get the final outcome as to what will happen.
Okay, fair call. A bit of a focus on auto, naturally so, because you're creating quite a ripple in the markets with the kind of products that you're launching and the kind of pricing too, Dr. Shah. Now, a lot of people are saying, calling it, my own analyst calls this a daring strategy, wherein you are daring the market that, hey, I'm coming out with a product which is priced at a punchy level. Come and try and see if you can disrupt my sales. Now, I'd love to know what went behind that thought on the pricing, because we've spoken on the product before. We haven't spoken quite on the product and the pricing together.
So our approach is to drive profitable growth. And therefore, our pricing is not to just go and get sales right now and then worry about profits in the future. That's not how we work. So what you're seeing is actually the strength of our product development, the ability to develop world-class products at prices that are very competitive. And we've seen that across multiple ICE products over the last few years. You're seeing that in electric now.
Yeah, certainly. So But is this a factor of a particular gross margin that you want to make, or is it also positioning that you want to do with the first of the, technically not the first, but the first of the really new age, cutting edge looking and feeling products that you launched on the EV side?
We will always look at gross margin as a factor, and that is an important one. When we launched the XUV700, there were the same set of questions on pricing, saying, are we being very aggressive on pricing? And that's one that has worked well for us. It's a product that gives us good margins. And similarly, we are building the EV portfolio with a set of outstanding products that are priced very well for the consumer.
Sorry, I'm just probing this a little bit more. By aggressive, I don't mean it in a negative fashion. All I'm asking is, it's by design that you're choosing to be a bit more aggressive because you want the product positioning to be of a particular pattern?
We believe that it has to be a product that is affordable for the customers that we serve. And therefore, we've got to develop it in that manner. So aggressive is not pricing below cost or pricing in a way where we're going to make losses to get market share. It is pricing based on the product that's developed with reasonable margins and one that we feel is required to be able to create a much stronger EV portfolio that we will develop over the next period.
Okay, last question on autos per se. So there are two strategies. I'd love to pick your brain on this. One is that people start with a low price model and then eventually inch up higher as the particular brand gets developed for a new product. Are you going the other way, wherein you are pricing or coming out with the premium product first, and then maybe you will look to launch lower priced electric vehicle options in that same category?
So our product strategy is more based on consumer lifestyles, and we will have products that meet various different consumer lifestyles. You see this in the B6 and the XUV9E. They're two very different products.
Fantastic looking board, by the way.
And yes, we hope that all of our products are fantastic looking. We've got a great team and they're doing a great job there. So for us, it's not about just price. It's about creating that product for that lifestyle. And therefore, we will have some that are more premium. We will have some that may be less premium, as you call it, but catering to a set of customers that want that type of product.
Okay. Last couple of questions. One is this whole tractor upcycle piece. Now, I'm just wondering if you are even more bullish on the tractor division in 2025, because while the Indian tractor upcycle was always a belief, what you spoke in the opening answer about the US GDP growth and what the tractor business could do out there, does it make you feel that 2025 could be one of the best years in recent times for the tractor business?
We've seen good years in recent times as well. The first year of COVID was one where the tractor market grew 27%. We don't expect that level of growth at this point in time. But our business is doing very well. We are at a 44% market share, up 4 percentage points, which is not easy to do when you're in the 40s. And that gives us, again, a lot of confidence that, yes, the market is looking positive right now. Our business is positioned well. So we will have a good year. Whether that's as good as a 27% growth, probably not. But we do look forward to a good year.
Okay, last two questions. One is on the IT services business. And Tech Mahindra numbers were better than anticipated for sure. But when I scanned the notes while I was here about what the larger review has been for IT services, you could use the term neither here nor there. You could use the term that there is not enough clarity about what could happen in 2025. Would that be a fair assessment? Because clients may be firming up their budgets, etc., and therefore this might not be the time when anybody could have clarity. Or do you believe that that may be true for the sector, but for TechM you have a different thought?
So for the sector, technology is continuing to be an important part of growth for every industry, and therefore that's not going away. For TechM, we've underperformed versus industry in the past. We've laid out a very clear plan to get back to industry average. That plan is being executed well. We're almost 1 year into it now. And we feel very good about where TechM's headed and about it staying on course to be able to get back to industry average and then get above that after that.
And 2025 might well show glimpses of that as well.
2025 has to be a year where we meet important milestones along the way. And yes, so it would be an important year from that perspective.
Okay, last question. On the India promise out here at the WEF, the interesting piece this time around that I thought, we used to be present across the breadth of the promenade. The India Pavilion by itself, or the State Pavilion, is now a one high rise, etc. Maharashtra has announced some really large sums of MOUs. We were doing an event with Andhra Pradesh government yesterday, and there is a lot of promise as well, they say. How do you see the India promise out here at the web this time around, from the government side and maybe from the corporate side as well?
Very strong. And it's not just the presence that our states and our companies have here, but it's also how global companies are seeing India. We're seeing, as I mentioned earlier, a much higher level of urgency. And many CEOs in the past were looking at India and saying, we need to play there, and we're still figuring out how we play there. What I'm hearing now is that we're just coming there and we'll figure out how as we go along.
Interesting. Music to the ears. Great. Dr. Shah, thank you so much for taking the time out, and have a great remainder of the WEF.
Thank you.
All right. And viewers, thanks for tuning in.
They say fortune favors the prepared. The more prepared you are, using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
I present the budget for a historic
This January, the world will come together at the World Economic Forum at Davos to bridge differences, because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
Hey everyone, with Budget 2025 right around the corner, there is one question on everyone's mind. Will this finally be the year salaried individuals get some much needed income tax relief? Let's dive into the story behind the tax slabs, the rising cost of living, and why economists are calling for reforms. First things first, Budget Day is set for 1st February 2025. Expectations are sky high, especially among salaried individuals. But before we talk about predictions, let's rewind a bit. The first big moment for taxpayers was back in the Union Budget for FY 2020-21. That's when the government introduced an optional personal income tax regime with lower tax rates but fewer deductions. Remember that? It shook things up for taxpayers who had to choose between the old system with deductions or the new simplified one. Fast forward to 2023 budget, Finance Minister Nirmala Sitharaman made some tweaks to the new tax regime, expanding 2 income tax slabs and increasing the standard deduction from 50,000 to 75,000. Sounds promising, right? But here's the thing. It didn't touch the old regime at all. So what exactly is standard deduction and why does it matter so much? Think of it as a fixed amount you can subtract from your taxable salary. It's meant to help with everyday work-related expenses. While it's been raised over the years, the question is it enough to combat the rising costs we're all facing today? Did you know the standard deduction was actually scrapped back in 2005, but it made a comeback in 2018 at 40,000, and since then it has been climbing steadily. Now economists have a big ask for Budget 2025. Cut income tax rates. Why? Lower taxes means more disposable income in your pocket. That extra cash could boost savings, increase spending on essentials, and even revive demand in sectors hit by sluggish consumption. Sounds like a win-win, right? In fact, during a recent pre-budget meeting, experts suggested exactly this to Prime Minister Narendra Modi, arguing that it's time to ease the financial burden on taxpayers while stimulating economic growth. As per an NDTV Profit exclusive, the upcoming union budget could bring significant income tax relief with potential modifications to the new tax regime. Sources suggest the government is considering adjusting personal income tax slabs and reducing tax rates for incomes up to Rs 10 lakh to boost disposable income. The new tax regime, which restricts exemptions and offers fewer deductions, is already the default option for taxpayers, with 72% having shifted to it. Notably, the July budget increased the standard deduction to 75,000 and revised both tax slabs and rates. Under the new structure, income up to 3 lakh is tax-free with progressive rates ranging from 5% to 30% for higher income tax brackets. As Budget 2025 nears, there are growing expectations for reforms aimed at easing tax compliance, particularly for NRIs, that is non-resident Indians. Here are the key suggestions highlighted.
Rally in tech stocks helped subside markets midweek blues. Nifty Sensex end 0.5% higher. Sectoral indices end mixed with deep cracks in realty index of nearly 5%. HDFC Bank's Q3 asset quality worsens, profit beats estimates driven by fall in provisions. HUL's Q3 in line with estimates. Net profit rises 19% year-on-year. Company reports one-time gain of 507 crore rupees. Cabinet increases MSP of raw jute to 5,650 rupees per quintal. This would ensure a return of 66.8% over all India weighted average cost of the production. In a fresh development of high-stakes family disputes, the Lodha brothers are fighting it out over using their family name for their businesses. Whereas there is some relief for Kirloskar Brothers Limited with the Pune court allowing it to use the surname trademark. We at NDTV Profit are focusing on what the everyday consumer expects from the Finance Ministry. We bring you discussions on topics like agriculture, railways and more in the run-up to the 2025 Union Budget. President Trump announces joint venture by OpenAI, SoftBank and Oracle to invest $500 billion in AI infrastructure for a project dubbed Stargate. Hello and welcome. This is Profit 360 on NDTV Profit and I'm your host Himakshi Bahuguna. Along the next half an hour, we'll bring you the latest on the markets as well as national and international news. So viewers, the markets have rebounded after yesterday's bloodbath on the D Street. The Nifty closed in the green at around 23,160 while the BSE ended up by 0.75%. The IT sector led the rally, gaining 2.14%, while realty and media sectors dragged the indices down. Harsh joins in with a lot more details on this.
Well, very healthy recovery in what was, for a predominant part of the day, a very tough market. It was choppy, but thereafter, around 2:30ish, we had HDFC Bank's numbers come in, and the Nifty Bank saw a rally which led the index also higher, the Nifty 50 index. Outside of that, IT stocks were in focus. They were doing very well through the day. Likely, the US stability with regard to policy as well as macro, likely aiding those IT stocks, including taking cues from US markets. So IT was definitely in focus, doing well. Banking followed suit post the HDFC numbers. We saw HDFC recover over 2% from the day's lows, so did very well for itself. And as a heavyweight, not only did it impact the Nifty Bank, if we can pull it intraday, the intraday chart, you'll see the manner in which HDFC Bank moved, the Nifty Bank as well as the Nifty 50. And you'll see that move was largely driven by banks, and you also saw it spill over and rub off on other banks. IndusInd and ICICI also recovered from the lows. Kotak did very well again today. And again bounced off from the lows. So some of those stocks pockets doing well and aiding the Nifty 50 index. Where the breadth of the market was concerned, on the Nifty 50, it was an even keel, 25 stocks advancing and declining. But on the broader markets, there was a lot of pain till the last hour of trade. And broader markets also saw a bit of a reversal thereafter. We bounced back nearly 1% from the day's lows on the Nifty mid cap as well as the small cap. What was looking like a very, very difficult day, which could have gone or become only worse, actually got better, and we saw a bit of a recovery. In terms of stocks and sectors which gained, if you can pull up the sectoral heat map, we saw IT doing well, we spoke about that, but pharma also stood out today. It was a tough day and some of the defensives did well, IT, pharma. And we saw the private banking index do well, along with the Nifty Bank. The PSU banking index, on the contrary, was down 1%. So that was the divergence we saw. Along with some of the others, slight negative bias on the Nifty Auto. We also saw the Nifty Realty tank another 4% lower. Now it's 25% down from the 52-week highs. Are opportunities popping up there is a big question. Last off, the BSE 500 top gainers, top losers. A lot of those were on the back of earnings and numbers. And you'll see a lot of those on the negative side impacted by earnings and numbers. But outside of that, it was a negative day on the markets, but we ended the last hour in positive fashion. Therefore, looking forward to tomorrow.
Stay with us, Harsh. HDFC Bank has come out with their Q3 earnings and the asset quality has worsened. So if you could just break down the numbers for us.
Well, HDFC Bank's margins haven't really recovered this quarter, so it'll likely be another quarter to wait before we even can expect anything on the margin front. 3.43% is what the margin number has come in at. So tough to turn the tide on such a large bank, but that's how it was. Let's look at how the other numbers really are stacking up. You're looking at net interest income largely in line, nearly 1% higher from what we were estimating. It's coming at 30,600 odd crore. You're looking at operating profit smack in line of what our estimates were suggesting at 25,000 crore. We were expecting provisions of around 3,000 crore. They've come in at 3,150 crore. So largely in line on the provisions front as well. And profit after tax, we had estimated a 17,000 crore number. It's come in at 16,800 nearly. And therefore largely in line even on that count. It's a very, very solid set. We saw a bit of a spike up on NPA ratios. We'll have to wait and watch as to what has led to that spike. But we've seen a bit of a spike up. And you're looking, as I did mention, on the margin number, 3.43%. How quickly can that recover? The loan to deposit ratio has come below 100 now. How quickly can it go back towards 90% is the big question. And maybe some of those answers are built in to the con call, which we will attend later today and give you an update on.
Thank you, Harsh, for taking us through those numbers there. Now, relief for Sanjay Kirloskar's Kirloskar Brothers. The Pune court allows KBL to use trademark surname Kirloskar. Charu joins in now with more on this.
So in this story, there are two important parties. One side is Kirloskar Brothers Limited, whereas on the other side, we have Kirloskar Proprietary Limited. Now, Kirloskar Brothers Limited was always using the Kirloskar trademark, which is basically their own surname. And Kirloskar Proprietary Limited also got transferred this trademark once the family divided its assets in business based on a family agreement years back. Now, they're embroiled in a family dispute alleging mismanagement and other allegations on each other. However, in a relief to Sanjay Kirloskar run Kirloskar Brother Limited. The Pune court that was hearing one of the aspects of the family dispute gave them some relief, saying that they are allowed to keep using this trademark. Now, what was the case of KPL, which is the Kirloskar Proprietary Limited? It was saying that after getting the trademark, the company basically served termination notices, and that is why the agreement was breached and they should not be allowed to use the trademark anymore. However, Pune court did not find much substance in this argument and saw that KBL should be allowed to use the surname as a trademark.
Right, Charu. Now, viewers, let's cut across to press conference of Hindustan Unilever. Writes H. Tiwari, CFO of HUL, is addressing the numbers.
While PAT grew by 6%. Looking ahead in the near term, we expect moderation in demand trends to continue. In this context, our focus remains on driving competitive volume-led growth across our portfolio, prioritizing investment across core, future core, and market makers portfolio. If commodity prices remain where they are, we expect a low single-digit price growth in the near term. Amidst inflationary market prices of materials, we expect to maintain EBITDA at lower end of our range of 23 to 24%. We will continue to manage our business dynamically, driving savings through a net productivity program and provide the right price-value equation to our consumers. We remain focused on our job of transforming the portfolio. The mid to long-term opportunities in the FMCG industry is immense. With strategic clarity and operational excellence as our foundation, we are well positioned to leverage this opportunity and grow competitively. With this, I complete my prepared remarks and we can now take questions.
Thank you, Ritesh. Shilpa, would you like to ask the first question? We'll come to you, Sesa. Shilpa. Okay, Sesa, you can ask the first question, please.
Right. So thank you for the opportunity. So, firstly, I would like to know, how is the current demand scenario looking like? As we speak, are you seeing any signs of improvement in urban demand? And also, are there any near-term triggers that you think would aid demand going forward? That is one. And second, on the minimalist deal, if you could give some more insights into, how this fits into HUL's overall strategy, as we know that the company is focusing on, sharpening its BPC focus. So on those lines, if you can just share some insights.
Maybe I can speak to the market trends and then request Ritesh to give you some understanding in detail on the minimalist joining our family. On the market, we clearly see rural gradually improving consistently over the last few quarters, and that's good news. Urban, on the other hand, continues to moderate in terms of growth, and at this point, we see that trend continue in the near term. As a result of which, the overall market is muted because it's a combination of these two sectors. We expect going forward, given the good signals from both the Kharif and the Rabi crops, that the rural markets will improve. And on urban, it really depends on the macro factors. But as far as we are concerned, as I have been saying in the past such calls as well, that our job is to do what we can control, which is to go where the growth is, invest behind our operational efficiencies, grow competitively, which we are indeed. We're growing competitively across our business by way of volume. And importantly, we will at the same time keep doing what we need to do to be future fit, which is basically as our strategy, which we shared in our capital markets recently, contemporize our core, premiumize our future core, and lead market making. So we're very focused on doing both the operational excellence, competitive growth in the near term, and our strategic investment in the long term. And Minimalist is a great example of how we are investing behind building a portfolio, especially in B&W, that's absolutely fit for the future, and probably a great segue to hand over to Ritesh to speak about the Minimalist brand and why we're so excited about them joining our family.
Yeah, we had mentioned about our own strategy of beauty and well-being, where one of the key imperative for us is to improve and increase our share of the premium portfolio. Minimalist as a brand is deeply rooted in product efficacy and consumer love. The brand operates at masstige price segment within skincare and hair care, and which is why it is a fabulous fit to the portfolio of Hindustan Unilever. It has a very good presence online and hence strengthens our position on e-commerce as well. We have acquired the business at an enterprise value of 2,955 crores. The brand today has basically in the last 4 years' time grown to become a 500 crore business and also profitable. We acquired the business at 5.9 multiple, and we believe that once we unlock synergies of Hindustan Unilever and bring that, so the team Minimalist and team Hindustan Unilever put together can come and create a bigger version of Minimalist, and the synergies that will unlock will also be able to invest more behind the business and realize the potential that the brand has.
Right. And if I can just squeeze one more in, with the rise of quick commerce, as a preferred channel, what is the percentage of your sales coming from e-commerce, and also how much of that is contributed, from quick commerce?
As I mentioned before, e-commerce obviously continues to grow faster than the rest of our business. Still, it's below double-digit contribution at the moment to our business. Within that, quick commerce is indeed growing faster. And I will not be able to share with you the exact share of that, but it is clearly increasing its contribution to the total e-commerce business in our case. We are very mindful of our models where we have a very clear intentional strategy of differentiated assortment by channel. We serve an omni-channel consumer who's shopping for different shopping missions. The quick commerce consumer and the shopper is increasing in their shopping mission. So clearly all the platforms are now, so we have the convenience mission. We also have, the indulgence mission. So therefore including, we are increasing our assortment in quick commerce, and we are also therefore clearly growing quite high in that channel. And we intend to make sure that we are competitive in that channel and make sure that the assortment is clearly differentiated so that we serve the shopping missions that the Kirana stores are there for, and we also make sure that there's little overlap between the two channels.
All right. Thank you so much. I'll come back in the queue.
Thank you, Sesaj.
All right, so that was Ritesh Tiwari, CFO of HUL, addressing the Q3 earnings there. He said that e-commerce continues to increase its contribution in the business. In fact, Puneet is joining us with a breakdown of the HUL numbers. Puneet, over to you.
Well, thanks for that. So, we are seeing the numbers flashing on the screen, so wouldn't go too much into those aspects. Just want to highlight a couple of points here in terms of, an exceptional gain of 507 crores is recorded on the profits. That's, of course, led the beat for the company, and that's from sale of its water purification business under the brand of Purit. So that is one of the key positives that has come in the So it was already announced on 15th of July of 2024 that they will be looking to sell this particular business. The money has now come in on the 1st of November in this particular quarter, and hence recorded a gain of 507 crores. Another key aspect to look at in terms of HUL numbers is they've announced, the demerger plan of the ice cream business under the Quality brand, and they've incorporated a new entity called Quality Walls India for the ice cream business. They have announced a share entitlement ratio. So one share of HUL as a shareholder, you will get another share of the ice cream business. Subsequently, it will be listed as well on the exchanges in due course of time. The company has mentioned they will be looking to complete this particular transaction somewhere around, in this particular year itself. The other key aspect, and one of the biggest ones which, the management also addressed, was the acquisition of the Minimalist brand. It's a skincare brand in the premium space and will be complementary to the products that HUL sells in India. They've announced a 90.5% stake acquisition for an enterprise value of 2,955 crores. The balance 9.5% will be held with the founders and acquired over the next 2 years. That's what the management has said. The team of Minimalist, which is led by its founders, Mohit as well as Rahul, will continue for the period of the next 2 years as well. What's another key aspect is the outlook that they gave in the investor presentation. That's sounding a little pessimistic. Moderation in consumption trend is what they are seeing in the near term. And commodity prices, if they remain where they are, they see that a low single-digit price growth is expected in the same. So that's the overall lowdown of the numbers as well as the multiple transactions that they've announced. The Minimalist acquisition is, of course, a very positive one.
Right, Puneet. Thank you so much for taking us through those numbers there. Now, viewers, in a major decision, the Uttar Pradesh cabinet has approved the formation of a new development authority combining Prayagraj and Varanasi along with 7 surrounding districts. Yes, so this aims to strengthen infrastructure across the region, including Prayagraj, Varanasi, Chandauli, Ghazipur, Jaunpur, Mirzapur and Bhadohi. Chief Minister Yogi Adityanath outlined several key proposals, including new investment investment plans for aerospace and defense policies and the conversion of the Atal Bihari Vajpayee Hospital into a medical college. Additionally, the state will expand medical colleges, issue bonds for municipal corporations and focus on improving transportation, including a new 4-lane bridge in Prayagraj to curb the traffic issues. Now, women leaders have shared their expectations from the Union Budget 2025. They have highlighted key issues they hope that Finance Minister Nirmala Sitharaman will address, from harnessing women's potential for entrepreneurs to advocating for improved palliative care. Women leaders call for targeted support in sectors like healthcare, manufacturing and MSMEs. My colleague Uma Sudhir brings in a special budget ground report.
Union Budget 2025 coming up. We are here at the Indian School of Business and I have with me a group of women leaders. Asks from Nirmala Sitharaman.
So manufacturing has only 5% of women working, and I think it's high time we do something to incentivize. Elder care and child care needs to be incentivized so that we can free up the time of women to come and work at the manufacturing places.
You yourself have 2 units where women are working 3 shifts, and for that actually you have to get permissions, you said, from the government.
So that's the rule. We have to apply to the Labour Commissioner and ask for permission for women to be working in the 3 shifts.
Yeah, as we see, the cervical cancer, is kind of becoming the 3rd highest killer of women in the country. And to mitigate this, menstrual hygiene education is very, very important. And as Dr. Shankar Narayan, who headed the WHO cancer, research in India, once said that if you educate a girl about hygiene or about anything in health, you are educating 3 generations, not 2, not her next generation, but her mother back home too. So, in this regard, it is imperative that the government invests in in advocacy and also in forming a syllabus that would go into the school syllabus. There you need to invest budget clearly in terms of garnering the right experts and the right kind of design as well.
Talent and skill is your forte.
Yes. So today there's a lot of talk, I think the government, both at the centre and state level, is talking about skill development to make India globally compete. But the sad part is when it comes to skill development, and I'm not talking about the government schemes, it's still being taxed at 18% GST, which to me seems very high when you're kind of making that a priority area. So that is something that if it can be considered, I think the number of takers for investing in skill development will be more.
As an entrepreneur, what is your ask?
Well, simply simplify GST tax rates across, instead of having it so complicated, especially food products. I can specifically speak about it's highly complex. I think having a uniform tax rate for food products will support the food exports from India, which we are known for globally.
Okay, we are also going to go walk across and talk about your passion, which is health, and what are you asking the Finance Minister?
Madam Sitharaman does a fantastic job, but health is not considered because it's neither the state or a centre subject. We do fall in between the cracks.
On to some international news now, viewers. President Donald Trump has announced billions of dollars to build artificial intelligence infrastructure in the US. Companies like OpenAI, SoftBank and Oracle are planning a joint venture called Stargate. Executives from the companies are expected to commit $500 billion into Stargate over the next 4 years and $100 billion immediately for projects like data centers and cancer research. President Donald Trump has announced billions of dollars to build artificial intelligence infrastructure in the US. Companies like OpenAI, SoftBank, Oracle are planning a joint venture called Stargate. Companies like Microsoft and NVIDIA are also expected to participate in this initiative. Now, shortly after being sworn in on Monday, US President Donald Trump signed an executive order cancelling the provision of citizenship by birth, which could directly affect thousands of Indian professionals working in the US under H-1B visa and other temporary visas who hope to raise their families there. Tune into The Big Question at 6 p.m. where we ask if Trump's latest move has ended the American dream for Indians. Well, that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
They say fortune favors the prepared. The more prepared you are, using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
This January, the world will come together at the World Economic Forum at Davos to bridge differences because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
Well, Budget 2025 is around the corner and Macquarie has come out with its budget estimates or expectations on each sector. The first sector is the banking space. They do not expect favorable treatment for deposits and possible capital infusion for PSU banks and insurance companies might take place. Moving on to the next sector, NBFCs is the counter. Credit guarantees similar to SMEs for MFI sector can be expected. In the insurance company space, that is the next sector to watch out for, no change in tax rates or any product or any corporate profit tax rate change can be expected in this budget of 2025. The next sector to watch out for will be cement and metals, where they are expecting announcement on import duties to restrict imports on certain metals and certain materials. Moving on to the auto space, outlay for PM E-Drive and PLI can be expected. Policy initiative to drive localization of key EV-related parts can also be expected. The next sector in focus would be the consumption space. Mid to high single-digit increase in cigarette taxes can be expected. The budget, interim budget which was announced last time did not have any tax rate change in cigarettes, which is why we did see an uptick in stocks like ITC and VST. But this time you could see mid to high single-digit increase in cigarette taxes. Reduction in taxes for low middle class consumers could take place, which could boost consumption in the rural as well as the urban spaces. Moving on to the next space, jewelry is the space where no reversal of custom duty cut on gold will take place. In last budget, there was a custom duty cut announced on gold, silver as well as platinum. There will be no reversal on this as per Macquarie. Moving on to the next space, pharma and healthcare, potential support for higher R&D via tax reduction can take place, and PLI for anti-diabetic and weight loss medication could also be one of the factors that the budget might consider. And modest increase in allocation for Ayushman Bharat is something that Macquarie is expecting from the pharma and the healthcare space. Infra is the next space. Capex allocation for key ministries like railways, roadways, etc. Can be expected in this budget, and announcements around additional dedicated freight corridors can also be expected in this budget 2025. Defense is another area where initiatives to boost defense exports can be expected, and announcements around that will be expected, and initiatives fastening domestic defense equipment procurement could also be one of the things to watch out for in this particular budget. Lastly, in terms of power, green energy thrust to continue. Steps to promote initiatives across the value chain, that is to promote green energy, might also be seen during this budget. Oil and gas is the last counter where Macquarie expects that OMC's compensation for LPG under recoveries might be seen. So these are Macquarie's expectation on different sectors as to how budget may come out with different changes in different sectors and how it may impact these sectors.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with.
Hello and welcome. You're watching KYC, which is Know Your Company, and today we're going to focus in on a software company, New Gen Software Technologies. The stock has been a 16 bagger or 15 plus bagger since the day of listing in 2018. But of late has come under pressure due to its Q3 numbers. We'll try and delve deeper into everything that's transpiring. First off, with regard to the company, and let's stick to the basics first. It's a global provider of software product development, and it drives digital transformation through a platform. It also provides services around Gen AI as well as cloud, and it got listed in February of 2018. Just to try to understand this slightly better, I'm going to try to help that. One was incorporated in 1992. It's a application development platform company. A large chunk of its revenues, so around 54%, is annuity, 60% as of FY24, and 45% is largely software as well as implementations. You will have sale of products as well as sale of services, which will comprise the balance in terms of the revenue mix. The worry here has been with regard to growth in the annuity business. Whether that comes back in a big fashion, how quickly can it revive, or whether the larger focus will be on sale of products, sale of services, then what does that imply to both margins as well as growth prospects for the company? That's something we'll want to really talk about. But basically, that's the real breakup, and that's why the stock has been under pressure as well. So we'll try and break this down a little bit better. And for that, I have with me Rucha Somaya, who tracks IT quite closely. And she'll obviously take us through some of the metrics that we look at, and let's pull those up as well. You'll have the income statement, the balance sheet, the cash flows, as well as the return ratios that we will talk about, and how the company has fared over the last 3 to 4 years maybe, the shareholding pattern as to what's happening there, the street credentials as to what's happened to the stock price. Yes, over the last maybe 2 to 3 trading sessions, it's been under a lot of pressure, but outside of that, it's given very, very strong returns, as I did say. Then you have street coverage as well as valuations, which we will talk about. All of these key and essential to understand companies that you are investing in, and that's basically the goal that we are trying to solve for through this show. Let me welcome on board Rucha Somaya for exactly this. And Rucha, talk to us about how the income statement for this company has evolved, and what are the finer metrics with regard to Q3 in particular that is standing out, that has left the street a little bit disappointed?
Yes, Harsh. So as you rightly mentioned, most of this, the business of it comes from annuity, about 60%. So that was majorly the problem in the third quarter, because annuity revenues were not seeing growth. And even if you look at the kind of revenue CAGR that this company has provided over the last 3 years, the compounded annual growth rate at 23% might seem good, but is not healthy when you compare that with peers. EBITDA, again, a 3-year CAGR of about 15%. Again, not a good sign over here. And if we particularly talk about the Q3 numbers, as Harsh also mentioned, annuity business is the business which is, 60% of the total revenue proportion, which did not do well in the third quarter. And that is why the stock has been tanking. Even yesterday and in today's trade is down about 9%.
To remain healthy. We do expect that the higher levels of consumption and rural demand recovery will push the overall economic growth to be about the 6.7% in the second half compared to the 6% in the first half. And similarly, we do expect that the CPI inflation that came in recently at 5.2 will get below the 5% level and head to the 4.6% by March. Providing a conducive environment for private consumption to pick up, which we expect would be in the second half around the 7.8%, and the government consumption growth is also pegged by our house view at about 6.1%. Now, we have seen that the manufacturing PMI remains strong in the expansionary zone, and the services PMI also above 60 continues to be in the expansionary zone. And we do need to watch out for the external challenges, unevenness in private capex. Some of those factors pose risk which need to be closely watched. Now, getting to the bank's numbers in the quarter that you have seen, the advances under management at 26.8 trillion rupees grew 6.1% over prior year, and on an average AUM basis grew 1.86 trillion rupees, 7.6% versus prior year. On the deposits front, the total deposits reported rupees 25.6 trillion grew year on year by 15.8%. On an average basis, also it grew 15.9%, 3.36 trillion rupees. Sequential quarter, on an average basis, we grew close to 1 trillion, 0.99 trillion or 4.2% growth, and powered enormously by the time deposit, which grew year on year by quarter on quarter by 0.9 trillion on an average, 5.8% growth. That's in terms of the headline volumes. On the distribution expansion, we grew 51 branches in the quarter, and 1,052 branches in the last 12 months, and this year in 9 months about 405 branches or so. So we continue to expand our points of presence. On the payment acceptance points, we have 5.4 million, a growth of about 12% since last year. On the customer franchise addition, we added 1.9 million new liability relationships in the quarter. Our customer base stands little above 96 million, 96.7 million customers. We also added 1.5 million cards during the quarter. The total card base stands at about 23 million. We have a strong balance sheet with a total capital adequacy ratio at 20%, CET1 ratio at 17.3%, so 17.5%. And the LCR quite strongly positioned at 125%. Now getting to the revenues. Revenues for the quarter at 421 billion grew 6.3% over prior year. Net interest income at 307 billion, which is 73% of the net revenues, grew 7.7% over prior year. The core net interest margin was at 3.43%. And the core net interest margin on an interest earning asset basis is 3.62%. Now, getting to the other income, aggregating to about rupees 115 billion, within that it comprises the fee and commission income, which is 71% of the total other income, at about 82 billion rupees, grew 17.9%. Similarly, the foreign exchange earnings and derivatives income at 14 billion grew 16.5% over prior year. Now getting to the expenses, expenses for the quarter at rupees 171 billion increased to 7.2% over prior year, and cost to income ratio was at 40.6%. Now getting to asset quality, the GNPA ratio was at 1.42% compared to 1.36% in prior quarter. This includes the impact of the agricultural segment, which is seasonal between the Rabi and the Kharif crop season, so the December season gets impacted. So GNPA, excluding the agricultural segment, at 1.19% remained flat to what it was in the prior quarter at 1.19%. Now getting to the slippage ratio, the slippage ratio in the current quarter at about 35 basis points compares to 88 billion rupees or so, and it's excluding the impact of agri at 26 basis points is flat to prior quarter. Now getting to the total provisions for the quarter at rupees 32 billion compares to 42 billion in prior year or 27 billion in prior quarter. Again, impact of the agri. Excluding agri, the credit costs have been fairly flat quarter to quarter. You know that we do have floating general and contingent provisions, which account for almost 169% of gross non-performing loans. And on a basis point basis, floating contingent general provisions are about 1.43% of gross advances as of quarter end. Now getting to profit after tax at 167 billion, grew on a reported basis 2.2%. But as you know, last year we did have tax adjustments and treasury items and net mark-to-market trading gains. Excluding those one-offs, the profit after tax grew by 13.6% versus prior year. Now, getting to the in summary, the results reflect robustness in various parameters, passionately driven by our employees. We are progressing in our journey to normalize the CD ratio with the deposit growth outpacing the loan growth, which I just described above. We have seen robust growth in our average deposits close to 16% year on year, and the AUM growth close to 8% year on year. We have delivered the strong deposit growth despite the challenging macro environment, which again, system liquidity being neutral to negative through the quarter. NIM remains in a very range bound with an upward bias. OPEX continues to be managed very tight at cost to income ratio at about 40.6%, as despite our franchise continues to demonstrate strong deposit growth, which OPEX growth of 7%, deposit growth of 16%. Credit parameters continues to be pretty stable, and we are robustly positioned, growing in a very balanced manner, and get the strategic imperative to rein in our CD ratio. We have sufficient liquidity as well as capital and continue to grow our deposits, allowing us to be in a comfortable position to grow and capture market share in advances when the macro turns favorable. So with that, maybe I stop here and open it up for questions.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Please note, participants are requested to restrict to 2 questions per participant. Kindly join the queue for a follow-up question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vishwanath Nair from NDTV Profit. Please go ahead.
Hi, sir. The first question is with regard to the net interest margin front. If you can explain at what point in time this contraction is likely to end, considering specifically that there is going to be a rate cut, or is the expectation of a rate cut is very high at this point. And the second question to that is also, while I understand agri slippages have added to the NPA for this quarter, CRB slight 1 basis point is a very small number, but on the base it looks larger. So just want to get a sense as to where those slippages are coming from.
Okay. Two aspects of it. One on the margin. One thing on the margin is that it has been fairly stable compared to various industry players that you have seen or you will see, which is how, because of the positioning, the duration, the modified duration of the assets and the modified duration of liabilities are fairly matched, very closely, tightly together. There is an impact on the rate, right? When the rate does change, there is a lead and a lag effect, but then that is a quarter-to-quarter effect, not an annual effect, because they stabilize over a period of a year. So that's one on the margin as such. Otherwise, we are positioned in a way that CASA, hopefully, as you alluded to, when the rate changes, the preference of customers today has been more towards time deposit, wanting to lock in little higher yields. We should see that, which is what we have seen over the last 2 or 3 large cycles over 10 years. We've seen the customer preference also moves into the CASA area, and that also provides a tailwind there. So that's one on the margin, right? So we'll have to wait, and both customer preference plays out, as well as not quarter to quarter, but over a period of an annual year. If you see that the bias is to be stable to moving up. Now, the second aspect of it you touched upon on the NPA as such. On the NPA, what needs to be seen is that the overall NPA at 1.42, excluding agri 1.19, it's flat quarter to quarter. It's been pretty stable between that. And then the next other important thing is to look at the slippages, how accounts slip into non-performing. That also, if you look at it excluding agri, because you know that in December and June, you get that impact of the seasonal, the crop season impact that you get. But excluding that, it is flat, 1.02 to 1.02, both sides. And similarly on the credit cost also, when you look at the total credit cost at 50 basis points or net of recoveries 36 basis points, it is pretty flat excluding agri. It's either 42 or 36, whichever way you look at it, excluding agri, it is also flat. So it's a function of the seasonality of agri that will have to play out, which has played out. Other than that, every other portfolio groupings that we have, the retail book or the CRB book excluding agri, or the non-retail book, all of the corporate wholesale book, all of them are pretty stable over this time period. And you alluded to a basis point or 2 on CRB. Yeah, 1 to 2 basis points can always move at any point in time. Those are normal in terms of how things happen. And again, how many festival days were there and how many working days. I don't want to go into those kind of minutiae. There are several factors that go, but a basis point or 2 left, right, that doesn't change the fundamental construct of the quality of the book that continues to be pretty strong.
Sorry, just if you allow me a follow-up around the margin question. Now, your advances get repriced faster than your deposits. So while I understand the customer preference will change, but in the short term, will there likely be any changes?
Quarter to quarter it will be, but I would urge you not to look at quarterly, because that's not how we manage. We have to manage it over a period of at least annual and longer. And so that is how the book is positioned, not for quarterly changes, but for how do you manage it over a year.
All right, sir. Thank you. I'll come back.
Thank you. Thanks.
Thank you. Next question is from the line of Piyush Shukla from Hindu Business Line. Please go ahead.
Good evening, sir. Am I audible?
Yes, please. Good evening.
Yes, sir. Sir, OPEX is a little bit higher as we are continuously investing in building retail franchise. Want to get some guidance for the current year as to how many branches will you add? What would be the impact on your OPEX because of that? How much will it rise? And secondly, sir, you alluded towards higher seasonality impact in this asset quality, particularly in agri loans. Going ahead in the current year, if you could give a broader assessment as to how these last year unsecured segment was a bit under pressure, MFI segment, unsecured personal loans, so on and so forth. So at HDFC Bank, how do you see the asset quality panning out in the current calendar year, and in general also in industry, what are the trends that you're seeing, sir? Thank you.
Yeah. More than giving you an outlook of looking forward, I will tell you where it stands. That gives you the level of comfort, how we manage and where we are positioned, both on the cost as well as on the credit. Getting to the cost first, expenses first, right? For the quarter, 171 billion rupees. Cost to income ratio 40.6, stable one period to another period. And the rate of growth year on year is 7.2%, or quarter to quarter 1.3% change, right? Which we believe that is one of the levers that is strongly positioned expenses. And more important on expenses is also if you look at cost to assets at 1.93 thereabouts is one of the best in class in the industry. If you compare us to any of the private sector or the industry average, at 1.93 or thereabouts on the cost to assets, expenses by assets, is one of the best in class. So highly efficient. And you touched upon the investments in branches. Yes, we do make investments in branches to expand our distribution reach, because that's the fundamental tenets of how we acquire and engage with customers to manage them for better relationship. And as we grew 51 in this quarter, 405 this year, there is no one particular target or outlook that we have provided. Right? The last year we grew close to 1,000 branches. This year so far 405 branches. Where we will end, we will not get a particular outlook, but then our trajectory is to make certain investments to reach. But it is not for eternity, in the sense that we evaluate it periodically in terms of how many we need, and then you take a pause to drive the productivity of those, so that both the employee productivity as well as the engagement with the customers, the reach to the customers happen. And one other important aspect of all of this is once you get those branches and people and get the reach, you need to get on with customers. So we have added 1.9 million customers in the quarter. Similarly, last quarter was about 2 million or thereabouts. And last year, whole of last year, we added 9 million customers or so. So we keep bringing on. Now we have about 96.7 million customers to work with to deepen the relationship. So that is how you perceive. So there is no one particular number, but that's part of how we manage. And we do see that the density of branches in the country is the level of what you will see in a Western market. So we do see that the country does need more distribution presence points to be closer to the customer for better engagement. So that's one. Without any particular number of an outlook, I just gave the fundamental tenets of how we operate on that. The second aspect of it that you asked about is the quality. Yes, I alluded to say that other than the seasonal agri, the overall portfolio is pretty strongly positioned, both from a GNPA point of view, the leading slippage also remaining flat, and thereby the credit cost also remaining flat from last quarter to this quarter, if you see, have been stable. Then you alluded to see that like last year, the unsecured or the MFI and so on, Those kind of portfolios, we are the leading players. We are one of the largest, or I would say arguably the largest market share in the unsecured book between cards and personal loans and so on. Those books are all pretty stable and very strong at an aggregate level. And we do have that SLI MFI, but they are a small portfolio in the overall scheme. But including that, you can see that there is no particular change or blip in any of the NPA numbers or credit cost numbers, because the way we approach it is with the financial education preceding any lending, and we have more than 10,000 people handholding and working with these kind of customers. You know that our SLI book is 100% women folk. That means in the rural, it is given to women for production. That means various products they produce, right? That's the target at which we operate, and they are closely coordinated to ensure that the outcome is perfect. And that is how what was important in terms of giving back to society through these social initiatives. We continue to do this operation and successfully manage the credit quality there. Thank you, sir. I'll come back. Thank you, sir.
Thank you very much.
Thank you.
A request to all the participants, kindly restrict to 2 questions per participant and join the queue for a follow-up question. Next question is from the line of Siddhi Naik from Thomson Reuters. Please go ahead.
Hi, sir. I have a couple of questions. Am I audible?
Yes, good evening. Audible, yes.
Hi, good evening. So my first question is on your slippages aspect. Excluding agri, I guess slippages are at around 65 billion. If you could also give me a breakup of how much of it has come from MFI, credit card and TL. If you could provide that breakup, please.
No, we don't provide that, but we annually publish in our US filing. You will see certain numbers there. But on a quarter-to-quarter, we don't. But all I will tell you is that at an aggregate level, you've seen that 64, which is stable. And that includes all of those books. That includes the unsecured book as well as the credit card book and the SLI MFI book, all of them. And they're pretty stable.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
I present the budget for a historic.
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about 3 key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold into the mutual fund industry over the past couple of years will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate, and what that means is that depending on which income slab you fall in, if you're in the highest tax slab and you're paying 30% on the income above a certain threshold, your gains from debt mutual funds are also taxed at 30%. That wasn't always the case. Long-term capital gains came into effect after a period of 3 years, and they were taxed at 20% with indexation benefits. Of course, that doesn't remain the case anymore. So the mutual fund industry is asking for a rollback to the previous tax treatment because they say that the debt market in India is growing, is emerging, and it needs to be incentivized. The third change that they're suggesting has to do with the income distribution schemes. Of course, there are two types of schemes in mutual funds. One is the growth scheme where all gains are reinvested by the fund manager. And in the second case, which is the dividend distribution scheme as it used to be called, the income is distributed on an ongoing basis to unit holders. Now, the thing is, income above 5,000 rupees that is distributed in this manner will have to have tax deducted at source, or TDS, as things stand right now. And the mutual fund industry is suggesting that this threshold be raised to 50,000 rupees, and they expect that this will benefit a lot of people because they won't then have to have tax deducted at source. Of course, there are more proposals that they've made, but we'll see what the finance minister takes up when she presents her budget for 2025.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Hi, I'm Alex Matthew and we're talking about Your Money Matters on NDTV Profit because we understand that your money matters. Managing credit is tricky. Over the last few months, even the Reserve Bank of India has had to step in to tell lenders to be careful about giving out personal loans. The reason is that there's been a rise in bad loans. People are unable to pay back their debt. The thing is, not paying back a loan can have a cascading effect. It can even push someone into what is called a debt trap. How does this happen? And what should you do if you find yourself in such a situation? Joining me to talk about this is credit expert Parijat Garg. Parijat, thanks so much for taking the time. It's an important conversation to have because sometimes people don't realize it's a slippery slope, and by the time they've realized that they're in trouble, it's often too late. So what are the first few signs, in your opinion, that things are not going well when it comes to managing credit?
Thank you, Alex, for having me here. And it's a very important topic, that trap where one gets into a vicious cycle. And the first red flag that one can spot is that if you have to take a loan to repay another loan, that itself is the first big indicator that you are progressing towards a debt trap. And usually what happens is that you will be taking the next loan with higher interest rate, perhaps from an institution or from informal channels, and that creates a spiraling effect for you. The second possibility could be that you are perhaps taking money from credit cards. Now, a lot of us think that credit card is not loan, but essentially it's backed by credit. And that is a very, very expensive credit. And that is often one of the biggest reasons why somebody gets into debt trap.
So, but Parijat, let's define it first, right? For people who don't understand this concept, what is a debt trap and why is it called a trap?
It's a trap because you go down the path and it's very, very difficult to come out. And why you go down the path? Because if you have taken a loan and you are supposed to make the payments on a particular time, and if you're not able to do it, you will get penalized for it. You will have late payment charges. There could be other charges that a lender would apply onto your loan, which means that if you were supposed to pay back 1 lakh rupees towards your loan over the next 6 months, now that 1 lakh could eventually become maybe 1.5, 1.6, even up to 2 lakh rupees if you're not paying over the months. And that can become so large that it is very, very difficult for one to even pay that.
Okay.
And to do that, you arrange for funds from other sources. And at one point in time, you will run out of your sources to get money. And that is where you're trapped in obligations towards many, many different lenders, which could be formal lenders, informal lenders, and it's very, very difficult situation to come out of.
We saw a lot of people face this problem during the COVID-19 pandemic, and this is because a lot of people lost their jobs, their livelihoods, and they had existing credit or they had existing loans. And what the government did and what the Reserve Bank of India did at the time was to give a moratorium, which is they said you can avail of this and you can delay your payments over a period of time and then restart paying. But of course, that is not available right now. So in a situation where people find that they're in this debt trap, the avenues to escape are less. But does this often happen, Parijat, with unsecured credit, which is personal loans, credit cards, and the like? Even BNPL, which is essentially the same thing, right? You're taking credit. Does it happen more with that, or does it happen with things like housing loans or car loans or things that are backed with an asset?
So in our world, we call loans in two categories, good loans and bad loans.
Yeah.
Now, good loans are the ones which are backed by assets where there is a value associated. So in case you are in trouble, you can sell that asset and recover the money and repay your loan. Or that asset is generating revenue for you or some income for you. And the backed loans are the ones which are purely for consumption. Maybe you're buying a luxury good or you're actually investing in your wants. And that is where possibly you would find more debt trap situations in comparison to the secured loans like home loans or vehicle loans. Having said that, it is not that you cannot get into a debt situation even when you have taken a large loan, which is for, say, an asset. It could happen in emergency situations or unexpected situations. So maybe, like you said, COVID is one example. A lot of people get into such traps because of medical emergency, which you have not planned for and which you are not aware of. And that could lead to crumbling your finances. Now, in such situations, one need to really go all out and spend a lot of money on family's health, and you are completely short of money. So these could be situations which are unavoidable, and it could also create situation. But more often than not, it's unsecured loan, which are towards consumption, towards your wants or desires, which can be somewhat controlled. And that is very important when one needs to come out of that trap, which is discipline.
We'll talk about how to extricate yourself or get out of such a situation. But Parijat, you speak to a lot of people, you help a lot of people with managing this very situation, and you've seen some of these situations develop while you're trying to help them. Can you talk about some of the most vivid examples of something like this happening?
Yeah, so I think I can maybe quote 2 or 3 different examples. One, one of close acquaintances, that person took money, not just from banks and NBFCs, but also from family and friends. And the money was taken to make investments. Now, we have seen that over past few years, the investment has been giving a lot of good returns. Maybe people are able to make 20-30% year on year on a good investment. Now, it works very well because you might be taking loans at 15-16% and you're making 30% and you're able to repay those loans. But that is in good situation. What about now? Like what we have seen over last 3-4 months, when the market is not helping such investments and you can't take the money out, or if you're going to take the money out, it's going to be at huge loss. And this person is now struggling to repay the money, repay the loan. And since the money was in a large quantum, it is very difficult because it's actually adding up, both in terms of interest rates and penal charges. And it's very difficult to repay money in this situation. That is one. Second one was an example where it's a low income example where the person's income was about 50,000 rupees. Now, one of the kids was critically ill and the amount of expenses were surpassing 10 lakh rupees. Now, in this situation, the family did not have any health coverage. And this money was taken again from banks, NBFCs, pledging gold, whatever was there in the house. And so the family is full out. How does the one recover from that situation when your annual income itself is just about 50-60,000 rupees? So in this example, perhaps like if there was enough insurance available, that could have been a possibility. Or if there was a possibility of solving through crowdsourcing, where you're able to take help from public at large and recover that money and come out of that debt situation. So there are quite a few such examples. COVID was another example where I saw a lot of people coming across because they had either lost jobs or they had invested in businesses, which the businesses were shut down. So they had taken loans to run businesses. Now the business itself is not taking off because of COVID situation. Now, how do you recover money? How do you earn money? And how do you repay the money? So all your assets are kind of locked up and you can't recover money and you can't pay their money. And these, like the situation that I'm talking about, could be for about 10 lakh rupees for a low income group person. For a high income group person, this could be 50-60 lakhs, 1 crore, 1.5 crore kind of debt traps as well. So it is not a situation which is affecting only a certain segment of people. I've seen it all across.
You know, I've seen this happen as well. Somebody who works with me had to take a loan from a loan shark, Parijat, you won't believe it, for their daughter's wedding. And they were borrowing at 10% per month. And so that has amounted to a very large amount of money. 3 lakh rupees was borrowed. So she was paying back 30,000 rupees per month. And in the first month itself, it's not like she got 3 lakhs, she got 2.7 lakh. So the interest for the first month was taken, and that, as I understand, is how loan sharks work. But that is a really horrible situation to be in. What are the first few things that happen when you miss a loan payment in the formal sector, when an NBFC or a bank has given you this loan? When you miss, what happens?
So the first thing that will happen is you will start getting calls for collections. And they will be a lot more polite in the first few calls. They will try to understand, they will try to nudge the customer, understand what's happening in their lives, and give them opportunity to repay. But as the situation progresses and if it seems to get worsened, then you will start seeing collection agents coming at your doorsteps. Now, regulator has definitely taken a lot of steps in terms of making sure that this does not go into very difficult situations for the customers. But still, somebody showing up at your doorstep asking for money is not a very pleasant situation from a social context standpoint.
Okay.
And that starts to put a lot of mental pressure on people. People go through a traumatic situation, and we have seen people losing lives as well when the money surmounts to a level where they can't really look out for it.
Yeah, and the other thing that happens, of course, Parijat, the other
yeah.
thing that happens, of course, is that your credit score gets hit immediately. And whenever you have to go out and take more credit, which is often what people do, then it becomes much more expensive to do. So the final leg of this conversation is, how do you get out of a situation if you are in such a situation? And what, according to you, are the first few steps, or all of the steps that you have to take?
Sure. So I think, like you rightly said, credit score gets impacted, and that does not allow you to take more loans or loans at better interest rates. So that really puts you into that trap. So I think the first critical element is to spot when you're going into this situation. More often than not, I've seen people coming and realizing this very, very late. And even if they seek any professional advice, it's very difficult at this situation to advise anything because the person has already exhausted most of the avenues. So it's very important that one understands, first of all, that they're getting into a debt trap, which means that you are possibly taking more loans than what you are expected to take. So if your income is, say, 100 rupees, don't let your EMIs cross more than 40 or 50 at worst. Because if that is getting crossed, then you are possibly likely to move towards debt trap. So that's the first indicator that one needs to keep in their mind. Second is that if you realize that you're getting into debt trap, go and seek professional advice. Do not try to exhaust opinion or avenues yourself, because it's possible that you may not make the right choices. You might be making choices under pressure, which possibly could be incorrect and could have potential downstream impacts for you. And third thing is that be open about it. Speak to your family, speak to your relatives. It is a difficult situation, I can understand, but don't bury your head in the sand, because that's not going to allow you to do anything. And this situation does not go away. You can bury it under the carpet, but this will surface as soon as you take the carpet off. And that's not going to be too far in the future. So one needs to make sure that these things are very, very clear in your head. Take that help and look for options. Yeah. Now, in terms of what options are available in the market, you have possibility of debt consolidation, where if you've taken money from 5 different sources, maybe you consolidate that together so that you at least have one lender to talk to. You are not worried about repaying to 5 different lenders on 5 different days. And there are services and lenders available who can help you consolidate these kind of debts. The second thing is, if you have any assets that are available, try to leverage those assets. Maybe either if you can sell them off. For example, if I have bought an iPhone and I'm not able to pay my EMIs for iPhone, better that I get rid of it, get money, maybe switch over to a much cheaper phone so that I'm still connected. But then I'm able to recover some money and repay some of the loan, because that will actually lower down my debt burden. So try leveraging some of those kind of assets, and that can help you to come out of the debt. The third thing is definitely look for options which are lower interest rates. Avoid loan sharks as much as possible, because they are necessarily not under any kind of regulatory situation. It could lead to a law and order situation for yourself, for your family, and it could put you at a lot of risk. So avoid loan sharks, work with formal lenders, be open about what your situation is, speak to them. Like Alex, you were mentioning, moratorium was offered, which was at a large scale. But in one-to-one situation also, where I have seen lenders who are willing to do settlements, they are willing to do restructuring of your loans if they understand your situation and help you out so that you come out of your debt trap, you're able to repay. Because for bank, it is not important that you have a difficult situation. What is important for them is that they recover
of money. Yeah, recovery of money, certainly. So I think we've covered quite a few bases. By the way, if you're listening to this and if you find yourself in some situation like this, please write to us and we will try and assist in any way that we can. We'll try and put you in touch with people like Parijat, for example, who can help you out. Parijat, thanks so much for joining me on this conversation. Very important one to have, and pleasure having you.
Sure, thank you very much.
All right, it is time now for Wellness Wednesday. You're probably wondering what this has to do with personal finance. I'll tell you. Through the week, we tell you about how to build wealth and keep it. But we need to talk, in my opinion, also about how you should stay healthy so that you can enjoy the fruits of your labor. Today, I'd like to talk about a condition that a lot of women face, sometimes without even realizing it. It's becoming more prevalent, I'm told. It's PCOS, and this is polycystic ovary syndrome. What is this about, and why is it going unnoticed? What should you do if you are showing the symptoms? Join me to talk about all of that is Dr. Sudeshna Ray, Senior Gynecologist and Additional Director, Department of Obstetrics and Gynecology at Jaslok Hospital. Doctor, thanks so much for taking the time. First, the definition. PCOS, it's a term that a lot of people have heard about, but what is it?
It's polycystic ovarian syndrome or polycystic ovarian disease. There are many names to it, PCOS, PCOS. Basically, it's a polycystic ovarian disease or a polycystic ovarian syndrome. It's a condition, it's a hormonal condition where the hormones are not playing at the right balance. So I'm calling it as a disorder. I'm not calling it as a condition because it's not a disease where you can identify one particular cause and you can treat it. So it's a combination of conditions which probably leads to a bit of disturbance in the hormones, and it can all come back if we are on track.
What are the common symptoms of PCOS, and is there a particular time at which this can develop, or is there any time, for example, somebody in their late 20s, somebody in their early 30s, can they also have this disorder?
Yes, of course. PCOS can come up with symptoms at various ages. The symptoms are different at different ages. In the adolescent, it can be in form of irregular periods. It can be in form of acne, stubborn acne, or pimples. It can be in form of a little bit of facial hair. It can be in form of a little struggle with the weight. In the young adult, it can be a problem with dealing with getting pregnant, or maybe a problem dealing with the obesity as well as irregular periods. In the later stages, beyond 40, the periods might be regular, but they can express themselves in terms of diabetes or blood pressure or different metabolic problems.
So how does one identify that they have PCOS?
So first, a symptom, of course, if they have irregular periods, in terms of the irregularity will be more in terms of skipping periods. So rather than having it frequently, but frequent periods can also happen in PCOS, but it is more to do with skipping periods. For example, they have it in January, then they don't have it in February, or maybe the normal cycle length is about 35. This goes beyond 45, 50, 60, sometimes 90. So that is one of the most common symptoms that they present with. The second common thing that they have is acne, the stubborn acne. There is a typical pattern of PCOS acne. They are big, they are in clusters, they are situated along the jawline, and sometimes the acne also comes in the back. So these are the different types of acne that they can present with. There's also a common thing which is a struggle in losing weight. They are either gaining weight or the struggle in losing weight. Then there can be facial hairs, then there can be other symptoms like lethargy, fatigue, and things like that.
And you've already enumerated that this can cause certain other diseases to occur as well. But what are the common treatments of PCOS? Identifying it early, of course, is important.
Very important. First of all, be aware. That's the first step of every condition that you have, is being aware. If you don't know what to look out for, what your mind doesn't know, your eyes will not see. So the first thing is awareness that PCOS can come with these symptoms. Now, there can be a person who is having one or two symptoms. There can be a person who is having all the symptoms. it is a mix of symptoms, but even if you have only one symptom, like not so good flow during your periods, not so regular in your periods, having heavy periods after a long gap, or having very small flow of periods, all these are symptoms that one should look for, and one should go to the doctor for a diagnosis. Now, this diagnosis is also a little complex as the condition is. The diagnosis is complex because there's no cause to it. There's no one particular cause to it. So there are blood tests. Then there can be sonography. The blood test can be of the hormonal test, metabolic tests. That there can be sonography. There can be a physical attribute, like we measure the BMI, we measure the hip circumference, the waist circumference, like a tailor. And we make ratios, and that will not only help in diagnosis, but also help in tailoring what kind of treatment they need. So now coming to the treatment, there is actually, I would like to coin the word management, because there is no such treatment, because it's not a disease, and so it's not a curable condition or a curable disease. It is mainly in form of a management, and it can well manage PCOS with there can be medications which can be hormonal, metabolic, sometimes anti-sugar medications. But the main denominator, the common denominator, is a lifestyle. Medicine or medication without lifestyle is not going to help.
So what lifestyle is ideal if you find that you have PCOS?
Right. So again, this is has to be tailored to individual needs. What kind of metabolic rate that the woman is having. But basically it is, if you ask me a blanket thing, then basically it would be a low carb, high protein, high fiber, and a low sugar diet. Avoid food that have preservatives, avoid confectionaries, avoid food that increase inflammation. So these are the basic diet patterns. Then there are combinations in which the breakfast should be, the lunch should be, and the dinner should be. And then comes the exercise part. It's a moderate or brisk exercise. And then comes the sleep part, which is a disciplined sleep between 11 to 7 a.m., 11 p.m. to 7 a.m. in the morning, at least about 7 to 8 hours a day. These are all very difficult to achieve things. However, the key to all of this is consistency, is the continuous process. It is not that I join a gym, I'm diagnosed with a PCO, I join a gym and I enroll in it and I do it religiously for about 3 months and then I forget about it. Everything comes back.
Okay.
So
I understood a lot of that. Now, when it comes to the medication, is this in the form of oral medication? Are there alternatives that you can have?
Well, oral medications, it can be in form of, hormonal tablets, oral contraceptive pills. There can be supplements. There can be metabolic medications. These medications are basically to kind of reboot your system. It's not going to treat, but it's going to give you time to reboot your system.
Are there side effects to that though, doctor?
Well, Alex, there's nothing without a side effect.
Yeah.
Okay, we have to balance between the benefit that we get out of it and the risks that it involves. So at some points, giving the medication is mandatory. At some points, we can do without the medications. At some point, it's a combination of medication plus lifestyle.
Thank you so much, doctor, for joining in and for explaining everything that you did today.
Thank you very much. Thank you. Thank you for giving me this opportunity.
That brings us to the end of this particular edition of Your Money Matters. It's been an absolute pleasure bringing it to you. Do stay tuned. Lots more coming up on NDTV Profit.
This say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
Everyone, with Budget 2025 right around the corner, there is one question on everyone's mind. Will this finally be the year salaried individuals get some much needed income tax relief? Let's dive into the story behind the tax slabs, the rising cost of living, and why economists are calling for reforms. First things first, Budget Day is set for 1st February 2025. Expectations are sky high, especially among salaried individuals. But before we talk about predictions, let's rewind a bit. The first big moment for taxpayers was back in the Union Budget for FY 2020-21. That's when the government introduced an optional personal income tax regime with lower tax rates but fewer deductions. Remember that? It shook things up for taxpayers who had to choose between the old system with deductions or the new simplified one. Fast forward to 2023 budget, Finance Minister Nirmala Sitharaman made some tweaks to the new tax regime, expanding 2 income tax slabs and increasing the standard deduction from 50,000 to 75,000. Sounds promising, right? But here's the thing. It didn't touch the old regime at all. So what exactly is standard deduction and why does it matter so much? Think of it as a fixed amount you can subtract from your taxable salary. It's meant to help with everyday work-related expenses. While it's been raised over the years, the question is it enough to combat the rising costs we're all facing today? Did you know the standard deduction was actually scrapped back in 2005, but it made a comeback in 2018 at 40,000, and since then it has been climbing steadily. Now economists have a big ask for Budget 2025. Cut income tax rates. Why? Lower taxes means more disposable income in your pocket. That extra cash could boost savings, increase spending on essentials, and even revive demand in sectors hit by sluggish consumption. Sounds like a win-win, right? In fact, during a recent pre-budget meeting, experts suggested exactly this to Prime Minister Narendra Modi, arguing that it's time to ease the financial burden on taxpayers while stimulating economic growth. As per an NDTV Profit exclusive, the upcoming Union Budget could bring significant income tax relief with potential modifications to the new tax regime. Sources suggest the government is considering adjusting personal income tax slabs and reducing tax rates for incomes up to ₹10 lakh to boost disposable income. The new tax regime, which restricts exemptions and offers fewer deductions, is already the default option for taxpayers, with 72% having shifted to it. Notably, the July budget increased the standard deduction to 75,000 and revised both tax slabs and rates. Under the new structure, income up to 3 lakh is tax-free with progressive rates ranging from 5% to 30% for higher income tax brackets. As Budget 2025 nears, there are growing expectations for reforms aimed at easing tax compliance, particularly for NRIs, that is non-resident Indians. Here are the key suggestions highlighted by Deloitte. Firstly, simplifying the tedious process for property transactions involving NRIs. Currently, buyers must withhold tax at a higher rate, obtain a TAN, and file eTDS returns. Introducing a challan-cum-statement system similar to residential transactions could streamline the process and reduce the burden on buyers. Second, enabling tax payments from overseas bank accounts. Presently, tax payments must be made through Indian banks, making it cumbersome for NRIs. Allowing payments from foreign accounts would enhance convenience. Third, improving e-verification by extending OTP options to foreign mobile numbers. This change would simplify tax filing for NRIs, reducing paperwork and eliminate.
Well, hello and welcome. We're at the World Economic Forum, certainly on the sidelines of the World Economic Forum, where India is very much a focus. It is every single year. One of the governments, the state governments, doing a great deal of work in terms of talking about key issues, whether it is job transformation, artificial intelligence, sustainability, or perhaps even the climate, is the government of Andhra Pradesh, one of our most vibrant states, looking to really explain the Andhra Pradesh story to a global audience, certainly a lot of people over here. Nara Lokesh, who we have with us, one of our young leaders, who has a real interest in artificial intelligence and technology and in bringing tech and industry together to benefit millions across the state. He is also the IT Minister of Andhra Pradesh. He looks after electronics, communications, and HRD. What we are talking about today is artificial intelligence for good, shaping a smarter, sustainable tomorrow. And we've got a wonderful panel with us. Matt Renner is President of Global Revenue at Google Cloud. Thanks very much for being with us. Archana Vyas, who I've worked with very closely for many years, Director Program Advocacy at the Bill and Melinda Gates Foundation. Emily Sfelli is the Director of Partnerships and Initiatives at the Tony Blair Institute for Global Change. Thank you very much for being with us. Nara Lokesh, let me come to you first. When we talk about AI and public good, it can only happen if there is the public sector and the private sector working together. A lot of the technology comes from outside, but you have your own idea of how it'll work. How is that partnership crucial?
I mean, Andhra Pradesh is always known for being at the cutting edge of technology and governance, or GovTech as we call it. In the third term of Mr. Naidu, we had the Real-Time Governance Center in place, and that was where we were assimilating all the data across various data sets, and how can we use it for real-time decision making. But now with AI arriving, I think it can fundamentally transform governance, and I'll give you a few examples of what we're doing. First one is education. From being a passive learner to an active learner in the classroom. So we're doing this project where, it's a 45 minutes class, and then you have a 2-minute video, which we're working with the Khan Academy. And we're coming up with 5 questions at the end and gamifying it and giving kids a clicker, a simple clicker with A, B, C, D option. And sort of gamifying it and using AI to actually prescribe homework based on results. And we want to track this data in a very, very long term. So that's one example of it. The other example is using AI in identifying beneficiaries for various government programs. That's the second project that we're doing. Third project is delivery of government services using technology. So we have an agreement where through various platforms we can now deliver, and one of it being ahead is Meta on it.
Right.
WhatsApp governance, as we call it. And we're also working with Google in a similar platform. So I think there's a role to play. Government's job is to open up and create use cases that can then be scaled up.
Yeah.
But then, of course, I think the initiative will also have to be led by the innovators across the world.
In fact, Matt Renner, that brings me to the role of Google. And, before we started this conversation, you were telling me a little bit about specific examples. Mm-hmm. I was fascinated by what Google brings in terms of AI and healthcare. Mm-hmm. And I also do believe that when it comes to diagnosing illnesses long distance, using the benefits of AI, it could have massive impacts in a country as large as India. Mm-hmm. Could you share a few examples of what Google is doing?
Sure, and again, I think anywhere that you have a lot of data that you could crunch very quickly and come up with an accurate answer, AI is a great use case in most cases than not. For maternal health is a good use case that we're working in India at this point. One of the issues we had around mammograms and the time behind a mammogram was the time around diagnosis and the length of time, and how it impacted the ultimate result. Prior to AI and prior to utilizing these models, it took upwards of 5 days to get the result back to the patient. The problem with that is only about 20% of the patients came back once they got the information about this to go back to the doctor. So the AI use case we now put together is we can do a mammogram, run the numbers with very extreme accuracy within 5 minutes. So the patient hasn't left the doctor's office, right? So that's a good example of not just speeding up something for productivity, but it's a good example of changing the outcome, which I think is super important when you talk about health.
So AI actually analyzes a mammogram, it sort of diagnoses whatever it is, passes on that information to the doctor. So you've got essentially two eyes.
Correct.
One real eye, one artificial eye, be that as it may, but potential solutions and certainly a diagnosis. That's what it does, right?
In that specific use case, yes. Right.
Could you give us a few more examples of?
Sure.
Of
in healthcare, some of the things we're doing. So there's in all variations, right? There'll be some opportunities to look into AlphaFold, which again is genomic 3D imaging, where you can that was released by DeepMind within Google, but ultimately is pattern. That's a public global scenario that Demis Ashrabis, and I know he's having a chance to meet with Bill Gates this week, but Demis won the Nobel Peace Prize for this, right? Ultimately, yes. He and Mr. Jumper as well on our team. So a fantastic example where that's more just for research, as you're digging into research. When you get into diagnosis, and I gave that example for a mammogram, but even the diagnosis around cancer itself. So the contouring process where you're going to apply radiation usually takes somewhere between 7 or 8 hours for a technician to go through all of your slides, all of your pictures, if you will, to find what's the healthy tissue versus the cancerous tissue and where to apply the radiation. By applying AI models to that, in this specific case, you could take that down into about a third the time, even a quarter the time. Why does that matter? More time with the patient, see more patients, diagnose more patients, right? At the end of the day, and when you're dealing with India, right, with this incredible number of people that have to go through, a lot of times it's the bottlenecks that you run into that we're trying to clear when you talk about healthcare. So probably an example there which bleeds into treatment as well, but that's from that effect.
Now, Lokesh, how would you roll something out like this, where every last district potentially has access to an AI diagnosis to speed up treatment of patients?
If you look at it, there are few tools that have come out where by doing just a facial scan and using AI, the basic health parameters actually can be captured. Mm-hmm. And a few of them are under FDA review. So there is a potential to actually roll this out for every citizen. And this is a great way of democratizing healthcare in that sense, and doing pre-diagnosis of this. And then, of course, deploying all the tools that you just explained. That's post a test. Mm-hmm. So can we look at preventive healthcare proactively? And I think that's where AI can play a very, very important role. And what I just shared is one of the tools that's under consideration.
Yeah. Archana, let's look at some of the other potentially transformative areas which involve AI. Climate change is a huge problem. Public health crises are some other issues which we are all dealing with. I think my question to you has to do with equity. And AI is available to some, it's not necessarily available to others. In as much as we have a 5G revolution in India, we are heading to a 6G revolution in India, there are deep divides between those who actually have smartphones and those who don't. Therefore, how do you and the Bill and Melinda Gates Foundation deal with the issue of AI and equity?
First of all, I must congratulate for putting AI for social good on the agenda. So my congratulations to you, Minister. One, I think my panelists have spoken about how AI can transform health as well as education. At Gates Foundation, we deeply care about equity and access, and the fact that despite the fact that digital tools and digital ecosystem can be transformational for those who have access to it. It should not leave behind people who do not have access to it. So it's really important that as these digital breakthroughs happen, it is important to think about infrastructure. It is important to think about digital capacity that should be available to people who are in the last mile, but also the technology itself has to be inclusive. The emphasis on the fact that this design has to be participatory. A lot of work that's being done, especially in terms of LLM as well as machine learning, getting voice of community,
into these tools is going to be super important. At Gates Foundation, we work on first principle basis. There is a task force on AI within the Gates Foundation that looks at all of the work that's happening across global health, but also, like you said, in the case of climate, agriculture, so that we make sure that we are looking at AI technology from an equity lens and from an access lens. The fact that we are upholding the principles of privacy as well as safeguarding, those principles and protecting people, but also thinking about capacities at the last mile. A lot of work that's being done not only in terms of health, which is about, diagnostics that you've spoken about, but also, how these tools can be made available to community health workers so that they can think about medical care of people who do not have access. Again, teleconsultation, faster diagnostics, health access to poor people. Likewise, EdTech for students who do not have access to education. These are some of the areas that we're looking at.
Emily, as somebody who's sort of managed several health crises, whether it's COVID or Ebola recovery strategies, the link between or the potential use of AI and disaster management, whether it is pandemics or a natural disaster, how could it potentially work?
Yeah, thank you. I mean, the first thing to say is I think it's really interesting when we're in crisis, because this is a state where actually governments and private sector do innovation very well, because it's all hands on deck in a crisis. And so you see government coming together with private sector to rapidly look at new ways to digest information and to respond in effective ways. And this gets even more exciting with AI, whether it's a pandemic or natural disasters. So I work for the Tony Blair Institute. We work with 40 governments around the world with their leaders to help them get things done. And one of the main things we look at is how technology can help them do that faster and better. So in terms of natural disasters, two big things that I think are really important with AI. One is looking at how do we prepare for natural disasters. We'll be able to do this in completely new ways with AI. And then the second is how do we respond to it? In the first, in terms of preparing, so one specific example now, we have satellite imagery of the entire Earth basically every day. There's companies that do this. That's incredible. But it's also a ton of data to actually use. So with AI modeling, we can take the historical satellite data from the last 7 years, put it with the weather data from the last 7 years, put it with what has happened with natural disasters, and we get a very effective model for assessing how this weather is going to impact this area. In the hands of governments, that's an incredibly powerful tool to plan for what's going to happen next. And we have a partnership right now with the government of the Philippines, actually, to build out a new model so that they can prepare for landslides. So that's one example. Then in terms of responding, similarly, you can get incredibly rapid assessments of the damage that has been done after a natural disaster using satellite imagery and AI again, which can then help governments plan where do we need to respond first? What is the damage? How do we get there? And after a natural disaster, getting there 24 hours faster or accelerating that path to coordinate all the actors can save lives. So this is just two examples I would say that governments should be looking at with private sector to apply AI in the space of natural disasters and climate.
Satellite imagery has transformed journalism, I can tell you that as well. I do a great deal of my work based on satellite imagery.
And just to build on that, I mean, we had similar work cases. The first example, right, of prevention, which I think is super important, and in a living example. So we've got over 100 countries that are utilizing an application at this point to prevent flood damage. But more importantly, we can now predict 7 days in advance with relative accuracy as to when a major flood is coming, right, for that perspective. And in some countries, that'll save hundreds of millions of lives. I mean, if you think about it through some of the scenarios over the course of numerous years in 100 countries. So it's becoming real. I mean, we do see that that was an obvious use case, but again, it comes back to there's a tremendous amount of data in weather, right, for that variability. Yeah. We still can't completely predict the weather, but we can come close, right, I think is probably the best way to put it.
Archana, would you like to comment on that?
And another partnership that we have with Google in terms of how to farmers, and this is in the area of response, how do smallholder farmers respond when there is adverse event, but also because of fantastic work that's being done in India, whether it's digital identity, data exchange, which